across the platform. From the Charts tab, and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. Trading has begun. Here's a look at where the markets opened up. Actually, well, it's mostly lower, although loss is very modest in the first minute of trading. Dow is down about 1/4 point, NASDAQ as well. S&P a little bit less than that, and the Russell, Eric Kuby's small cap picks, they're a little bit higher, just above the unchanged line. So a little bit of a mixed picture, but very sluggish to start. We'll see if this market can get some direction either way as we go ahead. But now let's take a look at some of the stocks that could be moving today with Sean Cruz, a contributor here on the TD Ameritrade Network. Good morning, Sean. Markets are sluggish, but it looks like you have some movers to talk about. First up, HPQ. This is a big mover after a big investment from Berkshire Hathaway.
Yeah, and I think, I mean, investors, and we have to, TD Ameritrade, based out of Omaha, Nebraska, previously also where Warren Buffett's from, considered the Oracle of Omaha, so it always gets a lot of attention in the company. But I think it's one thing where Warren Buffett has a very specific approach to making his investment decisions, and he's historically not been known for going out there into some of the frothier or extremely speculative areas. So I think for a lot of investors, when they see him make an investment, or it comes out that he's got a stake in a company, he's not just in there for a quarter or two or even a year. He finds some long run value or some long run opportunity. And I think HPQ, it makes sense. If you look at it in the computer space, there's a lot of people who are upgrading their PCs. There's a lot more investment going on in just having technology, no matter if it's even at home, or even a lot of corporations are starting to go out there. And he sees a reason that HPQ is actually maybe going to be a good place to park your money, where typically it's not only does he see value, but he also sees some sort of a lower volatility aspect to it. And so if you're someone who's looking in a market that's very volatile lately, maybe if you're looking for a low value play, sometimes Warren Buffett is a good way of signaling that, but you still want to make sure you're taking a look at it. Maybe you already own something that's highly correlated with HPQ. Maybe you already have enough low volatility, decent value plays. But certainly anytime Warren Buffett makes this kind of investment, it's going to draw a lot of investors to follow on.
It's interesting because that was the first thing I thought of. We know Buffett likes the value, so in my mind I was like, HPQ must be pretty attractively priced. I will say though, I did look at the median price target, so other analysts, and it's $36, and it's currently trading above that at $39. So it's interesting that obviously Buffett sees something that maybe some of the other analysts don't. Obviously can't necessarily bet against him, but one other thing I think that's important to note is that this isn't the first investment we've seen him make. I mean, Berkshire Hathaway has a lot of cash on hand, something to the tune of $140, $150 billion, and they're starting to put it to work, whether it's in Occidental Petroleum, Allegheny Insurance, and now HPQ.
Yeah, and I think, I mean, that's why I always say, look at where they're putting it to work and look at your portfolio, because Warren Buffett doesn't, and there actually are some hedge fund managers and some investment managers who just look at each individual investment as this is the best value I see just in general if you lay out every investment opportunity in front of me. But some investment managers, and Warren Buffett is one of them, where they take a portfolio approach to their investments. So he's not just making this on an island. I think HPQ is the best technology stock that's out there. He's taking into consideration everything else that he owns when he does this. So that's why I always say, and I qualify, look, Warren Buffett makes an investment. It is something you should worth taking a look at, something you should look at, but he doesn't make these investments on an island without considering everything else he's holding, and neither should any other investor at all. But if you're a trader, you can look at this as maybe an opportunity to go out there and say, look, if I think there's going to be some more follow-on investings, there's actually a lot of funds that track the Berkshire Hathaway investment portfolio. So there's going to be some funds that now have to go out there and buy some HBQ. And I think there's a little bit of that going on here. But if you're a trader, and even if you're looking at options, then this also creates some opportunities in the options world as well. If you're looking at, selling some premium or maybe buying something where you're expecting the momentum to continue. So this creates a lot of opportunity, one for short-term, more active traders, but it also is something for a lot of people who maybe have a portfolio approach to take a look at and make sure it fits in what you're doing.
Well, shares are up 14.4% right now, so certainly generating a lot of interest today. Let's move on to Constellation Brands, another winner today, although up 3%, so a bit more modest compared to HPQ, but still impressive gains nonetheless. They had earnings. How did they fare?
I mean, the earnings came in, and I think right now, and especially for this upcoming quarter, one is everyone considers the kickoff of the financials here in a week or two to be this official start of earnings seasons. But I think if you look at what we're getting right now and where the uncertainty in the market is, we don't know how a lot of what has happened up to this point is going to affect longer run expectations. And markets, and specifically equity markets, they actually are great discounting mechanisms and great ways to price in what we think is going to happen in the future. So hearing from a company like Constellation Brands, it's a staple company. They use commodities as a direct input to almost every product they make. So hearing from Constellation Brands and seeing how they're viewing all of the price pressure. Because you think about a lot of the last time you heard from a lot of the companies we usually focus on, it was before February and March where we saw really this fever pitch increase in commodity prices that are inputs for almost any and every company across the board. You're hearing from Constellation Brands, which is one of those stable companies, and you see as more of an offensive business as usual type of a company to look at, but you're getting a little bit of a read through on how they're managing a lot of these input issues, the input costs that are going to be an issue for a lot of these companies, but seeing them not only able to come out and raise their guidance, they're looking at is $11.20 to $11.50 per share. The market was looking at about $11.39. So I think what a lot of the concern, and I'm still going to be keeping an eye on this moving forward, is given everything we've seen in commodity prices up to this point, how companies are going to start projecting their expectations moving forward. I think there's a lot of concern that there's going to be a lot of companies having to lower those expectations, start cutting expectations, or even pulling guidance altogether. But seeing a company like Constellation Brand that is really right there attached at the hip to these commodity prices, able to come out there and reaffirm earnings per share estimates that are more or less in line with what analysts were expecting as well. I actually think that this is at least a decent sign that we're not going to see things falling apart. I would have expected if Constellation Brands would have come out and said, hey, sorry, we know you were expecting $11.39 per share for earnings per share, but we think it's going to come in at $10.50 because of commodity prices. I think you would see a massive reaction from the market today. So I actually think Constellation Brand coming out and how in the face of everything we're seeing from input cost inflation, coming out and still being able to stay in line with what analysts are expecting might be a good sign.
Well, beer sales are strong, and we know there's a lot of pent-up demand for things like travel, and you immediately think of traveling when you think of Corona. But let's move on from beer and Corona to the maker of Slim Jims, Conagra Brands, another company that reported this morning. How did they fare?
I mean, Conagra Brands, and once again, I think these are really interesting companies to focus on right now because of how close they are to what we're seeing out of the market. But they're actually talking about some of those pricing pressures hitting their yearly outlook. They cut guidance a little bit, but I don't think it was enough to really shake the market. And this is something where I think the market had already priced a lot of this in. If you look at what we've been seeing from inflation costs, the market performance, the way it's been, I think this is one thing where if you have to come out and cut things a little bit, there's going to be a little bit of a haircut giving to you and to your stock. And I think we're seeing that a little bit in Conagra right now. But it highlights another thing that I think is going to be important to pay attention to, and that is your efficiency as a company and how you can navigate it. You have Constellation Brands, which is finding a way to navigate some of their input costs and not have to do too much in terms of cutting guidance. And then you have Conagra, which is for better or worse, and I don't want to say this is all because it's poorly managed, but you have companies that are going to have to come out there and aren't able to navigate this as well. And investors are probably going to put their dollars to work in the companies that, given the spike in the inflection we're seeing, are going to put their dollars to work in the companies that aren't having as difficult a time with it, and avoid some of the companies like Conagra, which I would say is even more broadly exposed to some of these input costs than some of these other companies, but they're having a little bit of a tougher time with it. So you're getting a little bit of a preview of this earnings season and how you should think about companies and how they're going to react. If you're able to do what Constellation Brands did, you're going to probably have some pretty decent post-earnings performance. But if you have to come out there and start cutting guidance like Conagra, then you're going to see investors probably not use it as a buying opportunity, but maybe go find companies that are navigating this inflationary environment a little bit better. They're probably going to go put their money to work there.
Yeah, it'll be interesting to see how many additional companies talk about passing those higher prices on to the customers like Conagra, and if demand remains strong regardless. We'll see just how strong the consumer is. All right, Costco reported March sales, and I see multiple price target adjustments in turn. I'm counting at least 6 here. Break it down for us.
Yeah, and I think it is going to be watching what analysts do in the face of a lot of these adjustments that we're seeing from companies. They're either going to reaffirm and keep things where they're at, or the worst case is they're going to come out and say, yeah, they're not going to do so well in this environment. They're going to start cutting. But for companies like Costco, you're seeing just across the board, Barclays raised them to $6.50 from $5.70. Goldman Sachs raised them to $6.27 from $5.61. That is an example of a company where they're figuring out how to navigate this environment. I mean, make no mistake, even though Costco is considered a wholesaler, they still have to source everything they put out there in their stores from some supplier who's probably raising costs on them, and they're finding a way to do that. And it's coming from, they're selling in bulk. There's a little bit a different dynamic in terms of what they're doing. They're probably able to raise a little bit of the cost. They've got the membership fees that they can toy around with. So I think Costco is one of those companies. I don't have a Costco membership. If I did, I'd probably end up throwing half of it away because you have to buy in bulk before I actually used it. But I think for a lot of families, and if you think about where a lot of this inflationary discussion is coming into play, it's how is the average American household, not me living in an apartment in the city and I buy just food for myself, but for those people who have kids and bigger families, how are they going to navigate this? It actually increases the value proposition of a Costco, where you can say, hey, you know what, I'm going to go out there and I'm going to buy things in bulk, and it's going to, at a per unit measure, going to make it cheaper for me to put food on the table. I think it makes Costco an obvious a choice for a lot of consumers who maybe were still going to the local grocery store, are now probably going to start going there. So a lot of this inflationary issues and a lot of these inflationary costs that are coming through at the core level. And we always talk about inflation as, you know, the X energy and food, but right now energy and food are the two key things that everyone needs. That is where people are trying to find a way to navigate. And Costco actually, they even sell gas at Costco as well. So it's a place to go where they're probably going to have this be the best marketing opportunity of all time for them to get more people coming to their stores.
I don't have a Costco membership either, because I don't have cabinets big enough to fit the stuff from Costco in them in my small apartment either. I'm getting a glimpse into your cabinet situation, and it looks much more appealing than mine. But lastly, in the software space, Coupa Software got an upgrade from Evercore ISI, and it is actually up about 2.6% this morning. Tell us more.
Yeah, and I think they're looking, what Coupa does is they actually provide spending management software, and that is, if you're a company out there, once again, this kind of all goes back to what's going on with inflation and cost. Coupa Software, they actually have spending management software, and it's coming in pretty strong. It's a way for people to navigate some of these supply chain issues. And if you're a company looking at a tidal wave of costs coming at you, and you have a company like Coupa that says, hey, we've got some software that can help you figure your way, figure out a way to navigate this, and your investors are going to like it when you report earnings. I think it makes an obvious choice where it's pretty much the lifeline you need to be thrown right now in this environment. So you're seeing analysts come out there. There's right now one of the price targets is set to by Evercore to $140. It's a pretty decent upside from where it's trading at now. And I think it's one of those things where a company like Coupa, it's not one of those, hey, inflation was high this quarter, so buy our software and we'll talk to you again next quarter. They actually usually lock in longer term deals. So this is an interesting way for a company like Coupa to come out there and get some customers on and get them into longer term deals where there's actually a stream of money coming in. It makes sense right now that they're probably one of those star companies that you want to look at if you're saying, how do I invest, or what are the companies that are going to have some sort of value? Costco with their buy in bulk and it's at a per unit cheaper. That's something that's going to drive a lot of people there. Coupa Software going to businesses. Hey, we're going to help you navigate this. We have software specifically tailored for navigating spending management. Help you clean up your expenses and help you manage your expenses that you're spending. I think it's an interesting company, and it makes sense that Evercore is seeing a little bit of opportunity here.
Yeah, it's interesting. I'm just looking at the chart here. 140, which is Evercore, they have an outperform 140, really brings us only back to January of this year levels, because it's down about 33 or 34% year to date. But hey, upside regardless could regain some of this year's losses according to Evercore ISI. Sean Cruz, thanks so much for all of those, for breaking down all of those stock movers. Appreciate it.
Yep, everyone.
Coming up next, Inside Out, we'll look at some stocks that could help shield your portfolio from not only inflation, but a potential recession risk. That and more ahead on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
I'm Jenny Horn. Here's a few more of this morning's movers to keep on your radar. JP Morgan reiterated its overweight rating on Apple, but cut its earnings forecast due to slower consumer spending. The firm said this was led by its modest haircut to its revenue growth estimates for iPhone, primarily iPhone SE and services. Although they said the overall reduction in estimates is fairly modest given the resilience of high-end smartphones, tablets, and laptops to the broader slowdown in spending. Morgan Stanley maintained its overweight rating on Disney, saying its parks division will help strengthen the company's earnings outlook. The analysts believe Disney is implementing technology and operational tools that should drive structurally higher growth and incremental margins in the long term. They noted Disney's streaming, however, remains more of a show-me story, with success not priced in. And Citigroup started coverage on Roblox with a buy rating and a $59 price target, saying it's now safe to enter the metaverse as expectations for the stock have come off the boil. The analyst said Roblox's ad-based monetization is more balanced than Meta platforms, and its U.S. users generate about 2 times the average revenue, which is also less than Meta. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Caroline Woods hosting.
Thanks to Jenny Horn. We're back to Morning Trade Live, and now we're joined by Kevin Simpson, founder and CIO of Capital Wealth Planning and author of Walk Toward Wealth. Good morning, Kevin. Thanks for being here.
Hey, Caroline. Thanks for having me.
So, Kevin, before we get to some of your specific picks, I want to talk strategy overall. What does an investor need to look for to help protect their portfolio from not only inflation, but now these recession risks?
Yeah, I think that's the big question for everyone out there, all of us collectively, because we've been so placated and spoiled for the past few years with stock markets performing so well. How do we readjust portfolios, not just to deal with this inflation, and you did a great job talking about that in the last segment with Costco, but also more specifically, how do we deal with the higher probabilities of recessions? And one of the easiest things in the playbook is you can look at real estate or raw land or commodities or even energy plays to play off that commodity trade. But those have really been very active trades as of late. There's been a big run in every single one of those sectors. So if we're looking for an inflation hedge and potentially a recession hedge, I make the case that dividends, and very specifically, Caroline, dividend growth can be a true hedge against inflation. If you have a company that's increasing its dividend each and every year, you have the ability, in effect, to generate increasing revenue, almost like getting a raise. So we're really identifying opportunities within that dividend growth sector.
All right, so looking for income opportunities. I know one of the stocks in particular that you like is Cisco Systems. So does that have to do with dividends, or is it more multiples, or both?
Yeah, I think it's both. And, a lot of times we're looking for, show me a sector, or show me a place where we can look for inflation hedging, recession hedging. And to me, it's more about just show me these great stocks. And again, building diversified portfolios. Cisco's not the top of mind when you're thinking of tech names, but it's an old school tech. The dividend yield is over 2.75%, which in and of itself is pretty good. I know the 10-year Treasury is pushing it, but 2.75 on a tech name is pretty good. You also mentioned multiples. About a 17.5 on a forward multiple is good valuation for a company, because fundamentals more than ever are really going to matter again moving forward. So you kind of check off those two boxes there. Their earnings growth was over 7%, which is pretty attractive. And then sticking with our theme of dividend growth, Caroline, for the past 5 years, Cisco has averaged a 10% increase on their dividend. So for me, that's the stock that I want to be in, especially when I'm thinking about it from a little bit of a defensive posture in the tech space.
Yeah, and it's certainly a better value now than it was at the end of last year. It's down about 15% year to date. In terms of other picks, another one, ICE, the Intercontinental Exchange. Why do you like this one, Kevin?
So if we're sticking with that commodity theme, it's sort of an anti-beta play. Like, there's going to be more commodity trades on a commodity exchange. So it's a way to get exposure to the more heightened volatility within the commodity space by owning a stock that can benefit from that. The other thing that I like about it, the dividend's not huge. It's around a 1% yield, but they've had a 15% dividend growth over the past 5 years, including this year. They've already raised their dividend this year by 15% over quarter, which is, again, that whole theme of looking for companies that are giving me a raise each and every year, regardless of what markets might be doing, up, down, or sideways. Not only do I want to get paid while I wait, but I want to be able to increase my cash flow to help keep pace with inflation. And this is certainly a great candidate.
All right, sticking with that commodity theme, you have an ag play as well, and that's Deere & Company. Now, this is one that's actually done very well year to date. It's up almost 20% year to date, but you think that there's room to run with this one?
Yeah, well, this is it's an interesting idea, because we sort of rotated out of Caterpillar into Deere, and we've caught a little bit of this run. But from a momentum standpoint, I still think that yes, as long as they can continue to increase their earnings, which they've had an incredible history of doing, that the stock can still go higher. With this one, maybe you pick your spots a little bit. You look for broader market pullbacks to build a position. It's never, an all or some gain, but I wanted to try to show a diversified type of holding to build a diversified portfolio. John Deere pays about a 1% dividend also, so not a massive yield, but 5-year dividend growth has been at a 10% clip again, looking for that increasing dividend. Their revenues have averaged also about a 10% increase over the last 5 years. Earnings per share were up 20%. It's a solid play. It's not a knock against Caterpillar. We've owned both off and on over the years. But right now, I just think when we're looking at what's happening within inflation, especially within the food sector, the ag sector, this is a very comfortable way to get exposure. And I would, again, cautiously build a position here.
All right, we'll leave it there. Thanks so much for those 3 plays. Kevin Simpson, founder, CIO of Capital Wealth Planning and author of Walk Toward Wealth. Thanks again.
Thanks, Caroline.
All right, now let's trade it with Tom White, the co-host of Fast Market. All right, Tom, let's start with Deere. How do you look to trade that one?
Well, you have to look at it. It's a high-priced stock, nearly $410 a share, just off of those all-time highs that we saw a couple months ago. So you have to take that into consideration. I think the option market gives you that leverage to do so. And based on Kevin's analysis here, if you think it's going higher, grain prices are going higher, the need for agricultural equipment is starting to rise, right? And the farmers are flush with cash at this point. So if you think that this is one of those plays that's going to continue to outperform, you mentioned it's already up nearly 20% so far in 2022. How do you play that using the option market? Well, you give yourself some duration, right, for this to play out through the spring planting season. So I looked at the June option series here, going out about 70 days till expiration, where I'm going to buy a call vertical as opposed to just buying the calls outright. This will give you leverage or a less capital-intensive way to get into the shares over the next 2 months, where if you're bullish, you think it's going to go higher, this might be the way to look at it. Buying the 410 strike call, which is basically at the money, and then against it, because there's still a lot of option premium in these out-of-the-money calls, I'll sell the 450 strike call, which would be a new all-time high, against that long 410 strike call. So creating this bullish $40 wide call vertical to the upside. If I pay roughly about a $15 debit for that, it's going to take my break even on this, where I start profiting at expiration up above that 425 mark, which is just below those all-time highs of 438 from last month. That break even, just about $16, $17 out of the money to the upside. So you don't need that big of a percentage move, and you're saving on getting into a bullish position because you're not buying the shares at $410 a share. So this might be the way to play it. Implied volatility relatively low considering what we're seeing in the overall market also.
All right, thanks for that, Tom. What about a name like Cisco Systems, which is actually underperforming the broader market by a little bit this year?
It is, and you know, Kevin mentioned getting paid to wait, and the option strategy I looked at in here is to take advantage of that, where if I buy the shares, I want to collect that dividend, create some yield against my long stock position. So you can do that. You buy it for every 100 shares of stock you buy, you maybe sell a call that's out of the money to the upside against it, creating more yield, right? So you still get to own those shares, you still get to collect that dividend. But the example I looked at was for every 100 shares you buy, selling a May 57.5 strike call against your long stock. That creates this covered call or buy right position that allows you to collect the dividend, and you're collecting yield on that short call. If you pay roughly about a 53.20 debit on it, that's going to be your break even on this trade. That's about $1 below the current share price. While it limits your upside, it also, if the stock market continues to gyrate, consolidate here, or even go lower, you're going to create yield by selling calls against your long stock. So this might be the way to play it over the next 43 days. And as you get closer to expiration, you can sell another call against it for every 100 shares of stock that you own. That's going to create more yield. It's going to lower your break-even point and keep you in this position. So neutral to bullish type strategy here, paid to wait.
Paid to wait. All right, Tom, thanks so much. Always appreciate those trades.
Thanks.
Coming up next, we'll keep the trading going and look into Ford after a downgrade this morning at Barclays. Stick around on the TD Ameritrade Network. Morning Trade Live. We'll be right back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back to Morning Trade Live. I'm Caroline Woods filling in for Oliver Rennick. Here's what we have for you in hour 2 of the show. We'll talk to Alex Coffey in just a minute about Apple and the latest analyst note from JP Morgan. Then we'll trade Ford following a downgrade at Barclays. We'll look into rare earths with a guest who just launched an ETF in the space last week. And the Chartmaster will come and he'll look at analyst moves in Yeti, Wayfair, and Home Depot. Now let's take a quick check at where the markets are about 30 minutes into trading, and we're actually seeing a little bit of green. NASDAQ has turned positive, up about 0.4%. Dow down 218 points, down 0.6%, so the biggest loser so far this morning. Meanwhile, the Russell is down about 0.2, so turned negative after inching above that unchanged line, and the S&P 500 basically flat on the day. Alex Coffey now joins us to talk about Apple. Good morning, Alex. I'm just taking a look at Apple. It's actually up about 0.5% today, but we got a note out from JP Morgan. What were the key takeaways there, Alex?
Yeah, analyst Sam Chatterjee released his note here on Apple, and like you said, it looks as though, although there was a bit of a cautious tone to the note, the market is taking this kind of in stride here, as you do see Apple more so following the general trend of the NASDAQ this morning. A little bit of a whippy trade, but is above the unchanged line after some weakness the past few. Within the note, I thought it was interesting to note that the analyst did keep his overweight rating as well as the price target at 210. So it's more cautious language, and I think in many ways this language catches up to kind of what the general feeling within the marketplace has been. Talks a little bit about a reduced consumer spending outlook going forward, and how that may weigh on Apple. Also speaks about the limiting of the upside expected from Apple's launch of the iPhone SE 3. We talked about some of those production cuts that we've heard chatters about from Apple as well, and so this in many ways is catching up to that narrative at the same time. I also noted from this analyst is that because of all this, they did trim the earnings forecast for Apple, led by a modest haircut to revenue growth estimates for iPhone and services. So the interesting piece here is now there's conversation a bit on the services side of things where it's primarily been limited to product. And so this is where it may come down to a little bit more concern about the consumer spending outlook in general and how that may have an impact kind of across the board. So there's almost more of a macro read through here than just solely tied to Apple. But again, as I said, I did think it was quite interesting, and I think this ties into the analyst's last point that Apple's quite a resilient company. And so although there may be some near-term headwinds for the general marketplace, you're still looking at a stock that they like over at JP Morgan with an overweight and the price target at 210.
Alex, it's so interesting, just building on that note about, the reduced consumer spending outlook. There's such a disconnect between how consumers are spending right now and how they're feeling about the economy and inflation and the future. But we really haven't seen any signs that they're pulling back yet, have we?
Not entirely, but I would note that we did see, of course, consumer spending be reduced downwards in the GDP going back to the fourth quarter. And so you're starting to see declines in terms of the amount of expenditures that investors are putting out. All the while, you're seeing the prices paid go up. And so that's usually kind of an interesting sign. But you talk about the outlook that we see in surveys from the University of Michigan, for example, the consumer sentiment. One thing that's been pretty consistent over the last 3, 4, 5, 6 months has been the expectations for where things will be are continuing to be pretty grim. And so if I look at the situation, my prices that I'm spending on core things like food and energy are going up. My feeling about the future is not necessarily great. There's a lot of uncertainty in the near term. At some point, there's a lot of signs that are pointing to, reduced consumer spending outlook. The question now, Caroline, I think comes down to, has the market sniffed this out, and is a lot of this already priced in?
Yeah, it's interesting. I'm not seeing it when I'm booking travel or on a flight that's completely booked or in a restaurant that I still can't get a reservation to. So I mean, still so much demand in some of those pent-up areas that we had to give up for so long. Just in terms of trading today, Alex, over 30 minutes into the trading session today, market's not doing all that much. Dow picking up a little bit of speed in terms of those losses, but what's caught your eye today?
Yeah, NASDAQ outperformance, I think, is the early story so far. But we talked about this yesterday, Caroline. Everything seems to be stemming from volatility in the U.S. Treasury market. So I'm really watching those yields as they continue to roar higher here. Again, continued pressure on the long end of the curve. And so if that volatility continues, it could spill over to stocks. But so far, a bit of a bounce back day, at least in the tech side of things.
And then in terms of what's going to, aside from just watching yields, in terms of what's going to move this market, you think it's just we have to wait till earnings and inflation data next week?
Those are clearly going to be important factors. Caroline, can't discount that, particularly the banks kicking things off. But I think Fed speakers continue to move the dial. Might be less and less as we've gotten their picture painted fairly clear now for what's to come. But I also think, we still have uncertainty on the geopolitical front. So any type of shocking headlines on that front could lead to some short-term volatility. But for the most part, Caroline, it's sort of business as usual here. The market's largely aware of a lot of the known unknowns, I guess you could say. And it's just a matter of how that data comes in and how those headlines print to see what the next direction will be. But I do firmly believe that it's going to move the bond market first, and the bond market may be where we get the clue as to what may happen for stocks after.
All right, we'll leave it there. Alex Coffey, thanks so much. See you later on Next Gen. Joining us now is Ken Rose, contributor on the TD Ameritrade Network. Good morning, Ken. We're taking a look at Ford this morning. Barclays downgraded the stock. What's behind that call?
A couple of areas that Barclays indicated were areas of concern. One was inflation and the impact of inflation on consumers' disposable income. The second one was interest rate hikes and the impact that could have. If you look at the percentage that consumers have been spending with regards to automobile payments, it's currently sitting at about 13.5%. If we have an increase in cost of the automobiles, and we also have an increase in financing automobiles, and of course that percentage is going to go up, and that could have a negative impact with regards to demand in that particular area. Also of concern to the analysts was the production pressure, supply chain issues, particularly with regards to chip availability, so that they can build the vehicles and get them out there for consumers here, Carolyn.
So I'm just taking a look here in terms of other analysts, 9 buys, 10 holds, and 4 sells. So pretty mixed picture in terms of what analysts are expecting, but the median price target is $19, which still implies about $4 upside from here.
Right, yeah, and Barclays basically went from a target of about $24 down to about $17. So we're still at a price higher than where we are currently at. It looks like when Ford opened up this morning, it took about a 1% cut to the downside, but where it's at right now, it has steadied a little bit. And when I last looked at it, it actually moved up a little bit from where it opened up this morning. But it'll be interesting to see where it goes from here on the chart. In looking at the chart, a couple things kind of jumped out to you. Is the stock is down about 26% year to date, so it has already had a significant move to the downside. With the breakdown this morning, it broke down below a significant support level 1560. I have the current support level down below there at about 1440. If we're to break down below that, I have the next lower support level at 1236. If it were to recover here and move to the upside, we have to break above that 1560, which is now resistance. If we were to break above that, I have the next higher resistance level sitting at about 1789. The stock's currently selling at a price multiple of 8.6, which is historically low. It's also low in relationship to the average price multiple for the S&P 500, which is currently sitting at about 24. It also pays a nice dividend yield of about 2.6%. That's on a payout ratio of 22.35. However, while that dividend yield is rather attractive, when you're in an environment of raising interest rates, those dividend yields, while attractive, they become less and less attractive when you have things like the risk-free rate going up outside of the dividends of the individual companies. Caroline.
All right, we'll leave it there. Ken Rose, thanks so much. All right, now let's do some trading and welcome in Scott Bauer, CEO of Prosper Trading Academy. Good morning, Scott. Thanks for being here.
Good morning, Caroline. How are you?
I'm great. So, Scott, how do you go about trading Ford? I mean, it's a company down 3% today, but down almost 30% year to date.
Yeah, and so, there might be buyers out there looking for a buy the dip buying opportunity, but from a technical standpoint, this is very bearish. You've got the stock sitting below the 200-day moving average. You've got the 50-day moving average just about to cross below the 200-day moving average, which, some people look at that, that's known as the death cross, a very bearish indicator. So obviously the downgrade this morning does not help the technical nature of the stock either. So I think in the near term here, I don't expect a big implosion, if you will, but I can see a very methodical continuation, a grind lower in the near term. Ken was talking about some support and resistance points. I really see the next area of support, the next big area of support around $13. So what I'm doing is I'm buying just a simple put spread, a simple vertical bearish put spread. I'm buying the May 20th expiration, 15.13 put spread, $2 wide, trying to get that for about 60 cents or so. Gives me really nice reward to risk. That's in line with what the market maker expected move would be going out, 6 weeks or so from now. And also I'm really playing off of that $13 area of support here. So I'm doing that. And listen, if Ford doesn't go down, if it sits here, or if it goes up, I know what my investment risk is. I cannot lose more than the 60 cents I pay for this put spread, but it certainly looks to me, both from the fundamental side of things with the downgrade today, supply chain issues, and then from the technical side here, Ford is in for some tough times in the near future.
Well, the downgrade today was equal weight, so it wasn't necessarily sell, but I guess in terms of, there was so much positive momentum around Ford heading into this year, and then sentiment really dropped off, hence the big year-to-date drop. But I guess, what would you need to see to actually want to buy the dip, Scott?
Well, I'd love to buy it at 13. If it did drop all the way down there, I think that is a very big area of support. I absolutely would want to be an owner there. But let's say it doesn't go down from here. Let's say it just kind of sits here, recovers a little bit. I've got to see this sustain itself, trade for a while above both the 50 and the 200-day moving averages, not just for a day or two, but what I'd really like to see is maybe this thing rally up to 16 and a half, pull back a little bit, then hold support on those moving averages. That would then turn me bullish.
All right, it doesn't look like you're going to get that today, at least not within the first hour and 15 minutes of trading, down 3.4%, trading around 1488, so not too far from that 13 level. Scott Bauer, CEO of Prosper Trading Academy, thanks so much.
Thank you.
Coming up, we'll look into rare earths with our next guest, who just launched a new ETF in that space. Morning Trade Live, we'll be right back.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock, takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He He wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watch List. When the default list appears, select the name box, then Create Watch List. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Morning Trade Live. We're joined now by Jerry Hicks, the CEO of Rare Earths and Critical Materials ETF, ticker symbol CRIT. Good morning, Jerry. Thanks for being here.
Hi, Caroline. Thanks for having me on the show.
Well, congratulations on your new ETF. It just launched last week. Tell us a little bit about the fund and really the driving force behind it.
Sure. Well, back in 2018, the US Department of Interior released a list of critical materials identified as being vital for the national security and for the industry within the US. And in the last year or so, the Australian government, the Canadian government, and the EU have all released similar lists. Now, we've combined all the minerals that are on those four lists and identified what we believe are companies that will benefit from government support legislation to encourage secure supply chains for these minerals. And also these minerals are vital for the transition to clean energy. And we believe that the constituents of our fund will benefit as we transition to clean energy.
So talk to me about some of the top holdings in CRIT.
Yeah, the fund itself is rebalanced every 6 months, and we have some stocks that are based in the US. About 20% of our stocks, I think, are based in the US, and a further 20% in Australia. The individual funds will derive or seek to derive at least 50% of their revenue from rare earth and critical mineral production, recycling, and refining.
All right, so let's talk about the supply chain issue, because we know it's affected so many industries, but there's certainly supply issues in this space. So talk to me about how, just basically about some of those global supply chain issues.
Well, I mean, I'm sure many of your viewers will have experienced during the last 2 years of COVID personal supply chain issues when they've ordered something on Amazon or eBay that's taken many, many weeks to arrive due to supply issues during COVID. On an international level, on a country level, the restrictions on purchasing from Russia has caused the nickel price obviously to spike in recent weeks. We've all seen that. But when we consider that rare earths are predominantly come from China, around 60% of production and up to 90% of refining is done of rare earths in China. And also, say, 70% of cobalt, for example, comes from the Democratic Republic of Congo. So we've got supply chain issues there. We're very vulnerable to changes in political will. Certainly in the past, Japan, for example, has been vulnerable to supply of rare earths from China. There was a trade and diplomatic dispute about 10 years ago, and as soon as China said to Japan, well, you know, if you don't like this, we're going to stop supplying you with rare earths, and suddenly that diplomatic issue was resolved. China has also previously cut off exports of rare earths, and it took the WTO to intervene to get those to return to normal. So certainly supply chains can be weaponized, supply of certain minerals can be weaponized. And so that was a driver for these governments to put in place these critical mineral lists and try to look at supply chains and how to improve them for their own national security.
Well, we've seen increased demand in this space due to the electric vehicle boom, which really, if we're paying attention to what the automakers are saying, it's all about EV. So the demand should continue. So given the fact that there are already supply issues, and Russia, for example, is a big supplier of nickel, and there's talk that this war could go on for years and years, how much does this threaten really the transition to electric vehicles? Will there be enough supply?
Look, a lot of analysts are saying there won't be, particularly lithium, nickel, cobalt, the rare earths, everything that's involved in producing an electric vehicle is going to be in short supply going forward. Now, the transition to green energy is a very material intensive one. So, for example, an electric vehicle requires 6 times more mineral input than a conventional internal combustion engine car. And these rare earths and critical minerals are also used in wind turbines and solar panels. And again, you need 9 times more mineral input to build a wind farm, which is equivalent power to a gas-fired power station. So there's going to be a huge supply shortage in these critical minerals going forward, and we believe our fund is well placed to take advantage of that.
Okay, what about in terms of the shift to clean energy, which you mentioned? Obviously, there's so much renewed focus on oil right now because of what's going on. We've seen oil prices skyrocket higher. Is that setting us back in terms of the green energy movement at all?
Well, if anything, I think it's going to encourage it. With people, push more people towards electric vehicles. Now, what I see really is, if you look back in time, the 19th century was a century of coal. And the 20th century is certainly the century of oil. The 21st century is going to be the century of clean energy. And we believe the minerals in our fund are really the minerals that are going to get us to that clean energy. We have to get there to meet emissions targets. And so, yes, the problem with oil and gas will certainly push people and push governments towards adopting ever faster the clean energy solutions.
So in terms of, we've already seen this significant run higher. As you mentioned, we saw nickel prices soar. So for the investor who hasn't gotten involved, obviously your ETF is new as of last week, but for the investor that hasn't played this space at all, there's still more room to the upside, is what you're saying.
Absolutely. I mean, you look at any report for the minerals included in our fund, and the projected demand shortfalls are going to be significant. Now, you've got a real disconnect right now. There's predicted high demand growing over the coming years, but also you've got to increase the production of these minerals and metals. It's very difficult. Mines take 7-10 years or more to come online, and as we've seen in recent years, there's lots of pressure in terms of environmental concerns to produce these minerals. These products, the transition to clean energy is very mineral intensive, but you've got to dig it out of the ground. And recently we've had Rio Tinto, the big mining giant, have trouble growing its proposed lithium mine in Serbia, and that was canned. And certainly there's been many cases in the States of this as well. So we want the transition to clean energy, but actually producing the minerals to do it quickly enough is going to be very difficult, which again, we believe is very supportive for our fund.
Jerry, I hate to keep focusing on the negative, but we are hearing renewed calls for a recession, which obviously could impact demand. How big of a headwind do you see that at this point?
Well, it's a great question. I couldn't possibly say, but certainly regardless of recession or not, the governments have all committed to emission targets, and the only way we're going to get anywhere close to them is by adopting the clean energy solutions and using the minerals in our fund.
All right, we'll leave it there. Jerry Hicks, CEO, Rare Earths and Critical Materials ETF, ticker symbol CRIT. Thank you very much.
Thank you, Caroline.
Coming up, we'll hit the charts with the Chart Master, looking at analyst moves in Yeti, Wayfair, and Home Depot. Morning Trade Live will be right back, so stay with us.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
We're back on Morning Trade Live. It's time for the Chart Master, and for that we welcome in Ben Watson. Good morning, Ben. I know you have 3 stocks to talk to us about. We're going to start with Yeti, which got an upgrade at Berenberg to buy from hold. Price target cut, though, to $92 from $103. I'm taking a look at Yeti here. It's trading up 1.6% today at $55.84, although year to date it's down almost 33%, Ben. And this analyst says that's unwarranted and a great opportunity to enter the stock. What does the chart tell you?
Well, I'll tell you what, Caroline, this price has been snowballing downhill, but perhaps seems to be a little bit frozen in this range with that price target cut coming alongside the upgrade. And it's been in this sideways oscillation really off of that February earnings announcement and kind of finding this range in between that 53.5, 64.5 area as support and resistance. And, kind of still that mixed bag, if you will, even with this downward move, a little bit of a sell-off coming on that upgrade, somewhat counterintuitively, but pushing it back down into that support. So it's tried once, twice, now 3 times potentially to bounce up off of that 53.5 support level, but still struggling to get out of this little bit of a range here at this point. And if you look at sentiment, long-term sentiment beginning to rise perhaps a little bit, but still depressed down in that oversold range. Intermediate-term sentiment falling really actually after creating this bearish divergence, lower highs in sentiment after a slightly higher high in price. And that suggests investors still just not convinced that maybe abominable snowmans exist or that there's the possibility of a price bounce here.
I don't know. This analyst, I see a note for solid fundamentals and strong growth trajectory, but you're not seeing that same trajectory on the chart, huh?
Yeah, you're not seeing it, and until it breaks out really of that 64.5, maybe that 65 range, and realistically even out of perhaps that 68, 90 to 70 range, those previous highs, do you really start to see this making new higher highs and higher lows? And until that happens, this is perhaps, Yeti perhaps just kind of rolling along sideways here for a while.
All right, let's move on to Wayfair next. It got a downgrade at Wells Fargo to underweight, price target cut to 100 from 110. It's actually up 2.7% today, regardless of that, but trading just below 110. So the analyst thinks that it's going to trade lower because of potentially lower demand and a higher inflation environment.
Yeah. Yeah, Wayfair has been kind of that, or was really that early pandemic darling as people were refitting houses and that sales boom was still going on. Really over the course of this last year, we've seen, again, that downward move, that overall downward trend. A little bit of sideways action going on here as it kind of creates this descending triangle above that 101 level. And we get a little bit of a bounce up off of that today. But that's been in place since that downside move on the February earnings announcement, and then the big bounce up. So gap down rally, testing that 101 support, comes on the downgrade. The potential is there for that bounce up to that next little high or the top of that triangle at the 130 mark. But Caroline, if this breaks 101, the technically derived price target, that pattern target, not a guarantee and not a prediction, but just what this pattern would suggest, would put the price down around $60, $61 a share. And you really don't have a lot other than that rising longer-term sentiment, but it's still down and oversold to suggest that buyers are stepping in. Now, they do have an earnings announcement that's a couple of weeks over the horizon here that could be the catalyst to bring this to the upside. But I think this is all part of the bigger picture that we're going to see in Home Depot as well here in a bit, with rising interest rates, with rising inflation, and slowing perhaps home sales. This becomes a challenge to Wayfair's main business.
Well, especially this analyst points out, and I know Loop did last week or the week before as well, the elevated risk of a spend shift. If inflation is pressuring us to only, it's cutting into the amount of money we can spend, do we want to spend it on a couch or do we want to spend it on a trip? I don't know about you, Ben, but I'd much prefer the trip.
Yeah, for sure.
All right.
And that's right. That's that difference between discretionary spend, and if that's getting pressured by fuel prices and food prices, stuff like, you're absolutely right, couches go by the wayside.
Yeah, even though mine has a rip in it. All right, let's look at Home Depot. It got 2 price target cuts today from Piper Sandler and Wells Fargo. Piper Sandler cutting it to 314 from 342, but kept a neutral rating. Wells Fargo cut it to 350 from 400, kept an overweight rating. It's down about 1.4% today at 294, but same kind of headwinds that these analysts are seeing.
Yeah, for sure. And really the same chart, just kind of different magnitudes of price movement. You're seeing that kind of double top pattern towards the beginning of the year, and then it falls into this sideways trend. So off significantly from that longer-term uptrend that we saw last year, but now finding a bit of support. Now, today, a little bit different. Yesterday and today, we get a gap down rally into a hammer candle yesterday that didn't follow through. Today, on this price target cut, we get a gap down and now becoming a little bit more of a sell-off, and perhaps even a little bit more significant of a sell-off. Sentiment in this case, long-term still moving down, intermediate-term moving down. So definitely some bearish pressures here on Home Depot in kind of this mid-earnings cycle move on the price of the stock, breaking the support. If it breaks down, the next level of support here, Caroline, is down around the 290 level, and we've got to go all the way back to early 2021 to find that level of support.
It's trading around 295 right now, but I'm just taking a look at the commentary from the analysts. Piper Sandler sees a trifecta of consumer spending headwinds, the stay-at-home bubble popping, which we sort of made reference to, the shift in spending from goods to services, but also the inflationary pressures from gas and food, but rising interest and mortgage rates. So even if you can afford to buy a new house, if you're paying a higher mortgage rate, you probably aren't going to have as much money to spend fixing up the house or doing whatever you need to do.
Yeah, absolutely. Now, the one thing to think about, though, is it is springtime, and that typically tends to stir a little bit of revitalization in Home Depot as things spring back to life a little bit in the garden and the yard. So there is that potentially as an upward move here.
Although how much of that might be priced in. Also, the fact that there's very low inventory in terms of the housing market. So if you can't, and if you're not renting, if you do own and you can't find anything to buy, maybe you just, remodel what you do have if you can get access to all the materials and the labor. All right, Ben Watson, we'll leave it there. Thanks so much.
All right, thank you.
When we return, it's market meetup time. We'll break down the market action and find out what you should be watching throughout the trading day. Stick around on the TD Ameritrade Network. Morning Trade Live. We'll be right back.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to
Oh,
wait
wow, I
board.
gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Lichtenstein here with your TD Ameritrade Network futures market update. Stocks and stock index futures products are struggling for direction this morning after selling off from highs earlier this week. The ES back below 4,500 is down around 0.4% in reaction to the Federal Reserve's plans to tighten monetary policy. The Fed minutes yesterday revealed plans to cut the balance sheet by more than $1 trillion a year. U.S. Treasury Secretary Janet Yellen warned lawmakers of how Russia's actions represent an unacceptable affront to the rules-based global order and will have enormous economic repercussions in Ukraine and beyond. Just over an hour since the cash open, the Nasdaq's been hovering below 14,500 and, well, down around 1/3% as yields, 30-year yields, that is the TYX, reached 2.7%. Crude oil is back below $100 to start the day at, well, just below 97. Currently trading higher by about 0.5%. Actually now trimming those and just went negative, as you can see, at 96.22 and reversing the sell-off that we saw in response to the International Energy Agency's decision to release 60 million barrels from emergency strategic petroleum reserves. Natural gas spiked this week, back above $6. We just heard from the EIA. They said weekly natural gas inventories fell by more than expected. Analysts were looking for a draw of 26 billion cubic feet. Actual came in down 33. Also supporting prices this week, domestic production, which has dipped during a time when exports are increasing. Futures at 611 are up over 1% this morning, actually up around 2% right now. This has been your TD Ameritrade Network Futures Market Update. Now back to Morning Trade Live with Caroline Woods.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. It's time to bring in our market meetup panel. Joining me is Kevin Green, Senior Derivatives Manager at Charles Schwab, and Nick Theodorakis, Financial Risk Management Director at TD Ameritrade. Thanks so much for joining us, Kevin and Nick. Kevin, let's start with you. Just taking a look at what the market's doing, seeing red arrows, Dow actually down 0.8% now, NASDAQ even lower. What's your call on what we're seeing today? Stocks, we were saying they were struggling for direction, but it seems like now they're just lower.
Thank you, Caroline. Well, I would say right now we're seeing a little bit of a pullback. We had a really nice run in the markets here, so seeing a little bit of a pullback is really not that surprising. Seeing the VIX at around 23, if you could stay below that 25 range, you probably could make a little bit of a bullish case, if you will, but a pullback could be healthy at this point in time. One thing that I'm kind of looking at right now is the HYG, which is going to be the high yield investment bonds out there, and that's actually showing a lot of weakness. So there's a little rumblings going on in the fixed income market, especially when it comes to corporate bonds and high yield bonds as well. I'm not sure if that's going to be the leg that to fall and cause disruptions within the equity market, but something just to keep your eye on as of late. We have some economic news still coming up, consumer credit coming out. We had that coming out today. wholesale inventories coming out tomorrow as well. So we're starting to end up the week with a little bit of economic data, a little shakiness, but not surprised we're seeing this a little bit of a pullback today. And actually kind of shows a little bit of strength as well. We saw that significant sell-off yesterday. We saw a little bit of a rebound, down a little bit over 1% in the S&P 500. So there's still some bulls that are out there that are trying to buy this dip.
Nick, is this just a pullback, or was that strength we saw that Kevin made reference to a bear market rally?
Well, time will tell, right? I'm, I'll take the other
Safe
side.
answer.
Just, in my risk space, Yeah, well, time will tell, but it feels to me like a bit more of a bear market rally, and the reason I lean that way is because when you see, Mary Daly yesterday and then Bullard today aligned, right? Kind of maybe the most dovish and the most hawkish, and they're saying this is a hot economy. Bullard said this morning, that this job growth will continue. We're likely to get below 3% likely to get below 3% unemployment, and he wants to see that short-term rate above 3% this year. I don't think markets were expecting everybody to pile into that camp, especially some of the more dovish Fed members. So I think this is a bit of a sell-off that is. I agree with Kev. There's some good components to this over the last 10 to 15 days. We saw a bounce. We saw a bounce in some of the sort of the tech leadership names, and whether it is a bear market bounce or we really are kind of just taking a pause and then we're going to get back off to the races. Either way, in my opinion, they throw out some of these really good names along with all the other stuff. So you got to really, think about your portfolio. Don't react too quickly. There's ways to hedge yourself. There's ways to protect yourself. Just make sure you're kind of taking into account fundamentals, because you're going to see everything down. Over the last 4 or 5 days, we saw, basically the S&P indices, sectors, I should say, split, 5 up, 5 down, 6 down. Today, almost everything's down. There's only 2 sectors up. Healthcare and staples, I think, are the only 2 that are up right now. So it's feeling a bit heavy here, with more sectors participating in the sell-off after Bullard's comments this morning. So time will tell. It feels like we saw a bit of a bear market rally, and potentially we're going to slide here for a bit. But those ultimately yield investment and buying opportunities in stocks that are going to perform well throughout the cycle.
Kevin, in terms of the data, we did see weekly jobless claims hit, like a 53-year low, yet that failed to excite the market this morning. Has a strong labor market, a strong economy already been priced into this market?
I think really the participation rate is going to be the focus. And so every month when we look at the actual non-farm payrolls themselves, you want to look at that participation rate. That's what really the Fed is really counting on right now. Those that were on the sidelines, those that may have retired early, getting back into the labor force, if you will, and to be able to get off of the sidelines and help out with some of the supply chain glut. So I think it might be a little bit priced in. I think there's still a little bit of a wait and see, and you can actually see that right now in the VIX and a lot of the options trading that's going on. A lot of the options trading, a lot of the VIX trading is happening in the June contracts and July contracts. I think that's going to be really the focus in the make or break for this market, either to the upside or the downside. But we got to also keep in mind we are in a midterm election cycle, and that tends to be a bull case for the market towards the third and fourth quarter here. So we just got to keep that in mind. And we could also be trading in a range. I mean, we hit the 4,200 level, almost the 4,200 level 3 times, and we saw a really good technical rebound off of those levels in January, February, and in March. So we could potentially see a range between the 4,600 and the 4,200 level here in the S&P 500. Just something to keep in mind and keep our eye on.
Nick, you say time will tell if this is a bear market rally, but I have heard calls for pullbacks of 20% or more. Obviously, it's impossible to time the market, but how should investors approach some of these down days in terms of dip buying, so positioning themselves for solid gains while trying to also manage risk?
Well, all the stuff we just talked about, right, is already out there, right? The Fed has laid their cards on the table now. We see that. The war doesn't seem to be escalating, at least at this point. So a lot of these unknowns have become knowns, and the market, I think, is looking for footing. And that's why, the charts are really nice to look at, but that stuff already happened, right? So we don't know what the next tick is going to look like. And I think to protect yourself here, I mean, Kev mentioned the VIX. Look at the VXN too, right? There's so many of our our clients are, heavy tech investors, and VX, the NASDAQ VIX is right at that crucial 30 level. And I think that, we couldn't keep VIX below 20. VXN, or the NASDAQ VIX, is right back at 30. So the market's telling us that even though a lot of this sort of uncertainty has come out, there is still worry out there. There is still a level of concern going forward from these prices. So what's the next catalyst? Well, we get a bunch of data next week, tons of economic data in relation to, in relation to this week where it was relatively quiet. And we get earnings season kicking off. So, the big banks kick us off on Tuesday, Wednesday of next week. So I think, hearing how these companies are talking about what inflation looks like, what the employment situation looks like for them is going to be probably the next driver, along with some of the geopolitical stuff that's still out there. So, hedges are more expensive now, right? If you want to buy options to protect your position, you're paying up for that. But if you're a long-term investor that's holding a portfolio that's been, beat up, there's certainly some dollar cost averaging opportunities out there now. And there's obviously the ability to trade some, individual options or spreads against your positions to protect yourself. But, those options cost more money now because, there is that level of concern out there. But I think you still have to consider those strategies because while some of these stocks are down 20 to 50% already, there's a lot that are not. And if this selling were to pick up, right, if this really were to kind of ripple through, you have to have a game plan for that. I'm not saying it's the most likely scenario, but you have to have a game plan to protect those holdings that you want to keep in your account.
Kevin, I do want to ask you, HPQ, one of the biggest movers today, it's up about 18% right now, obviously because of Warren Buffett, Berkshire Hathaway's investment. But can we draw any conclusions from the fact that Warren Buffett, who's been holding on to a ton of cash, some $150 billion, is starting to spend it?
Not surprising at all, especially when the market has cheap cash that's out there right now. He does see some opportunities, and that he's a fundamental investor that's going to look for the long term. HPQ, we saw actually some pretty high options trading on the name here for the last couple of weeks. So seeing this pop coming out right now is not really too surprising coming out of this news here. But one thing to just kind of keep in mind, Caroline, before we let go here, we do have earnings coming up. The financials are going to be the first ones on the deck, if you will. But just kind of be mindful, the financials don't really tell the full story of the overall economic picture or all of the earnings that are going to be coming out. So it might be something that we do see some choppiness from the financials, but that does not mean that it's going to be the same way for all these other sectors that are out there, just because of the yield structure that's going on. The net interest margins are definitely going to be a little bit compressed, and their outlook is going to be a little bit more depressed as well, as you're looking at an inverted market. So let's just keep that in mind as we go into earnings season.
All right, appreciate that note. Kevin, Nick, thanks so much.
Thank you.
Thanks, Caroline.
And thank you for joining us. I'm Caroline Woods. I'll see you this afternoon on Market on Close. But up next, Trading 360 with Nicole Petalides. She's live from the New York Stock Exchange, so stay tuned, and I will see you in just a bit. Have a great day.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. with innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live from New York City, live from the floor of the New York Stock Exchange. Let's take a quick look here at the markets. The red continues, folks, as we see the selling continue. You can see that the Dow is down 210 points, losing 0.6% at 34,286. The S&P 500 down 0.25% at 4470. The Nasdaq is down 0.1%. And the Russell's down more than 0.75%. Now to some of the biggest movers in the markets. We're watching HP spiking higher. Warren Buffett's Berkshire Hathaway initiated a major stake in the company. Berkshire purchased almost 121 million shares worth $4.2 billion. That is an 11% stake, and this purchase follows other recent investments by Berkshire in Occidental Petroleum and the insurance company Allegheny. ConAgra is slightly higher today, despite issuing disappointing guidance. The food manufacturer saw profits fall 22% due to higher than expected transportation and raw material costs. ConAgra did say demand remains strong, despite the company raising its prices. Rite Aid tumbled this morning after Deutsche Bank downgraded this stock to sell. In fact, lowering the price target to $1. The analyst said there's the possibility the drugstore operator may not be able to generate enough earnings to continue as an operating company. And Wells Fargo, call here on Wayfair, downgrading Wayfair to sell, lowering the price target to $100. The analyst said higher interest rates and potential for a slowing economy could be bad news for the stock, tied to consumer confidence and housing market, could weigh on it all. Here's a look at the futures products right now. You are seeing Bitcoin down 90 at 43,685. The dollar is down just fractionally at 99.61. Gold is gaining almost $17 at 19.39 a troy ounce. Crude oil 96.62, and the VIX at 23.70. Let's get some insights of the news shaping the markets, and for that we welcome in Jay Hatfield, founder, CEO, portfolio manager, Infrastructure Capital Advisors. Jay, thank you so much for being with us. We heard from the Fed. We got some great claims in today. The market has now gone back to that selling season. What's going on here?
Good morning, Nicole. Thanks for having me on again. What really we see happening is you had a little bit of relief rally when the Fed came out with their dot plot, and Chair Powell had the press conference, but then what I would call erratic communication from the Fed has taken us a leg down. It seems that Powell neglected to mention that they actually had come up with a number for the tapering of $95 billion, which is above market expectations. And also, he failed to mention that he was sympathetic to this 50 basis point increase. So that's taken us another leg down here. We think there's some support for the market, S&P at 4,400. And the reason for that is next week is earnings season. And we think earnings in general should be positive and will be a positive catalyst for the market.
A positive catalyst. So if that's a positive catalyst, I mean, we'll kick it off with a lot of the bank earnings, right? But I think that when you talked about the 50 basis points, I think the part that I think is so fascinating is that the Fed, and we heard from Brainerd, and they're willing to sacrifice some growth, it seems, in order to tame inflation. Does that part worry you?
Well, certainly we're in dicey times because the Fed is lurched to being hawkish from being ultra dovish, inappropriately ultra dovish. So that's risky. The Fed there's been 18 tightening cycles since World War II. 11 of those have ended in recession and only 7 in a soft landing. So it's perfectly reasonable to be concerned. What we think is the most likely case is in the second half, the two critical sectors, housing is likely to slow some, but not crash. We have really a shortage of housing. The ratio of housing to households is below the 50-year average and way below what it was in 07, 08. It's about 110% of housing to households, and it was 120. So we think housing's okay, and we think energy is finding a level around 100, so it'll get capped out. So we think inflation will get better, and the Fed will become more dovish in the second half. It won't take us into a recession, but that does remain to be seen.
I'm glad you brought up the $95 billion, right? I think that a lot of folks had been talking about the surprise, right? $60 billion in treasuries, $35 billion in mortgages, so they'll continue that. It'll probably be over $1 trillion in a year. That would equate at least probably a couple of rate hikes itself without even actually doing rate hikes. What I did think was interesting, a conversation I had yesterday, Jay, tell me what you think. You mentioned how Powell acknowledged that he was considering 50 basis points, but because of Ukraine and took a pause and decided to do 25 basis points. Do you think there is some empathy to the market or what's going on here at all? Because if there is still war in Europe, if the war expands somehow, how are they going to get in there and just start doing 50 basis points?
Well, like I said before, we do think the Fed is being erratic because they have, what they haven't acknowledged is they've already really accomplished their objective. Their objective really should be, and another data point is 11 out of 11 post-World War II recessions have been preceded by a housing decline or even crash. So the key sector for them to cool off is housing. And they've already moved rates just by talking and not raising from 30-year mortgages of 280 to really almost 5%. That's absolutely going to cool off the housing market. We don't know how much. So they should be more patient. But yet again, really ever since Greenspan, the Fed has been highly incompetent. Groupthink is worse than, Volcker or Greenspan. So it's entirely possible they make another mistake like they did in 2018. But we're optimistic. There's new Fed governors coming on. We're optimistic they'll be more reasonable and recognize there's a lag in monetary policy. And therefore, they'll wait to see this cooling in the second half.
Okay. And so with all of that, I'd like to get to some of your recommendations or what you see that might be working at this time. I saw you have dividend payers, right? Pipelines, some large cap energy, telecom utilities. You like preferred stocks as well, REITs, which often is a real safety play. And cryptos could crash. Tell me a little bit when, these were just some of your ideas here. We won't have time for each one, but I am curious where you think money should go.
Well, we think there's a little bit of a misconception around what's driving tech stocks and crypto lower, or at least was going lower. It's not really interest rates. Rising interest rates are bad for really all investments because all stocks are long duration assets and preferred stocks are too. But really what it was is the decline in liquidity. We had a bubble last year in tech and arguably cryptocurrency. This year, you're seeing that bubble decline. We think that's going to get worse in the second half of the year when that 95 billion is going to come out. So we think, but we do think, just like yesterday, you'll have that kind of market where the conservative dividend payers, the stocks that we own in our strategies, are actually up on days where tech and the more risky, higher beta, higher volatility names are suffering from the prospect of liquidity coming out. And then the other great thing about buying dividend stocks, as we've said before, is you can be wrong and still be right because you're getting paid the way you reinvest your dividends. So it's not like I'm saying go buy Dogecoin. You're buying great conservative household names that pay you dividends. And in the case of preferred stock, you're senior to common, so you're getting paid before the common shareholders. So we think it's a year to be cautious. We've been saying that before the year started, but it's sort of more obvious now with the super hawkish Fed, markets down for the year. And these defensive stocks have already outperformed. We think they'll continue.
Thank you, Jay, very much. Good to talk with you. I appreciate it. Jay Hatfield, Infrastructure Capital Advisors. Thanks.
Thanks, Nicole. Thank you, Nicole.
Plenty more to come right here on Trading 360. Customer experience software company Sprinklr is in our 360 spotlight after it reported its earnings yesterday. The company's founder and CEO joins us live to go through the numbers and give us an outlook. Zeta Global is today's disruptor, in fact, an upgrade from OpCo. Tom White has all the details and an example trade. And we'll discuss telecom stocks in our 360 round. I'm looking forward to that discussion. But up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals. Charles Moon from Prosper Trading Academy takes us to the trades for DoorDash, Lyft, and AMD. Next here on Trading 360.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides live in New York at the New York Stock Exchange. The big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. And here to take us through the trades, Charles Moon, Senior Market Strategist for Equities at Prosper Trading Academy. I love what you're bringing to us today, Charles. I think, there's been a lot of talk. Should there be a merger between Lyft and DoorDash to take on Uber Eats? Now, you can give me your opinion on this, but I know your first trade is actually DoorDash. Tell us.
Right. So DoorDash for me is very attractive. They've been actually pretty strong. Now, in the short term, they've been spilling over just like a lot of these stocks. And we say, where could this bottom come into play? Well, yesterday when the market was breaking down pretty hard, DoorDash bounced off the 20 SMA. And then the news came out that or at least the rumors between Lyft and DoorDash, the talks are getting intensifying and a deal is possibly closed. So both Lyft and DoorDash bounced pretty nicely. They were both a lot stronger than the rest of the markets, which was spilling before the FOMC, so the FOMC volatility. And then for me today, it's kind of in that weakness mode with the broad markets, but seeing where DoorDash bounced, I'm finding this range very attractive. And again, as stocks spill, we always look to see where that possible bounce or floor or reversal come into play. So with DoorDash, I'm targeting between this like 107 all the way down to 102 range. And for me, if they remain above 100, it makes it a very attractive buy. Now, I don't know how the news will be perceived by Wall Street. A lot of times, the acquiring company will generally go down on a merger news. But, stronghold that DoorDash has in the delivery industry, this could be a huge propellant as well.
Yeah, without a doubt. So it did have a recent low, as you said. It's up off the lows, but it looks, even though it's down about 20% for this year, it feels like this stock has been in somewhat of a range. I do like that you love it, and when it pulls back, Charles, you said 107, 102. I mean, I see what you're saying in that kind of range. Tell me, Ben, your thoughts on this chart.
Well, good morning, Nicole, and good morning, Charles. I see and understand the levels Charles has his eye on. I'm not as enthusiastic about this one, mainly because it looks to me like Dash is kind of running out of breath after the recent run-up that we've seen. Charles mentioned how it has been attractive, how it's been very strong, but again, the most recent move, I should say, as we've rolled over off the 130 levels. What, again, just has me sort of sitting here a little bit on sidelines. Now, in terms of what Charles talked about, the 102 level to the 107 area, I think it was, where he has kind of this heightened awareness in terms of potential to buy here. I can see why it's a lower extreme of this range in a market that has been, well, if you take a look at the 30-minute time frame coming off this 74 low, in a bit of a trend up here, basically since mid-March. But take a look here. In terms of that 20-day moving average, Charles, you can see how we got right back down to it, as you mentioned. And there is a possibility that, again, as we come off this 74 low, we can start to regain composure. But you can see that this move, just a small part of the bigger move that we've seen basically since, well, we're talking the mid-November highs when the NASDAQ maxed out and peaked out at their all-time highs mid-November from 257 all the way down to 74. Let's just take a look at where things stand. We're holding above the 20-day moving average. You can see we're also holding above the 50-day moving average, in this instance, the blue dotted line, below the 200-day moving average. But this is also what has me a little bit concerned. RSI is starting to roll over. If we build energy through the middle, oftentimes opening up a door for a retest of that lower extreme. I did want to point out here, though, taking a look at the weekly, and again, this is what has me a little bit concerned when you take a look at some of the momentum we've seen to the downside, up only 8 weeks since that mid-November high I mentioned back at 257. So yeah, I'd agree. It is attractive. It is starting to, show some signs of strength here right now. The question is, do we just roll back over as we test, again, that lower extreme that we saw back in February, March, April, May, talking this time last year. So we're running into some resistance at this level. And over the last couple of days here, it shows that it's kind of giving way. And, we were talking about it earlier in the week. Basically, Dash looks like the bulls are having a hard time doing the heavy lifting, I guess is the best way of putting it at this point.
Yeah. And I'm glad you pointed that high out, 257. I had to double check it, Ben. I said, really? Because I noted the lows in my notes. I hadn't written the high. And I can't believe it. That really feels far away, doesn't it? 257 from the 110 current price target. But that's Charles' basis, is that he's watching this 20-day, as are you, Ben. You just showed us that, and saying that, look, there's opportunities as it pulls back here closer to the $100 mark for upside. Tell me your final thoughts here on DoorDash, Charles, as you took a look at Ben's points in that chart.
Yeah, absolutely. And, you know, it kind of fits to the point why they're so far off the highs. Specifically, they were a COVID pumper, right? The growth was established during the COVID. CEO come out and said, we don't expect the same type of growth that we saw during the shutdown, which makes total sense. Wall Street kind of ran away with it. Retail traders ran away with it. They punished them for being a growth play during COVID. But overall, when we talk about dominating figures in their space, that's what DoorDash is. And I tend to be attracted towards the dominant players versus the up and comers. And you know, we still know that DoorDash is definitely a growth company. And the growth play is a bit muted, obviously, with the FOMC stance. This is really dependent on how the market's transition, because I wouldn't want to be a trader in DoorDash on the long side if this market is completely breaking down. This is a great momentum play, but if the market does reverse and start to look up, this has to be a must-watch play. This is one of those great momentum plays. When it does get bullish, it really just finds a lot of bids and just really stacks up very quickly.
Yeah.
And that's what makes it attractive. This is a low risk, high reward scenario, even in just the near term.
Okay. Yeah, and you know, I think it's interesting too, to your point, you know, which one will be the acquirer, which one will be the takeover target, because usually the acquirer go down, the takeover target goes up. I mean, it could be a merger of equals, so we have no real way to sort of say, oh, you know, get in on DoorDash because Lyft will buy DoorDash. It could be the complete opposite, right? So let's talk about the trading that we've seen on Lyft on the other side of this. And that is, I've noticed that it really was in this channel, looked pretty choppy. What do you think, Charles?
Yeah, so the whole basis here is that they remain above this 34 price level. They break through and take out the new 52-week lows. Again, is there value for the long term? Absolutely, but I don't usually play on stocks that are breaking down just to kind of jump in and say, well, it's due for a bounce. For me, I like established floors. And again, if Wall Street does find Lyft very attractive, we'll see Lyft hold this 34. It is very range bound. This is a range bound type of trade, with the idea that if this merger happens, maybe DoorDash is the acquirer, then Lyft is going to be the propellant, and obviously they have tremendous upside as well. And again, when they're the acquiree, of course, they're going to be the demand play, the push-up play, the buy target play, and that's going to be the watch here. I certainly don't expect an all-cash deal if this does take place. I expect that someone either be a mixed cash stock or a all-stock deal, which, you know, that dilution from Dash, they can afford it. But overall, again, for me, finding Lyft attractive to be a player, especially on the trade side versus investor side, I want to see this 34 level hold.
What if Uber buys DoorDash? Right? That would throw like a real wrench into our conversation. I just looked at Uber versus Lyft, and they both are not pleasing to shareholders. I mean, neither one is a winner. I'm going to give Ben a chance to jump in here. Your thoughts on Lyft, Ben?
You know, I just wanted to point out, when I look at Lyft right now, similar to what we just talked about in terms of a Dash, it's in a bit of a range. It's been, well, struggling to get anything going to the upside with any real follow-through. But the real concern here, and actually I've kind of highlighted this range that we're in right now, 46 down to 34. The real concern here is that, again, basically we're retesting this lower extreme right now in a market that's been trending to the downside. So you mentioned the channel and how we've been kind of choppy. Nicole, I completely agree with this. Now, what's interesting for me is let's just take a look quickly at, well, here you can see in terms of the daily time frame where things stand relative to the 50-day, again, the 200-day, the purple line, they're below both. Also a similar situation as we talked about as far as Dash, RSIs rolling over a little bit here. And, you know, speaking to that point, well, again, in terms of net change, where things stand year to date, down almost 20%. This month, down 10%, and this week, down 8%. So you can see, again, coming under pressure, and as mentioned here, now testing some key levels, this lower extreme. But I also wanted to point out here, again, to your point, let me just find this chart that I have here, because Lyft has there it is, the channel to the downside. As you mentioned, Nicole, here you can see that we're kind of just working our way through the middle of it. So in line with what we've seen as we work our way from the upper extreme of this channel, lower extreme, that's what has me a little bit concerned. Testing key lower levels right now, failing to get anything going to the upside, and now kind of working our way through the middle of this range towards the lower extreme. We could open up a door for the downside and just continue this momentum lower here. So one that's really struggled to get anything going to the upside here, very similarly, even more so in many ways than Dash.
Yeah, you know, Charles, are you feeling a little bit contrarian at this point? with these trades?
I certainly sound it. And again, these trades are very dependent on the markets turning up. We've seen the market reaction today. Yesterday, after the FOMC minutes release, markets rushed to the highs, rushed down to the lows, and rebounded back. So for me, the growth play is a bit muted. It certainly is going to be, in all respects, a more riskier play. But when we've seen this market get bullish, let's just say over the last 2 weeks, we've seen how strong these growth names came back. What was really prominent was in cybersecurity names and cloud growth names. Those rebounded back and snapped off like they were early last year. Just a really strong uptrending move. And then, there were some stocks that kind of followed suit, but overall, we're seeing that pullback right now. And this is where my concern is. Overall, for the year, we've been in a downtrend since we started. The S&P 500 made their new all-time highs just a couple of days after the start of the year, and we've been rolling since. And that is the concern here, that we're going to just continue this downtrend instead of just trying to stack up and rise up. Now, what gives me a little bit of hope is that the SPY is defending that 50-day simple moving average pretty aggressively, and so is the NASDAQ. And again, if we could stay above this level, we're trading within yesterday's range, so we haven't broken down below the lows. We didn't break above the highs. We're really consolidating today. It's certainly more bearish than bullish, but if we hold and then start to rebound, then of course these names are going to be highly attractive. These are, what I would consider low risk, higher reward variants.
Okay, well said, well said. Last but not least, and that is AMD. I mean, we could see the slide on that one too. But this one feels a little different because of what it brings to the table. Its large position as a market leader, Lisa Su at the helm, that a lot of people really believe in her outlook and hard work there at the company. So this one, I'm interested to hear what Ben's going to say on this one. But Charles, you're up. This is your trade.
So we could almost copy and paste the chart for Lyft and apply it to AMD. The semis actually were a bit muted. They definitely rallied back, but they're definitely one of the sectors from the tech side that was a little bit shakier than the rest. It really kind of started, and the breakdown really started with Micron earnings. It was pretty surprising. Micron had a really strong beat. Their guidance was really good. On their sales revenue side, they said plus minus 200 on their estimates, and that was way, way above what the streets were expecting. So since that point, Micron was basically washed out. It dragged down Qualcomm. Qualcomm broke through that, major swing low of 2022. Micron did the same as well. AMAT did as well. NVIDIA and AMD are really struggling here. NVIDIA is barely holding on to the 200-day. With this little market drop while we're talking, they may be through that 200-day. But that's what makes AMD very attractive. Going back over the last 6 months, they've approached this $9,900 level. The last time, or the first time they approached that level, they ripped it straight to the all-time highs. They retraced back here in early December, bounced back off that level, back to that 130, came back down here at the start of this year, ripped it right back to 126, and here we are right around this 102, 103. So the question is, how many times can we test this level without breaking? Certainly the market has established this as the line drawn in the sand. So it's the same thing with Lyft. If we see the stocks hold, this is a very low risk, high reward opportunity. Again, AMD is a lot more attractive than Lyft in my opinion. But certainly the semis are under fire. It may have to do with the COVID shutdowns in terms of production. It may have to do with the supply chain issues with some of the rare materials needed to create, these semiconductors. The conflict obviously is having an effect on neon production, et cetera. Maybe that's the cause and effect for why the semis have been a bit of a struggle in comparison to, let's say, cloud or cybersecurity. But nonetheless, AMD at 102, especially holding this floor, makes it extremely attractive for me.
Understood. Okay, so he really is making the case here, Ben. Your thoughts?
He is. A quick look at the charts here, Nicole. I agree, and I think Charles hit the nail on the head when he said kind of a copy and paste in terms of Lyft. Take a look at the 60-minute time frame first and foremost. Remember, we identified that range that Lyft was in and how we're testing the lower extreme of it. You can see, again, almost identical pattern playing out here in terms of AMD. Taking a step back from the hourly time frame, you can see how, well, Charles mentioned, below the 200-day moving average, below the 50 RSI in a similar pattern, kind of rolling over, and volume, again, starting to, well, it's kind of limited in terms of what we had been seeing. It had been on the rise throughout this period where it had been declining. So as we've gone a bit sideways, you can see a little bit of a shelf holding just above this $100 level. I wanted to take a step back because that balance we just looked at on the hourly time frame, we're talking $130 to 99. Well, take a look at where that stands on the weekly time frame. And what has me a little bit concerned here is we were forming areas of value to the upside. So migration of value to the upside means a trend higher. 1, 2, 3, 4, 5. Why isn't 6 forming at a higher level? In fact, it's now forming at a lower level. That really brings us into question. At the very least, we're going to start to form a larger area of consolidation here above 100, below 164. But if the bears have their way at this point, then we're going to continue to see some weakness off that 164 high. I'd be watching 100 in terms of the lower level of this range that we've been in basically since, well, the beginning of the year. So key levels right now, we're testing a lower extreme, one to watch here again. And yes, in a very similar situation as Lyft.
Great to see you both. Thank you for that. You love those charts? Thank you both. Charles Moon, Prosper Trading Academy, Ben Lichtenstein. I think this was a great one. Dash, Lyft, and AMD for the big three. Thank you. Coming up next, we're going to spotlight Sprinkler after the customer experience management platform did report better than expected earnings yesterday. The founder and CEO will join us next. Tell us all about his company's growth and what lies ahead. Trading 360 continues.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Nicole Petalides, live from the New York Stock Exchange. Let's take a quick look here at the markets. Of course, we've been selling off this week. You can see right now that trend is continuing with the major market averages to the downside. In fact, the Dow right now down 264 points, 34,232. And you can see the S&P down 25 at 4456. The NASDAQ losing more than 0.5% at 14,395, and the Russell down 1.25%. It's time for our spotlight. Our spotlight today, Sprinkler, after the company experience platform did beat on the top and bottom lines yesterday. It was a beat and a raise. With us now is founder and CEO Raji Thomas. Thank you so much for being with us. Welcome back to the show. A beat and a raise. Pretty great. Feeling good? Tell us what's going on with the company.
We are feeling amazing, Nicole. We're just very pleased with the quarter and the year.
where we reported more than 30% growth for second quarter in a row, fifth quarter of reaccelerating growth. And in the context and at the backdrop of the macro uncertainties that's going on in the world, we're very pleased with where we are, and we're super happy to see that we're becoming an enabling platform for large global companies to digitally transform themselves and get closer to their customers.
Yeah, and I know you have partnerships with great companies. I saw, a lot of talk about Uber, but that's just one of your many partnerships where you have more than 80 customers paying over $1 million plus for over a year to keep your help and your work at Sprinklr to enhance the digital experience, to help them engage with their customers. Tell me about some of the partnerships that you are allowed to talk about.
Yeah, absolutely. Let me just back up a second and talk about what we do. We provide a platform for large global brands to do all customer-facing functions digitally. Everything from customer care to marketing and advertising. And we do that on a unified platform, bringing those teams and markets and business units together. So we work with, at this point, 9 of the 10 of the world's largest brands, about 76 of the top 100. And you mentioned Uber. It's one of our great customer stories where they have been a customer since 2014, started by doing customer care on the Sprinklr platform. You're on an Uber ride, something goes wrong, you're probably reaching out on one of the social or messaging channels to the company to get your issue resolved. So that was phase 1, where we had hundreds of agents log on and resolve issues on the platform. And from there, they evolved to the second phase, where they started listening to customers, listening to things going wrong, even if that's not directed and customers aren't calling Uber. And they call it proactive care and proactive engagement, protecting brand reputation and mitigating and getting ahead of potential crisis. And the next step is to really use the voice of the customer to drive business strategy and decisions.
Yeah, I think it's just fascinating how you work so closely with these companies, because they do want to reach out and engage, and you use AI in order to help them really personalize the experiences that customers have. That being said, are you on a growth trajectory? Are you happy with what you have? Is it good enough? Or what are some of your plans and agenda in order to continue? I mean, I know the Olympics was something that was a big deal for you as well, but now what?
We believe we're creating an entirely new category of enterprise software. We call it Unified Customer Experience Management. This is the ability for businesses to manage what goes on when a customer comes in contact with their brand digitally, right, on the website, on the mobile app, or any one of the social and messaging channels. We think it's a long-term trend. We think the rise of the category is inevitable, because we know that every brand is trying to go from brand centricity to customer centricity. Every manufacturer is trying to go direct to consumer. Every retailer is trying to go online, and everybody who's online is trying to get into conversational commerce. So we think these are secular trends that's going to bode very well for what we do. At this point, we're in a rare group of companies at $500 million or so. It's growing 30%, reported last quarter.
Yeah.
And a $60 billion TAM.
Yeah, I saw bookings and revenue and subscriptions all on the rise, roughly 30%. That being said, are you looking for any sort of deals, mergers, acquisitions? I must have to believe that some of the big, large companies are saying, look at what Sprinklr is doing. Impressive. Have you been approached by any super large companies, or are you, on the other hand, now saying, look, we're growing and we're really establishing some strength and we might want to do some acquisitions? Where do you stand on that?
So we've done 13 acquisitions in our past, and we think this is very early in the evolution of the category. We think it's a 10, 20, 30-year play, and the market can sustain growth of 25 to 30% for a very long period of time. We think we're better served by being a great partner to companies like Salesforce and Adobe, other front office players, and we can complement it by being a third or fourth platform for these large global companies.
Right. So last but not least, when you look at the current environment, does that spook you at all? You know, whether you see rising rates or an economy that might be pulling back, will there be budget cuts for some of these companies? They certainly are paying more for labor. I know you're well aware of every single one of these indicators and data points.
Yeah, so I just got back from a trip to Europe where we met with 75 of our customers over the span of a week. And what we are finding is the macro environment becomes more uncertain. As we know, it's constantly uncertain and getting worse. Companies want to dial up their ability to listen to competitors, listen to their customers, listen to the world to make these decisions. And as a platform that helps businesses understand what customers and prospects want from them, the impact of what's going on, we think we're becoming more relevant than ever. In the Ukraine-Russia situation, most of our customers are setting up dashboards in Sprinklr to find out whether their brands are being mentioned. If there are supply chain issues, any of the vendors or partners are getting online conversations are dragging them or their brand into some of this, one side or the other. And they're making strategic decisions by using AI and understanding what the world what the world is looking like outside of them.
Yeah. Raggy Thomas, great to see you. Congratulations on a great quarter and boosting the outlook there. Thank you very much. Great to have you on. Raggy Thomas, CEO, founder of Sprinklr. Thank you. Coming up next, it's time for the disruptors. We're ready, and Tom White is all over it. In fact, today's disruptor is Zeta Global. It was upgraded over at OpCo, and Tom has all the details and a way to trade it next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York. Time for the disruptors. Tom White is here. We're taking a look at Zeta Global. The ticker symbol is Zeta, Z-E-T-A. An upgrade today. It's amazing that they have a $20 target over there at OpCo, and it's already up 57% this year for this cloud-based marketing company. Tell us all about it. What do you think of this call? Give us some details.
Yeah, the call is making the stock hit all new all-time highs today, up about 9% on the session, Nicole. And this company is based in digital marketing, right? So they're taking all the data that they gather on consumers and allow their customers to target these consumers using their cloud-based platform. So they're across the omni-channel spectrum of web, connected TV, chat, social media, email. all the things that companies are looking to advertise on, right? So if you look at the upgrades based on their marketing platform becoming a strategic platform for digital transformation and privacy compliance, the CEO said last quarter after their earnings that it's a multi-billion-dollar addressable market that these companies need and have that demand for data-driven, identity-based marketing. So Zeta Global right in the mix of all of that. They did raise guidance last quarter also by about 10% above the street expectation. So good things coming out of this company using this cloud-based marketing platform. And I think the CEO said it best when he said the total addressable market that's out there for this firm is pretty minuscule right now, and the ability to grow in the near-term future up to levels that they set aside on their last earnings call for 2025 are achievable at this point. Now, there was some concerns that Google pulled third-party app marketing tools, and that the iOS system out of Apple was doing the same thing, was going to hurt them. But this is, as brands try to expand their exposure to consumers, Zeta Platforms is taking that. They're using the privacy measures that they have built into their platform for the good, as they call it. So this is definitely one to watch in the near term. And as you mentioned, they put a price target of $20 on this stock.
Yeah, I couldn't believe that part. I'm glad you summarized all that beautifully. And I think about the competition in the world of cloud. I know that, as you mentioned, the CEO, one of the things he said was just how much AI, and I think you talked about this, is how much AI can really help some of the supply chain issues that we've been facing here in our country. That being said, the competition is real, but as you talked about, some of the prospects looking good too. How would you trade this one, Tom?
Well, you have to think about it this way. Targeting ads to consumers, that's on everything that we do in life, whether it's social media, just speaking to your Alexa. So this is a needed product for a lot of these brands. So the way that I looked at it, you can buy the shares. They're trading around $13 a share. Not that expensive, but I looked at an option strategy that takes advantage of the higher implied volatility in some of the put options to kind of finance a bullish spread here. So I used a combo spread where I went out in duration on this one, and we're looking at the September options. So they only have monthly options here. Buying the 12.5 strike call, which is currently in the money by about $0.50, and then selling against that the 12.5 strike call in that same September monthly cycle. So I'm creating this combo trade that's selling the puts bullish, right? And then buying the call is bullish. So you're combining them. So you're getting double bullish on this type of strategy. And if you can collect roughly about a 60-cent credit, it might be closer to even money right now. But if you can collect 60-cent credit on this combo spread, that takes your break even all the way down to $11.90 on this. And you can see from the risk profile, Nicole, this looks like a risk profile for just buying shares of stock, right? But you're using the option market as leverage here for selling a put to finance buying your call, which is a bullish trade also. So this might be the way to look at it. You get a little bit more leverage here. You've got basically about 162 days in this position. So you've got plenty of duration for Zeta to continue to move higher over the next basically 6 months.
Yeah, and I like that break even too. I mean, this certainly seems very exciting, and I like the bullish play that you've set up there. Thank you so much. Tom White, good to see you. Thank you.
Thanks.
With our Zeta Global Disruptor today. Coming up next, you ready to talk telecom? Our 360 round. What stocks are outperformers? Can they continue? U.S., internationally? Some of the headwinds, of course, too. Our panel is ready next.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Bond futures are on the move lower this morning, in line with the trend we've seen, a reflection of the more hawkish tone from Fed speakers this week, and, well, in reaction to the Fed minutes from yesterday, which showed 50 basis points a hike was considered at the March meeting, and, well, the minutes revealed that the Federal Reserve's plans to cut the balance sheet by more than $1 trillion a year. Yesterday, U.S. Treasury Janet Yellen warned lawmakers of the ripple effect from Russia's attack on Ukraine. She said that they will have enormous economic repercussions in Ukraine and beyond. Bonds to 143.28 sent the 30-year, the TYX, to 2.71 to spring of 2019 levels. Rates on the rise and the dollar to multi-year highs are weighing on large caps. Dow futures, while still holding above 34,000, they're down more than 0.5%. Small caps also coming under fire, back below 2,000, down over 1%. And the ES, the only one of the four majors that's still yet to take out yesterday's lows, it's down, well, by about 0.5%. This comes after a strong report from the U.S. Labor Department. Weekly jobless claims came in below 200,000 for the third week in a row at 166,000. This morning, James Bullard, the Federal Reserve Bank from the Federal Reserve Bank of St. Louis, said the inflation at these levels is exceptionally high and that the FOMC is behind the curve. He'd like to see the Fed funds rate reach 3.5% the second half of this year. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Pedalides.
Ben, thank you so much. Ben Lichtenstein there with our update. It's time to talk in our 360 round. Welcome back to our show. We'll focus here on some of the telecom stocks. Joining me right now, Kevin Horner, Senior Manager, Trading Services Education at Charles Schwab. I know you brought to us so many different ways, because there is so many different ways when you talk about telecom. You know, we think about all the changing technology that's happened, but wireless and telecom, I think of every part of this. What is it that you're focusing on that tells you what's going on here?
Well, as a trader, obviously, one of the things that I'm looking for is consistency and trend analysis. The unfortunate aspect is that telecom within that communications sector has been a real underperformer, like many groups in 2022, unfortunately. But when I dug in to telecom versus the communication sector as an example, I have found some outperformance in telecom broadly. The biggest takeaway that I took from the look I made yesterday was that the outperformance isn't necessarily tied to U.S. based, though. It's a lot more international components. So we've seen outperformance from South American telecom, as well as Canadian telecom and Korea-based telecom as well. So some individual equities that are available in there have really been leading, in fact, trading recently at 52-week highs. And, you know, obviously the names within communications sector are big ones in the U.S. You know, we're talking the Alphabets, the Metas, et cetera. Those are the companies that have actually been bringing us down on a basis there tied to communications as a sector. So what I was taking from it was that if in the last 3+, 4+ months you've been investing in telecom, you might not be profitable, but on a relative basis, you've been outperforming communications as a whole.
Yeah, interesting, especially with the international part of that play, as you noted in the IYZ, looking at telecom overall. Joining us now to enter our discussion as well is Jeff Kagan, telecom and wireless analyst and columnist at rcrwireless.com. Jeff, I'm glad you're here as well, because we just finished talking about that technology is changing. Some of these companies doing better than others, but you know, telecom it's been a darling at times, but it also has been somewhat of a dud, right? I mean, if you owned AT&T, you haven't been so happy. Maybe if you own T-Mobile, you're starting to see a little growth lately. Tell me your thoughts of which companies may seem to be adjusting to changes versus those that are struggling.
Well, I think the point that you just made is a very important point. I've been a telecom analyst, a wireless analyst for, gosh, more than 30 years. And I've watched this industry go from boom to bust, it seems, every 5 to 10 years. And we've come out of a very quiet time in the telecom industry where Verizon didn't know the direction it was going to be heading in. AT&T didn't know the direction it was heading in. T-Mobile and Sprint were really in big trouble. And then with 5G and with the move toward it, we're starting to move into some very active growth areas. Now, the companies themselves, some of the companies, while the industry is going from zero to hero, some of the companies are positioned in others. Some companies have taken the wrong path over the past several years, and they have to recover. Some companies seem to be hitting the ball out of the park. If you look at companies like Qualcomm, for instance, they just can't seem to do anything wrong. Everything that they do is right there in all these different areas, wireless and telecom and the metaverse and all these different areas with companies all over the world. You've got companies like Verizon, who was trying to figure out what their next move was going to be. They acquired AOL and Yahoo, and it went nowhere. They had to sell it off. AT&T acquired Warner Media, you know, the Warner Brothers and CNN and all the rest. That went nowhere, and they're still trying to recover from that. T-Mobile went from zero to hero. If you remember, they were on the verge of going out of business, it seemed, about a decade ago. They missed the move from 2G to 3G, but then they got a new CEO and a new vision, and they started doing really well, and they've recovered. And not only have they recovered, but instead of AT&T and Verizon being number 1 and 2, today it's Verizon and T-Mobile are 1 and 2, and T-Mobile and AT&T is number 3. So, you know, yesterday's leaders are not guaranteed to be tomorrow's leaders. So you've got to make sure that you're up. Yeah. Got to make sure you're up to speed on.
Sounds like Qualcomm's the real winner. So Kevin, as you know, it's interesting because when we talk about telecom and wireless, Jeff, you know, bringing in his many decades of experience, which I'm so glad you were able to tell us that. And so when we look at telecom, we have to like really think out of the box sometimes. I mean, you were talking about GoGo and the world of aviation. I was thinking about Crown Castle and some of the satellite operators. I mean, there's so many ways that we could think about this. A quick thought, Kevin.
Well, I think he's absolutely right. Heroes to zeros, zeros to heroes. It's been a very volatile group without question. The underperformers, though, might be the ones best positioned. As he said, you know, we've got a lot of these individuals that you might look at in the Canadian space or in South America have been wonderful outperformers, but to expect that to necessarily continue would be, you know, not necessarily a wrong approach. You know, from a trend standpoint, as traders, we're always going with the trend for the most part. But in terms of overall valuations, I could absolutely understand considering more of the U.S.-based approach here, given what we've seen of late. There's certainly a lot of weakness in the most recent periods here, though.
Wonderful to see you both. Jeff Kagan, rcrwireless.com, and Kevin Horner of Charles Schwab. Thank you both very much for joining us.
Thanks, Nicole.
And thank you, friends, for being with me every single weekday at 11 a.m. Eastern Time for Trading 360. I'm Nicole Petalides. I will see you at 2 p.m. Eastern for the watch list. The S&P is near the lows here. Keep it right here.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Good afternoon, traders, and welcome to Fast Market. I'm Tom White, and we've got a great show lineup for you today, including discussions and example trades in Costco, which reported another strong month of sales, along with Dick's Sporting Goods. And like Folio, will break down consumer sentiment data on Roku, which is down over 75% from last year's all-time highs. Now, 2.5 hours into the trading day, stocks extended yesterday's losses after minutes of the Federal Reserve's last policy meeting provided more clarity on the central bank's campaign to dampen rampant inflation. 10-year Treasury yields climbed to 2.65% and are up 90 basis points over the last month alone. Now let's take a look at the four major indices, which are all in the red as we speak. The S&P 500, the benchmark, down 0.5%. Dow Jones Industrial Average down just over 0.5%. NASDAQ 100 down nearly 0.9%, and the Russell 2000 leading to the downside. Those small caps getting hit by 1.25% on the session. But to help me break down the market action, let's bring in my co-host Kevin Hinks, and also joining us today, Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Kevin, I'm going to go to you first. So we talked about the Fed previously. They don't need to worry about the jobs market right now. I think it's pretty good. The data showed that on jobless claims, 54-year lows on that number for jobless claims and continuing claims also. So what's your take here? Is it the velocity that we've seen interest rates rise and inflation, Fed finally catching up to inflationary pressures that we've all seen over the last 6 months? Is that what is causing the consternation for equities right now, is the fact that, hey, the velocity of this rate move is damaging to risk-on assets?
Yeah, I think, Tom, all the volatility around the release of the Fed minutes and what that meant to the market, combined with the fact that Lael Brainerd came out and basically stole their thunder on Monday by basically saying what the Fed minutes were going to say. Right? But we got like a double-pronged sell-off here. Now, Tom, investors have to think about this. This is what I think traders and investors should be thinking about going forward. And that is, how many of these rate hikes is already traded into the 10-year yield. As you know, Tom, the 10-year note is extremely oversold. The TNX, the 10-year yield, is extremely overbought in terms of relative strength. So now what, right? We've absorbed a big move in interest rates. And with inflation, everyone keeps saying on the Fed that it may get better in the second half of the year. How does the Fed get us to the second half of the year with minimal damage to the overall U.S. economy? I don't think their goal should be to cause a recession. I think that would be a huge mistake on their point. So how do they do that? How do they still manage a soft landing when you know the next CPI number might be explosive based on how it was measured with crude oil prices and overall energy? So I think we're at a really fascinating time because, Tom, I'll put a scenario out there for everyone to think about. If they figure out crude oil prices with production and things like that, and they get semiconductors manufactured so the cars can loosen up. Autos and energy were a big part of the inflation read. Why not focus on that rather than spiking interest rates and causing a potential recession? Now, getting interest rates back to neutral, I have no problem with that, and the market shouldn't either, Tom.
Well, historically, in a rising rate environment, equities have done well. That doesn't mean it's going to happen this time. Yep. But Nathan, if you look at what Kevin's statement said, basically the Fed's worked themselves into a box at this point because they didn't hike earlier. They didn't do 50 basis points in March. They're behind the curve. Fed Governor Bullard came out and reiterated his stance. He thinks the Fed funds rate should be 3.5% by the end of the year. Your take after all this rhetoric that's coming out, but Kevin and I have been doing this show for months. We've been calling this, that inflation's running too hot, and I've been stating that the Fed is way behind the curve, and now it's coming to fruition.
Yeah, it is. I mean, and look, the Fed is not our friend right now. Look at the comments that are coming out from Brainerd, and you know, a lot of those number of rate hike estimates that are going up. The 10-year at 3-year highs, as you guys mentioned, all of that is not good for equities. This is all about demand destruction. And, you know, Kevin's right. They don't want to engineer a recession, but they do want to destroy demand and bring those prices down. And, you know, guys, hopefully what the Fed is doing is going to be successful in bringing down inflation. I still have a question mark about the supply chain issues. If you looked at commentary from like Taiwan Semi, he believes that the chip shortage is going to be happening out into 2023. And so if we're in a situation where the Fed is doing one of their two mandates by trying to destroy demand, to take prices down, to stabilize prices, but we still have those issues with the supply chains and the war in Russia and Ukraine persists, I mean, that's going to be an issue. So I will say this. You guys know when I come on this show, the thing that I really think is important for this dynamic between inflation and the Fed is looking at those leading inflationary gauges. How are you going to do that? You're going to go to the commodity charts likely. The PPI, which is more leading, that comes out next Wednesday. Kevin mentioned CPI is on Tuesday. Yeah, I think everybody knows it's going to be hot. But I will say this for the bulls, because guys, I was really going down the list of all the bearish kind of catalysts with what's going on with mortgage applications, with what's going on in the 10-year, et cetera, et cetera. I mean, it's an unbalanced list, and it keeps on getting worse. And I hate to say that. I will say this for the bulls. If you look at the price of crude oil, it is back down to 94. It's broken below its 50 SMA for the first time this year. And that's a first kind of signal you look for, a break in trend. So the bulls will take that small victory for now.
I think that's a great point because we've been following that, how it's been hugging that 50-day and bouncing higher off of it over the last couple of months, Nathan. But Kevin, when you look at that, you know, we look at month-over-month numbers as far as CPI and PPI data, and even that PCE that the Fed looks at pretty closely. But is this just a reprieve at this point? Because now I'm hearing, you know, that the crisis, the humanitarian crisis in Ukraine and versus Russia might extend months, if not years. This isn't going to get over anytime soon, and that's going to continue the supply chain issues that Nathan highlighted. But it is a little bit of a reprieve when you see oil back below 95 bucks a barrel. Kevin, that means my gallon of gas is going to probably go down by 3 cents this week.
You know, Nathan got my point. Some of the inflation pressures are starting to ease ever so slightly, right? They're off their highs. I mean, crude oil, remember, when is CPI for this week? When will that have been measured? With crude oil at 130 or crude oil back closer to $95? That's kind of crucial, right? So I look at crude oil as a pretty good indicator that things have peaked, right? And if we can get the overall view that inflation has peaked, we've already seen the high prints, then bulls can take some of these stocks that have been beaten up and start to nibble on them, right? You've had big sell-offs. You know, it's interesting. If you look back at the rhetoric from Lael Brainerd, this was not a 180. This was a twisting double sow cow off the high beam 180, trying to stick the landing because she's been dovish for the last year and a half on inflation. So for her to come out with these comments, you're like, ooh, what just happened to Lael Brainerd? So she's been extremely dovish in the past. So this was a big reversal on her behalf, talking about inflation. So with that, remember, some of the rhetoric from the Fed, some of their focus and their comments have already brought down some of these commodity prices that Nathan was talking about. Now you're about to get into May will bring planting of U.S. crops. That may break some of those, because if you look at a long-range chart of U.S. crops like corn and soybeans, they're at levels not seen since the 2012 drought. That was a weather market. So they're up there at those levels. So there's still uncertainty in the grain market that could dissipate as well. But there's a lot, you know, this is going to get crazy, guys. I fully believe that. And Tom, I still think, as I said yesterday on the show, there's risks in Ukraine. And there's risks in that relationship between Russia and Ukraine and NATO. That is nowhere near done, guys.
Not at all. Not by any means. And Conagra was another stock, reported earnings. The stock turned around. It was lower earlier, but they highlighted inflationary pressures. They had to raise their estimates, which they've done for the past 2 quarters again. So we're continuing to see that inflationary pressure. But Nathan, when I look at a breakdown of the sectors that we're seeing in the S&P 500 right now and over the last week, they're getting led by the wrong names, right? They're getting led by utilities. They're getting led by consumer staples and some of these other safety type of sectors within the overall market. Is that a warning sign, and that it seems like investors are selling rallies at this point?
Yeah, I do think it's a warning sign. So utilities, all-time highs.
Yeah.
That sector. And guys, you know this historically, if you look in a rising interest rate environment, because utilities tend to be high dividend payers, there's usually an inverse relationship between the 10-year and utilities. I was talking about this with a colleague yesterday. I think what's going on with utilities is the cash doesn't really know where to go to be safe. And so they're going there. And why wouldn't they go to bonds over utilities? Because of the risk of principal. There's the 2 components. There's the yield component that you're going to get on the 10-year, but then you also have risk to principal if you're not holding until maturity. So my guess is that's where the money flow is going to the utilities because they see that's where the money flow is. That's where the uptrend is. They're at all-time highs. You know, follow the trend. But yeah, I do think that's a warning sign because it's like the cash is seeing less and less safe havens. Bonds are not necessarily a safe haven. To my previous point, that maybe you have risk of principal. I was just listening to a commentary from Dan Niles, and he basically said that he's recommending customers go to cash, and his base case was stagflation for 2023. So I do think these are warning signs. And guys, we're watching this slow kind of demand destruction that's going on, and every day, you know, you see mortgage rates going above 5%, 10-year, 3-year highs. You're seeing all these little flashing yellow go to flashing orange. And it's just a slow kind of unfolding. So yeah, where do you put your money? They say stocks can do good when we're going into a recession, but this environment is not like a lot of the previous recessions. We don't have a lot of data. We have 9 recessions since 1950, and with this confluence with what's going on with quantitative easing and inflation and potential stagflation, the Fed not having a put now, I think the VIX is undervalued at 23, and I think it's going to be really hard to compare this particular scenario to other previous periods where recession was a risk.
Yeah, we've been pounding the table on that, Nathan, over the last several weeks, is raising interest rates while inflation's red hot, 40-year highs, is something that we haven't been through, right? We're typically raising interest rates when inflation is, kind of moving higher, but, we haven't had inflation for 40 years, so this is definitely outside of the playbook But Kevin, you mentioned that Lael Brainerd came out yesterday with those hawkish comments. She's almost setting the table. This is the playbook for the Fed. These Fed governors come out and do their little talk, and then Fed Chair Powell kind of eases everything. We haven't heard from him, but the minute shows he's getting concerned about these inflationary pressures. You heard the comments this morning from Bullard. Is that when you look at when, and I mentioned utilities are doing well, consumer staples, these dividend-paying ones. We didn't even mention healthcare, which is just below all-time highs in the S&P 500 sector for healthcare. So it's almost like investors are doing what they should be doing. They're getting into some protection, and as Nathan said, maybe some are getting into cash or remaining in cash. Your thoughts there on that?
Yeah, what's the characteristic of consumer staples? High dividends, right? Yeah. Relatively stable movement and high dividends. That sounds like a pretty safe haven to me. Doesn't mean it is safe, right? Those stocks can sell off, as you can see their charts. But the high dividend nature of that is something that investors look like they're gravitating towards. I'd see Walmart trading up near an all-time high, Costco that we'll talk about, Coke and Pepsi and Procter & Gamble all doing well here. And CL, the other CL, not crude oil, but Colgate-Palmolive is actually up today too. So it's interesting the movement of money from one sector of the economy to the other, guys. And what we can do is watch and learn from what's happening.
Definitely. Nathan, I wanted to kind of get into a discussion in airlines today. Rising costs, jet fuel reserves are at their lowest level that we've seen in decades. So the price of jet fuel is going up, maybe a little bit of a reprieve with oil prices going down today. But this sector, most of the major names in here, the Uniteds, American, Delta, Southwest, all down about 3 to 5, 6% on the session. Now, I was just in an airport, visited, I believe you're in the beautiful state of Texas down there, and every flight I was on or that I went on was full. So it seems like demand's still out there, but this sector got cut, price target cuts across the board today.
Yeah, those input costs there. And you're right. I think the airlines right now are in a period where you're seeing the bookings really exceed in their ability to have that pricing power right now, because we're basically coming out of the pandemic, or at least we're coming out of the flu season in the U.S. Elsewhere in the world, it's still a question mark in terms of the COVID counts and what's going on with the trends. Here in the U.S., though, we have been kind of trending down towards that pandemic low. So that's nice. But guys, with these high prices, it's not just coming from the higher airline tickets, but as you were mentioning with gas and food, et cetera, this is hitting the consumer. So I think it's one of those periods where right now the consumer is willing to spend. They're willing to pay up for those airline tickets. They want to get out at any price. But if we fast forward to 3, 6, 9 months, I think that's probably what the analysts are honing in on, that how healthy or can the consumer be in terms of hanging in there and having these bookings after they've already booked those trips? Are they going to be booking, trips later in Q4 and into next year? They're likely just kind of getting this out of the way. They need to get it out of their system. And then oil, as we know, if that doesn't come down, that's also going to be, a harbinger there for the airlines.
Yeah, those rising inflationary pressures and wages also included in there with the inflationary pressures. But Kevin, you just flew also, I'm sure, on a full flight if you are anywhere down south because people want to get out of Chicago in the spring, of course. But when you look at this sector, and Nathan made a good angle on this, that looking out 6 to 8 months, does some of that demand destruction can start to ramp up a little bit as ticket prices are 3 times what they were, before the pandemic started, and people are getting squeezed from every angle as far as inflationary pressures. Is that what maybe this analyst is calling in the sector, that, hey, the demand is going to go away because people aren't going to be able to afford to travel?
Well, remember, guys, when you look at commodities, when you look at prices of consumer discretionary, higher prices are self-correcting, right? They have their effect on demand that eventually brings the prices back down. It's almost like a self-correcting mechanism that some of these things have. The airlines raise prices until they hit that elasticity in demand. Yeah. And you're seeing it in crude oil, and you're seeing it in these other areas of commodities. So elasticity of demand is a reason, because as price goes up, people start to look and say, nope, that's too expensive, so they choose not to fly. If prices were, and they wait for prices to come back down. These are self-correcting mechanisms, and higher prices serve their function, right? To slightly decrease or dramatically decrease demand.
Yeah, we're going to have to wait and see on that, because I think, people aren't going to be able to afford the flights the way that they're priced right now, right. I think, in the near term. I like Nathan's angle here, pushing that out maybe 6 or 8 months. Yeah, you expect travel to come back, maybe capacity will come online, but the inflationary pressures and wages, one of those things that never goes down, might be a concern also, and beating into that theme. Go ahead.
Tom, it looks like Wally World this summer for everybody. No flying.
Well, you can't drive either, Kevin. I'm paying $6 a gallon. All right, let's get into a stock that's actually doing pretty well over the last several years, especially since the pandemic started, pulled forward. Shares are up about 6% at Costco. The company releases sales data every month, so you get some clarity on what's going on here, Nathan. They reported March sales up 18.7% from basically $21.6 billion. This company hit an all-time high today, above $603 a share. And, it just seems like the demand destruction for Costco isn't going anywhere.
Yeah, what a phenomenal company. And Tom, look at the chart of this guy from 2009 low. It's like a 45-degree angle from the bottom left to the top right. I mean, just an impressive uptrend here in Costco. And, I'm really surprised they're able to do this, but then I think about it, I'm like, well, wait a minute. You go to Costco to save money on gas, and you go to Costco to save money by buying in bulk. And I think that's the allure in this current environment, and that's why they're able to deliver as consumers look for some way to save as they go and get their gas and groceries. So I think that perfectly fits that mold. What I will say, though, so they're at all-time highs today. So that's the bullish case for Costco. It's really hard to fight that uptrend. What I will say, though, what they're likely going to contend with here over the coming quarters, they're going to have tough comps that they're going to go up against.
Right.
The valuation is pretty difficult at 42. That's really high from a historical perspective for Costco, for basically a grocer, if you want to put it in that category. And the RSI right now in the stock is up at 80. And so, most viewers probably know, when you look at the RSI, the relative strength index, when it's above 70, it tends to be overbought. When it's below 30, it tends to be oversold. Another way to look at the relative strength index is to look at the historical RSI on that individual security. So if you look at the historical RSI on Costco, you'll see when it gets to this 75 to 80-ish area, you generally are going to encounter a near-term pullback.
Yeah, and I think if you get that PE moving higher. Now, one thing of note for this year, so historically every 5 years they've raised prices for their memberships anywhere from 5 to 10%. 2022 is the year, because the last hike that they did for those memberships was 2017. So that could throw some volatility in here. But Kevin, when you look at this, Nathan's point about, people are going to the gas station. I go by the Costco by me. I don't pull in because there's a line of cars 30 deep here in Chicago. So I just don't go. But at the same time, they've expanded their e-commerce, right? They're into travel. They're into every item you can get online. So it kind of offsets maybe some of that demand destruction that we talked about. But buying in bulk, as Nathan said, is that the way that you have to look at this company, that they continue to grow, and every time you think that maybe it should stabilize or pull back a little bit, it continues to move higher because they keep on beating?
Yeah, if you remember, guys, March is about a year anniversary from the end of some of the stimulus payments. So for Costco to be able to keep these numbers growing, even a year after stimulus has run out, is pretty impressive. And Tom, here's the numbers. E-commerce was up 9.2%. Stripping out gasoline and foreign exchange, sales were still up 12.7%. These are big numbers coming out of Costco. And you're right, Tom. There's a Costco not far from my house. If you look at that Costco on a Saturday morning, it looks like a scene from Mad Max. People are filling up their gas tanks. They're filling up pickle jars with gas. They're doing everything to get the cheapest gas possible. So, yeah, it's a strange scene going on at the Costco near me out in suburban Chicago. So, yeah, but these sales that they're putting up are just simply incredible, right? I mean, and their ability to keep this momentum going, because that was one of the big fears about this, was that they were going to see a drop off in some of the numbers. But Nathan also made what might be the most important part here, and that is this stock is overbought here on a relative strength. So even with these numbers, I'd be really careful up at these levels, guys.
Yeah, you mentioned that RSI, that indicator. Yeah. Just below the 80 level, so severely overbought, but that doesn't mean it can't continue to move higher. Nathan, when you look at an example trade in here and the run that it's had, maybe it does need to consolidate, or maybe it pull back just a little bit. What kind of strategy are you looking at here for just an example?
Right. Yeah, you guys, you know the common phrase in technical analysis, the trend is your friend. So it's really tough to go against that trend. However, timing is everything, especially in the options world. I know you guys can attest to that. So when you look at the near-term overbought nature of the chart, as evidenced by that nearly 80, about an 80 RSI right now is what I'm looking at. If you believe that perhaps it might be due for one of those one-step downs, that's of course we're in an uptrend. You get 2 steps up, 1 step down, 2 steps up, 1 step down. If we're due, or if you believe you're due for a 1 step down, then it's hard to put on a bullish strategy right here, right now. So another strategy you might consider, if your belief that you get a near-term pullback, is you could look at something like a long calendar spread. It's not that capital intensive, and I was getting a little cute here with the expirations, but guys, I've talked about this on the show before. When you're initiating your option strategies in this type of environment that flips one way or the other based on headlines, and it can get very volatile overnight, the further you go out in time and you attempt to establish either a bullish or a bearish strategy, you got a lot of uncertainty to deal between now and expiration. So what I was looking at, just next Thursday's, next Friday's a holiday, so next Thursday's expiration, selling the 600 call, and then just going to the following week. This is uncharacteristic for probably a long call, calendar, but just going to the 22nd expiration and purchasing the same strike at 600. Last I saw it was about $3 debit.
Yep. So it's a 1 week wide call calendar, buying that April 22nd weekly 600 call, selling the April 14th weekly, or monthly actually, 600 strike call. It's trading roughly about $3.20 debit, and that's your risk on it, $320 per spread. Now your break-evens, Kev, you've got this up here. Break-evens are around 586 and about 615 to the upside, so you've got a wide range. So even if the stock does pull back a little bit, maybe goes a little bit higher, you still got a wide range. Kevin, your thoughts on a 1 week wide call calendar that basically expires in a couple weeks?
Yeah, what Nathan's given us here is a call calendar that actually, because of the price of the underlying, is actually a short delta. So remember, if 600 is your strike price and you get to pick whichever strike price you want, it's actually a short delta because it is slightly in the money. But remember, this is a call calendar with a range bound strategy. So the stock could go up, come back down, but net, if it doesn't move significantly over the next week or so, this spread, because of theta, can be profitable as long as implied volatility doesn't crash down, which is I wouldn't say it can't happen, but it's a low probability of happening, guys.
Yeah, and after that sales announcement, that implied volatility commentary that you just made, it's in the lower 1/4 of what we've seen over the last 52 weeks, which you'd most likely expect just due to the fact that the stock has risen to all-time highs in this session. But good look at an example trade that's relatively neutral, but still giving yourself a nice wide range on that particular option strategy. All right, Nathan, have a great day. Thanks for joining us.
You guys too. Thank you.
All right, that's Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. But coming up after the break, Kevin and I will be joined by Landon Swan from Likefolio for discussion on Roku, which is down nearly 50% just this year. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks, but let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, the co-founder of Likefolio. Thanks for joining us today, Landon.
Hey guys, good to be here. Thank you.
All right, so we're talking Roku. This stock's been taken to the woodshed, to say the least here, Landon. And I know you're probably not streaming anything. You're down in Florida. You're enjoying the weather. You're outside, hopefully. But, you know, this is the aggregator of all these apps that I subscribe to, right? You would think that it would be doing well, but this thing's pulled back over 75% from its all-time highs that we saw last year. Probably overbought at that point, but what kind of data are you seeing moving forward for Roku?
Yeah, so what's interesting is we're right back at pre-pandemic prices for the stock, right? So it's about 113 bucks in February of 2020, and that's where we're at now. A wild run in between up to just under 500 and back down again. And, you know, that was a case of the right place at the right time for this company, where people were not allowed to go outside pretty much, and you had to stay home. Of course, you're going to stream more TV. And so people were buying Roku devices, buying Roku smart TVs, using their channel. But now things are starting to sort of return back to normal, and unfortunately, the stock has as well, at least unfortunately for those holders. So when we look at how they did last quarter, the revenue was very strong, up 33% year over year. The active accounts were up 17% year over year, up to 60 million. The number of hours that were streamed were up as well, 15%. By the way, I did a little math there. The average hours per day per account is 3.5. So a lot of streaming going on, and you got to remember that's per account. That's not per person. I have 5 people in my family, so across all 5 of us, that kind of makes sense. We're looking at though the current quarter, and it looks strong, up 47% year over year, almost all-time highs on purchase intent. So the company is doing well, but I think the stock just may have gotten a little ahead of itself. Even though they were successful, they've got, when you get those kind of levels, extreme growth is already priced in. And if you have anything but that, you're going to disappoint investors and they're going to hit that sell button. And I think that's what happened. Now, when we look at the company overall, how well they're doing with our data, it looks pretty strong. Again, happiness is strong, purchase intent is strong, but there is a little concern that Apple TV is starting to take a little bit of a chunk out of Roku's dominance. So right now, actually, Roku is about 1 in 3. It's the operating system of about 1 in 3 smart TVs. Apple TV is making gains there. They've got a higher level of happiness. They're doing better on a quarter-over-quarter purchase intent level. And so it's a little bit concerning. And I think one thing that's interesting is the fact that it's decoupled, right? So Roku is in smart TVs. You can still buy the device, but I think for the most part, people experience Roku because they buy a TV that has that in there. So they're impacted by a lot of the smart TV shortages and a lot of just issues around that. And you can kind of see how the smart TV usage has really trailed off. It bumped up in the pandemic. It trailed off. We're starting to make a little bit of a comeback. But for the most part, Roku is in the TV, whereas the Apple TV is also that external device. So they may be facing different challenges there from those two companies. The other thing that I would say that's interesting is that streaming overall is down when you look at a year-over-year basis. Of course, you're comparing to when people couldn't really get out there as much. It's down 14%. You can see here. And if you look at the other topics that we're covering, just kind of polling social media here, subscription fatigue is up. People going out and going to the movies is up. That smart TV usage is barely moving. People talking about cutting the cord, which means getting rid of cable and getting a smart TV or getting a Roku type streamer, is down. So there's a lot of things that are moving in the wrong direction. Now, this is year over year. So again, the comps are ridiculous. It's hard to compare to a year ago. We're starting to tick back up, but this is why Roku's been struggling a little bit as of late.
Yeah, Landon, this is a story of a stock market that has sold off and decelerating growth in Roku and higher interest rates. They, coming out of the pandemic, it went from a perfect storm positive to a perfect storm negative for this company. But the question is, because your numbers say it, the numbers that I have here say it, this company's still growing. And streaming is still at an embryo stage of its life cycle. So there's still nothing but opportunity. Is this story in Roku from $490 to below $100 before it firmed up here? Is this just simply a story of valuations and this new economy and the numbers that they took out of the entire market? Because your growth seems to be, a little bit of threat of competition here, but the growth numbers for Roku still really positive, Landon.
Absolutely. I think this is, they're clearly the leader in the space. They're a leader in innovation. They went from nothing to beating out Apple and Google and Amazon. That's incredible. Those are 3 monster companies, and they beat them at their niche category, right? So I love that Roku did that. And I would continue to argue that this stock is on sale right now. I think $490 was obviously a bit of a stretch, but I think that 100 or 115 or whatever we're at right now is also a bit of a stretch. And this is a company that is the leader in the space. They're getting a little bit of a threat from Apple, and of all the companies you'd want to be threatened by, that's probably top 3 that you don't want to be threatened by. So it's a little concerning that Apple's making some moves. to take away market share, but they still they're ingrained in a lot of the TV, just I guess, just how people think and how people operate. It's just second nature to click on the Roku button now, and they're getting in there. So I like them long term. Short term, obviously we need to find a bottom. The stock chart that you guys are showing there, maybe we're getting to a bottom. Anytime, if I saw a 90-something print, I would be buying shares for sure. Here, I'm a little bit inclined to, because I do think long-term they're going to make it. They're going to continue their dominance, but I think they just got a little outstretched on the valuation for a while.
Yeah, and I think that's part of it, because if you look at their growth rate, it still remains pretty solid, Landon. They're adding in digital advertising, which is starting to really pick up because they have this huge subscriber base. And as more people cut the cord, I know that some of your data showed that less people are cutting the cord, which may or may not affect Roku. But if you look at that, just the base that they have, even if Apple TV Plus is moving in a little bit and taking a little bit of market share away from them, don't they have other levers that your data shows that, hey, you know what, maybe overbought at $490, maybe oversold in the 90s, but at the same time, that's what you want. You want to invest to actually get a subscriber base so you can get that digital advertising and other revenue streams to start to ramp up.
I think that's a great point. And, about that cutting the cord, it's down 6%. But, if we had a chart on people talking about getting rid of streaming and signing back up for cable, I don't know that we'd have the sample size to put that together. I mean, hardly anyone's doing that. So maybe the rate of change from moving from cable to streaming is slowing down, but that's the direction that it's going. But you make a great point when it comes to the other revenue sources. So the Roku channel is at all-time highs as far as users. It's up 47% year over year on the last quarterly report, and they're getting advertising dollars from that. So it's not just the devices. That's not just the way they make money. They make money through advertising as well, and their revenue per user is up to $41. So they're doing a good job of monetizing those users. And the Roku channel, I think, is one of the ways that they're demonstrating the ability to not only do the technology side, but also dip their toe into the content side. One final note, while the streaming is going down, mobile streaming is booming. It is up significantly, 46% on a year-over-year basis. So it is doing really well, whereas just overall streaming is down a little bit, but people are picking up their phones and watching shows on their phones way more than before. So just the fact that Roku is innovating and the way that their whole business has evolved over the years tells me that they're going to take advantage of that as well.
Yep, and I will not be cutting the cord anytime soon, Landon. I have all the streaming services, but I've also have the cord, and I'm not cutting it. And that's how I watch it on my mobile device. All right, great data as always, Landon. Appreciate it. Have a great day.
Thanks, guys. Take care.
All right, that's Landon Swan, the co-founder of Likefolio.com, breaking down the data for us on Roku. Kevin, and we talked about in the last segment that Costco overbought on an RSI technical level. I mean, Roku just bounced off of oversold levels as far as the RSI or technical levels go. What's your take here? And he was pretty positive because this stock has been reset. Maybe gives you an opportunity. I don't know if you're bullish on it.
Well, I mean, if at any point during this sell-off you like this company, you gotta love it down here, at $113. So, right. I mean, at least you can look at this and say, my goodness, that this is a big discount from where it was. Now, clearly that was overbought up there, but let's get to a trade, Tom. So I'm looking at this, two trades that I'm looking at here, Tom. One more passive, one more aggressive. Now, I see this 134 level in terms of the 50-day moving average. So the first trade I'm looking at is something a little more passive, which is just simply a 135 calendar spread going out to May 6th, and then next weekend, April 14th, the calendar spread. And so that's about $4 because I want to give myself time for this stock to recover. But if it does start to move up towards that 50-day moving average, that would be around that 134 level. This trade would do pretty well. Obviously, this is a bullish trade in terms of a delta. So and you don't have a lot of theta. It's actually got slightly negative theta. Why is that? Well, because that move is a little outsized from where we have our options. So if it moves up at all, that theta will kick in. But where it sits right now, because that premium in that April 14th option is not very big. It's only about $0.50. You actually got a little bit of negative theta. Now, Tom, the more aggressive trade. If you think that this stock could explode to the upside, here's the 105. Now, I went out till April 29th. So the end of the month here, what's that, about 22 days. And I did the 105, 125, 1/2 back ratio, Tom. Now, that's trading about $4.70. So the break even on the downside, Tom, is only about $110. Or it's just slightly, it's about 109.72 is what the break even would be on the downside. So any down move of significance and this trade would break even. But on the upside, Tom, if you look at the break evens here, and I'll set the slices to break even, you can see over 140. So if you get any big news out that's positive on this stock, you could have an extra call unit on the upside here where the profit is, we love to say this word, infinite, Tom.
Right, so let's break down the call calendar first. About 29 days till expiration. Yep. Buying the May 6th weekly 135 strike call. Selling the April 14th, which expires next Thursday. Selling the 135 strike call in that option series. You're paying roughly about a $4.27 debit for that, Kevin. And you're going to capture that earnings event, which is about May 5th, I believe, on that particular trade. Your break-evens on it, about 115 on the downside and about 160 on the upside for that particular position. So you've got a nice wide range. What you pay is your risk on it, so it's currently trading at or near about $4.10, so $410 per spread on just the calendar. So you want it to kind of hover around that 135, but you do have a nice wide range for that to trade in. But because you're buying that option series that has the earnings event, we should see, or we most likely will see, or historically we have seen, that implied volatility usually remains stable or goes higher into that earnings event. So that's a good look at that one as an example. And then the second one is a back ratio where you're selling one of the April 29th weeklies, the 105 strike call, and then buying two of the 125 strike call, collecting a credit of $4.75, which is the most you can make below that break even of about 109.70 to the downside, Kevin. You get to keep that credit, but where you don't want it to be is between that 110 and about 140, because you have that extra unit above 140, which gives you profitability to the upside at expiration. But you're collecting a credit on that particular trade. The downside of that particular position, Kevin, is right at that short one, or the long 125 strike, where you have the extra unit there, and that's going to be about $1,500 in risk per spread on that particular one. So you're playing for an outsized move, but you're giving yourself plenty of duration on that one, about 22 days or just over 3 weeks in that particular example trade. So good look at two different ways to potentially trade Roku based on Likefolio's data. All right, Kev, coming up after the break, we're going to take a look at Dick's Sporting Goods, which should be in focus with the start of baseball season today, and the Masters. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network futures market update. Stocks and stock index futures products are lower into the midday trade in continuation of the selling we've seen off the highs from earlier this week. Monday, the NASDAQ topped out at 15,268. Today, down to 14,337. The Russell's back below 2,000, leading the move lower, down over 1.5%. Fed minutes yesterday showed a 50 basis point hike at the March meeting was a consideration, and that the Fed plans to cut the balance sheet by more than $1 trillion this year. U.S. Treasury Secretary Janet Yellen yesterday warning U.S. lawmakers. She said Russia's attack on Ukraine will have enormous economic repercussions, all weighing on sentiment. The S&Ps are down over 0.5%. Crude oil to 93.81, selling off this week after a build in inventories. The U.S. dollar to multi-year highs, and the IEA, the International Energy Agency, announcing plans to release 60 million barrels from their emergency strategic petroleum reserves, all weighing on the WTI. It's down over 1.5%. Natural gas, on the other hand, spiking this week, back above $6. Just heard from the EIA. They said weekly natural gas inventories fell by more than expected. Analysts were looking for a draw of 26 billion cubic feet. Actual came in down 33 billion cubic feet. Also supporting prices, natural gas this week. Estimates that domestic production has dipped during a time when U.S. exports are increasing. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market with Tom White and Kevin Hinks.
Welcome back to Fast Market. I'm your host, Tom White, along with my co-host, Kevin Hinks. Kevin, the Masters started today. Major League Baseball starts today. The hockey and NBA playoffs are coming up soon. And we've got a stock, Dick's Sporting Goods, that's right in the mix of all these sports. But the shares are down about 37% from those all-time highs that we saw last year. And this is one of those names, Kevin, that it makes me wonder how a stock with a PE of about 7 has short interest built up over 20% in this particular name. And people, for some reason, hate it at this point. But at the same time, traffic's starting to pick up. Interest in these sports is starting to expand. You're getting their youth leagues that they support is growing astronomically. But you know, it doesn't show any love for Dick's Sporting Goods, and we're right in the mix of a lot of team sports and individual sports that are coming online right now.
Remember when Sports Authority went bankrupt, Tom, a few years ago? It really threw this sector into kind of a tailspin, and there's been a little bit of lack of trust in this sector ever since then. But you're right. They've got a trailing PE in the single digits in terms of earnings. And this is a company that's putting up big numbers and growing. The only blemish that you could look forward in the future is something similar to Foot Locker, where what's Nike's commitment to these retailers going to be over the long period of time? But this company, you know, they're a multi-brand retailer. So Nike is a significant part, but not the only part of this business. So yeah, you're right, Tom. I look at a stock with a 2% dividend yield and a under a 7 PE. That is incredible for a company of this quality. But like I said, I think there's a lack of trust out there from the Sports Authority. Still a little bit of a hangover there.
Yeah,
Tom.
I think it's a hangover for retail right now, given the demand destruction that maybe inflation's causing. But if you look at some of the numbers, Kevin, 55% increase in revenue over the last 5 years. Gross margins have also increased in this name. So I wanted to look at this from a perspective that, if you think that maybe this pullback, and it seems like there's some support around $95, $96 a share based on what we're seeing on the technicals for this. I looked at a strategy where I'm going to go out to the May expiration. So this is actually going to avoid earnings. Earnings are at the end of May after expiration. So this is the monthly cycle, 43 days till expiration. A little aggressive here, but this is a way for investors, if they don't want to buy the shares, maybe you want to give yourself a little cushion to maybe a neutral to bullish strategy, where I looked at selling the May 95 strike put and collecting a $5 credit on that cash secured put here, Kev. That takes your break even down to $90, where you'd have to buy them at expiration if Dick's Sporting Goods below 95 at expiration underneath that strike. Your take here on a cash secured put as a neutral to bullish type stance as an example.
Remember what you're doing here, Tom, because you're selling this 95 strike put, and it is a little bit aggressive, but remember, if you were to take delivery of this stock, your entry point would be 90, not 95, because you're selling it for a $5 credit. So there's added advantages, and if it doesn't get down to 95, you're collecting theta each day, Tom. So this is a little bit different. It's got the same profit graph as a covered call, but you don't get the dividend, so it's a little different, but still a very effective way to trade an underlying that you're in favor of anyway, Tom.
Yeah, and that 90 level as far as probabilities of finishing out of the money, and you mentioned if it's below 95 at expiration, you're obligated to buy the shares if you're still short that put at expiration at $90, right? That's your break-even point. That's a 65% probability that it's going to be above 90 at expiration in 43 days for this particular trade. Now, your max gain on this, Kevin's $500 per put that you sell. Your risk is going to be $9,000 because if the stock goes to zero, you're going to lose everything on that. You're going to have to buy those shares, right? It's going to go down to zero. So to your point, it's almost like being long the shares below that at expiration if you're obligated to buy the shares at the $90 break-even point. But great look at a cash secured put if you think you have a bullish stance or it's going to remain here above that 95 strike into expiration over the next 43 days. All right, Kev, that's going to do it for us here on Fast Market. But stick around right here on the TD Ameritrade Network as Next Gen Investing's coming up with Alex Coffey and Jenny Horn hosting.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CNE Group, where risk meets opportunity.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Hello and welcome to Next Gen Investing. Happy Thursday, everybody. Good afternoon. I'm Alex Coffey alongside Jenny Horn. Jenny, a little bit more red here on the board. I think it's safe to say now that you did bring back some weakness to the markets here with your return from vacation.
I know, ever since I've gotten home, we have seen now 4 straight days or 3 straight days of consecutive selling, which I might blame the FOMC minutes a little bit and a more hawkish Fed, but the timing has not been ideal. But as always, we have a ton of micro and individual stock movers to get through. So we will go through our upvote and downvote segment. Following that, we will chart and trade our upvotes. Then we will discuss our FOMO stock of the day today. That is an HP after Warren Buffett's Berkshire Hathaway took an 11% stake, and we'll dive more into why that matters to HP, or perhaps doesn't, coming up later. Then we will discuss tax refunds, a very topical, timely discussion, as I sat down with Carrie Schwab Pomerantz to dive into more on that. And last but not least, we will look at SoFi selling after it cut its revenue guidance and some of the analyst expectations there, Alex.
Yeah, tons going on today, a lot under the surface, so I'm excited for the show. Let's kick things off here with upvote, downvote. As always, we'll take our list of movers. We're going to narrow it down, but not endorsements or recommendations.
So our first name is American Airlines, and ever since news broke of this potential JetBlue Spirit acquisition, I feel like airlines have been a lot in focus, but some different news on American today as Barclays lowered its price target to $15 a share from $18 with an underweight rating. The analysts said they lowered their airline estimates even greater due to fuel and labor expenses rising. Checks out. That's sort of the theme we've seen across the macroeconomic landscape right now. But they did note that capacity reductions and associated unit revenue expansion should partially offset those headwinds. Now, they said that pandemic, war, and energy prices aside, the analysts said that airline travel demand appears to finally be on the path to meaningful and sustainable recovery. Now, Alex, I have to say that it doesn't seem like you can just sort of say all of these major headwinds aside, things should be good. I mean, I think arguably anyone who's been to an airport lately can see things do start to feel more normal, at least from a crowd and busyness standpoint. But I liked this sort of asterisk of pandemic, war, and energy prices aside, because to me, those 3 things are still a major concern for airlines.
Yeah, I think that's almost understated if you can. But, you know, I'm a Southwest flyer in terms of rapid rewards and flexibility. And I've always enjoyed picking my own seat. But I'm going to say upvote today so we can talk a little bit more about the airline space as a whole. And American Airlines, of course, is sort of a favorite around the Chicagoland area as well.
I've grown up flying American. Now I just fly whatever is cheapest. I was saying I love Spirit because it's that low cost, but Americans can sometimes be cost friendly. It just depends if you find a good time. I flew home at like 1 in the morning on American. That's how you could afford American. But our next name today is Constellation Brands, sort of the bright spot in a lot of selling after reporting that sales climbed 8% to $2.1 billion in the fourth quarter, which beat forecasts on profit that also beat analyst expectations. Now, for the fiscal year of 2023, EPS estimates disappointed, but this was offset by strong beer sales and an accelerated $500 million stock buyback agreement. Management also said they will be investing aggressively into their brands in the next year. And now they were pacing for one of their largest percentage increases since November of 2020. Their rise today has since steadied a little bit, but we are still seeing a sizable move up to the upside following those fourth quarter results this morning, Alex.
Yep, post-earnings look here at Constellation Brands, like Corona amongst their products for sure. But I'm going to say downvote today just because we're about to embark upon a new earnings season. This is, again, one of those kind of stragglers towards the end. We got the results, now we got the move. So we'll see where things settle. But, of course, for those who are already involved or looking to get involved after, nothing holding you back.
I thought it was the funniest thing that their Corona beer was like nearly completely sold out when we first heard of coronavirus, which you'd think it'd almost be like the black sheep of beer, and it ended up being even more popular, which was kind of funny to me to see. But now our next name is Rite Aid. Now they're pacing for their worst 3-day stretch since March of 2020 after Deutsche Bank downgraded Rite Aid in what I could say is a pretty brutal report. They downgraded them to sell from hold, while also trimming their price target to just $1 a share from $16. Now, the analyst believes COVID has hastened the decline of the retail pharmacy business and sees potential for a dramatic negative inflection point for the shares. They said their preliminary fiscal 2023 outlook seems unattainable, and they said if EBITDA comes in below $400 million in the next quarter, Rite Aid arguably has no value as a company and is no longer in a position to really generate real returns to its shareholders. So to say that there's a possibility this company can no longer fully operate is a huge concern. We are seeing shares down over 23%, and shares have fallen 56% this year, a pretty brutal year-to-date chart, Alex.
Yeah, and pretty wickedly negative note from this particular analyst. I'm going to leave it kind of just sit into the world as is. I'm going to pass on this one, but certainly if you buy into the words of this analyst and the thoughts here, possibly potential opportunities. And of course, if you don't, maybe there's also opportunities the other direction. So again, I'm just going to let this one go. I'm going to say downvote.
Yeah, it almost was like a short seller report, the brutalness of the nature of just the description of Rite Aid. So an interesting report, but a downvote for today. Our next name today now is Roblox. After Citigroup started coverage on Roblox with a buy rating, saying that it is now safe to enter the metaverse. It's funny that now, April 7th, 2022, they say today is the day to enter the metaverse. No, not specifically, but they did say that Roblox is trading at an attractive price after a rough start to the year. Shares have fallen 58% year to date, but they said they've seen a sharp reduction in street estimates following its fourth quarter results, which now puts its consensus estimates at more reasonable levels. Citi said that while the firm's valuation is above many of its peers on Roblox, they do believe it's justified given the strategic position, the rapid growth, and the healthy pipeline of its product enhancements. It's also showing signs of growth outside of the U.S., but I do have to say, we need to see shares start to stabilize here, Alex, because after seeing the stock fall almost 60% this year, down 7% this week, 66% off of its peak, I think that the shareholders here are looking for maybe some recovery.
Yeah, no doubt about that. It has recovered a little bit off of its lows, but it's kind of a drop in the bucket compared to where it's been. Super interesting company. I don't think I'm the demographic that it shoots to target, but at the same time, you can see where this company could have a role in this innovation that's going to be tied to the metaverse. So I'm not sure I'm all in on the metaverse at all, but we'll see where things go. I think Roblox is super interesting, and I'm excited to talk about it a little bit more. I'm going to say upvote.
I do think this name is really interesting, and I agree that I'm not fully sold on the metaverse, but hey, according to Citi, now's the time to get into the metaverse. So I like to explore this one more. But to move forward with both of our upvotes today, those being American Airlines as well as Roblox, we're joined now by Ben Lichtenstein, the host of Futures. Ben, we will start things off with American. I've been really touting travel's recovery for quite some time, saying, how could you be rooting against this? Don't you want the world to return to normal? But American's chart, I'd say, looks a little bit less positive as of late, down about 10% this week and down about 9% so far this year.
Yeah, I'd have to agree with you, Jenny. It's been losing altitude, I guess is the best way of putting it, after really taking off last month. We saw a nice move up throughout the month of March from, I think it was $12.44 up to $18, almost $19. But again, it has been coming off with the broader market. You can understand why. You've got rates on the rise, and I think it's just more a reflection of sentiment, which has really kind of been waning recently.
What are your opening thoughts here on Roblox? It looks maybe a little bit like the American Airlines chart, but I would say a lot more volatile and a lot of that weakness as of late.
This is a stock that's been in a bit of a range recently, but I'm really looking forward to looking at the technicals on this one, because while we've been in a bit of a range recently, which Alex provides us with a really well-defined upper and lower extreme to keep an eye on in terms of gauging that next real feel for directional conviction one way or the other, or lack thereof, as we just continue to trade sideways. But ultimately, it's been trending lower on the bigger picture daily time frame in a really well-defined trend to the downside. So again, I'm excited about looking at some of these areas of consolidation, and kind of similarly to what we were doing yesterday, talking about some of the two phases of development, basically, and trying to simplify your viewers in their attempts to kind of understand and view price activity and identify trend more readily sooner, and then be able to identify when trend's no longer present as well.
Yeah, Ben, a really good point. And interesting that both of these names, Roblox down almost 6% now, American down about 5%. So they're both seeing actually similar intraday price action. So I'm excited to dive more into the technical forecast or look at both of these names, both American and as well as Roblox. Ben will be sticking around. Alex and myself will also be right back with Next Gen Investing.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo Webcast Series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. We're joined as well by the host of Futures, Ben Lichtenstein. We're going to walk through our upvotes. Of course, that was American Airlines and Roblox, Jenny. But before we do, just want to take a quick peek at the markets. You're seeing very divergent kind of sector performance. So obviously red on the board today, although we are seeing this intraday rally being staged by the markets here in real time. S&P is well off the lows by about 20 or so points. But I'm looking at the S&P 500 heat map here on the platform. A lot of kind of the stalwarts of the market, your Alphabets, your Amazons, your Apples, they're all underperforming today. And the areas that are doing better, healthcare and consumer staples, if I'm looking at the platform here, interestingly enough, a little bit more defensive traditionally, at least that's how it's perceived. So you're definitely seeing kind of a positioning amongst kind of market participants right now that is certainly a little bit more defensive than we've seen the last couple weeks.
I mean, no kidding. And I think a lot of investors looked at what happened in March, saw that rally, and a lot of these tech names, they actually recovered a good portion of their year-to-date losses prior to really the start of April. I think a lot of investors were looking at those gains month to date in March saying, how is this warranted? How does this necessarily make sense? And I think that that is now being reflected as we're starting to see things settle down, because March's rally, I don't think it was necessarily the most bullish signal, or maybe just the sort of the tipping point for things to necessarily weaken. Now, this is just speculative, as this is what a lot of what I've read, but some of the strength in March in these tech names, I think actually concerned investors more than it pleased them.
Yeah, time will tell. Certainly, market making a comeback here in real time. So I don't know if a headline broke or something, but we're only down about 5 points now after being down closer to 30 on the day. But let's take a look at the upvotes. We got American Airlines and Roblox here on our list.
Yes, we will start things off with American Airlines, a company that also saw some strength in March, but has since, I would say, slipped a little bit amid the broader market weakness, down about 10% this week so far. We also got news today that Barclays lowered its price target on American Airlines to $15 a share from $18. Also, American has been caught up a little bit in the volatility of the potential buyout of JetBlue buying Spirit Airlines, as American is one of the dominant U.S. carriers. But Ben, from a technical standpoint, we've heard a lot about these key spring-summer months for quite some time, that they're going to be record-breaking, that things will be back to normal, and then enter, of course, geopolitical headwinds, heightened fuel costs. What does this look like for American going forward from a technical standpoint?
Well, you pretty well spelled it out in terms of some of the fundamentals here. A very complicated discussion to be had if you're trying to sift through some of those points and the headlines recently, which is why I like to look at the technicals. And I don't think you necessarily want to discount the fundamentals, but the technicals kind of help us provide a little bit of clarity. And in attempts to do so, I drew a few areas that I think you should be directing your eyes to if you're taking a look at American Airlines. It's been coming off recently from this 1850 level back down to 1637. And Alex mentioned the market's trying to rally back here right now, so we're seeing a bit of a pullback. But you can also see how we just recently broke out of this consolidation area. I like to think of it as an area of value where the market pauses and kind of regains composure. And here you can see again the two separate phases of development, probably most well defined between 3 and 4, where you get that horizontal sideways consolidation and vertical to the downside, and then again a little bit of a slowing in terms of the momentum and just sideways, more horizontal type price activity. But look at this move off the 1857 level, and I just want to point out how it's a smaller part of the bigger picture move that we've seen. So notice here, while we were seeing value areas, now we're looking at an hourly time frame which had been moving higher, 1, 2, 3, 4 to the upside. We kind of topped out around this 1850 level, and since then we're starting to kind of move our way lower here. So I drew 5 and 6 again. As you can see, we're starting to form value at a lower and lower level, which brings a bit of concern into play, and basically just losing some of that working assumption that this market's trending higher, and the expectations that a new area of value, number 5, would form at a higher level, because here you can see again it formed at a lower level. That being the case, look at how we are right back down to the 50-day moving average after multiple tests to get up above, which have failed in terms of seeing any real follow through up and through. The 200-day moving average continues to be a hurdle which we have yet to really get up above basically since that most recent test back in November of last year. And then lastly, I wanted to point out the Russell has been rolling, or I'm sorry, the RSI has been rolling over. So relative strength indicator starting to weaken a little bit, kind of a reflection of what we just looked at in terms of the hourly time frame and those value areas which are moving lower. So you can see how we're losing some of the momentum to the upside at the very least, potentially something bigger to be concerned about here.
Yeah, losing momentum on the upside is exactly what I also saw, Ben. I also just think the whole energy conversation is not helping here, adding fuel to the fire, no pun intended. But Alex, when looking at these airlines or Americans specifically and considering some of that momentum weakness that Ben pointed out, as well as, I mean, I don't know how you can just say, like the analyst said, all things aside that are happening in the world, the airlines look strong, because I actually think that's the more important narrative, is the fact that we do have a war going on in Ukraine. We do have heightened fuel costs. I mean, these are all major, major concerns.
Yeah, and I don't think that the analysts entirely brushed them off, though. They did move their price target lower to 15, I believe, from 18. And so I focused on that $15 mark as where the analyst was targeting for American Airlines. I also would add in that this is a very debt-laden company. And so when you think about that, Jenny, interest rates are on the rise, and I know that they obviously have that as outstanding debt, but it can put pressure on a company that has just such a large outstanding debt. And so I looked at it. This is a slower moving name. Typically, it's a little bit lower volatility, although it certainly has been heightened as of late, over 60% on this particular stock. And so what I looked at was that $15 mark, buying the May-June put calendar. So giving ourselves some duration here, allowing this to ease its way towards 15 if that's going to happen. The key point here is it's a 25-cent debit. So that means there's only $25 being put into this trade. For most investors, I would say that $25 is a small trade, all things considered, but you're also talking about a stock that trades at $16 and some change. So the stock itself is very accessible, depending on the strategy that is selected and, of course, the outlook for the particular name. If we take a look at the platform, what you'll see, of course, is the risk profile that looks a bit like a mountaintop. Peaks out at 15, so you can overshoot to the downside. So this is one that was really focused on that 15 level as both being somewhat of a round number, the target for the analyst, and also slightly lower than where we are now. Because, Jenny, as you mentioned, there's just so much unknown here in this particular space, from energy to tensions geopolitically, of course, to maybe a pullback in spending here domestically as well. Looking at the chart, this dashed line represents 15. Since the pandemic's onset, which is right here, of course, we've really kind of straddled this level. We've spent sometimes below it, we've spent sometimes above it. And if we just kind of find that equilibrium around there, that would be best case scenario for this trade.
And as we know, the airlines have accrued a ton of debt over the last 2 years with the ongoing pandemic and some of these spiked costs. So another thing to consider. And I'm still very team for travel recovery, but a lot of these issues are just sort of glaring you in the face when you look at American or just the other major airlines. But now to switch our next name, totally different conversation here, Ben, is Roblox. Now this is more of a newcomer. Roblox, I'd say, is more of a trendy stock, but nonetheless, falling almost 60% year to date. It has seen a ton of weakness, but hey, according to Citi, now is the time to enter the metaverse, and Roblox is a beneficiary.
Well, let's talk a little bit about what we've been seeing in terms of price, because it doesn't look like investors feel the same way, or at least as of this point. We were just talking a minute ago about the move that we've seen in terms of American Airline, which has been or had been trending higher, but is starting to lose some of that momentum to the upside. So let's just kind of focus on the balance area again here in terms of Roblox. I have this one numbered as number 5. You can see basically from, we'll call it 53 down to 35. And, you know, as a trader, a futures trader, I would get chopped up for so long. I would just kind of, you know, my head would be spinning at the end of the day. I'd be buying and selling, and you can see, well, in this instance, a lot of chop type trades. So I like to kind of simplify things. As a trader, I think we overcomplicate. That's the tendency. So in order to do so, well, I just kind of zoom out and look at this as a wider range here. Again, you can see as I've labeled it as number 5. Now, take a look, because this balance area that I've labeled as number 5, again, 53, we'll call it to 35, is really just one of the balance areas in terms of this migration of value to the downside. Again, it's almost like a staircase type pattern. I like to think of these as footprints in the sand in terms of the path that the market is taking, and in this instant, it has been to the downside. Now, a couple key things to focus on here. Again, this is just one area of balance that's formed in this trend environment to the downside, but you can see how we've run into some resistance up around the $51 level. Now, what's key is it's not just the upper extreme and the lower extreme that's important. The middle is important as well, because if you fail at the upper, as you work your way through the middle, well, you oftentimes tend to test the lower extreme as well. The bulls are looking for a lower extreme test here to hold, eventually a breakout to the upside and start to reverse some of this staircase type pattern to the downside we've seen. But the bears are looking for a breakout below this 35 level to form a new area consolidation at a lower level. I just wanted to take another step back from this hourly and point out how the daily, well, Roblox has really been struggling below the 50-day moving average basically since the beginning of the year, below the 200-day moving average. Well, it's really yet to be above it. Again, the newness of this stock. But look at RSI. Again, another indication where that relative strength indicator is rolling over and suggesting that we could see some continued weakness favoring that kind of setup where I was talking about, where we just failed at the upper extreme. Working our way through the middle with energy and conviction opens up a door for the retest of the lower extreme. A stock that's been struggling to get anything going off the ground here and continues to. Again, at this point, no rejection of these lower levels, basically.
Yeah, Ben, I mean, sitting about $100 off of its 52-week highs, you can see that clear stair-separate pattern like you pointed out as it's just really fallen. I mean, 66% off of those all-time highs. This is a name that's just been consistently moving downward. We've just been watching it just chip away lower and lower. But Ben, as always, thank you so much for your technical insights. That is Ben Lichtenstein, the host of Futures. And Alex, when we're trading this name, say we wanted to take, I'd say, maybe more an optimistic or contrarian stance, because you could say, hey, shares have fallen sizably. I mean, it once traded as high as $141 a share, now trading at roughly 43, and you could say, hey, perhaps I'm taking the stance that we've hit a bottom here.
Yeah, the analyst at Citi, Jason Bazinet, said it might be time, talks about initiating this at a buy. Price target was 59, so I kind of keyed in on those levels. Of course, Ben gave us a bit of a breakdown as well. But centering our strikes with that in mind, what I looked at, it was going out to the May expiration, buying a call vertical, the 40-60. So it's $20 wide, Jenny. The reason I chose the 60 strike is, well, one, there was still some premium left in these options. Over $1 at the time I was looking at, so we can sell that against the 40 strike, which we're buying. That was the first strike in the money. But this allows us to kind of hit that 59 price target if it were to rally and hit that level that the analysts at Citi thought, but also allow us to chip away at our debit spent. And so this was about $6 at the time I was looking at it. So if we got it at a $6 debit, that would make our break even 46. And of course, our max loss potential would be 600 plus the transaction fees associated. If you look at the risk profile here, it's an elongated Z. We see these all the time. But what you will notice is the stock is currently trading below 46. So a couple things of note here, Jenny. One, by expiration, we would need a slight rally in the stock, because it would have to be above 46 for break even. But given that we need something to happen and that we're only paying $6 for a $20 wide spread, we actually could watch this if it does get above 60 and stay there through expiration. We could watch this expand to $20, net of our 6. We could make $1,400 on our 600 in risk. So although a lower probability trade is we need something to happen, it does have greater return potentials if that stock does trade above 60. And so if we take a look at the platform, one thing I wanted to highlight, if we can get it up, is the year-to-date performance of the stock itself. This yellow dashed line represents the break even for the trade illustration, which is essentially this area of consolidation that Ben was talking about, the lower bound of that. But then this 60 level being where our max profit takes place is this green line. You can see that's sort of the next consolidation level there. So Ben had talked about that throughout the week, is sort of these vertical phases and these sideways phases. And so we're kind of hoping it can go from one to the other with this particular trade illustration.
Hoping for a breakout, like you said, stands to make about $1,400, which is then why you see that max risk be a little bit higher, relatively speaking, to some of the other trades we put on. But, I mean, Roblox is just a name where you can see from that chart fallen sizably from its 52-week highs. So this stands to potentially gain from any sort of recovery in Roblox. But that does it for this segment. Coming up next, we will stick with our tech theme. We will be talking HP Inc. and really diving into this name, seeing one of its best days on record in terms of percentage gains, also hitting 52-week highs.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Time for FOMO. Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, today we're talking HPQ, which is HP Inc., Hewlett Packard, and this is the hardware side of the business. Making some headlines here today, and also breaking out to new all-time highs.
Breaking out to new all-time highs, seeing a sizable move up today, which is always a positive to talk about on a day when we're seeing a lot of weakness. But Berkshire Hathaway disclosed an 11.4% stake in HPQ, buying roughly 11 million shares of common stock on April 4th for a total transaction that sized at roughly $398 million. This boosted stake by about 10% to that grand total of 11.4%. But what this did really is, obviously we follow Warren Buffett. He is a very FOMO-esque type figure, Alex, because a lot of attention and a lot of focus follows really whatever he does, as Bank of America has been one of his favorite holdings, as well as we talked to Occidental Petroleum yesterday, another company that he's increased his holdings in as of late. But what this move today really stirred was the debate between the bulls and the bears on HP Inc. Now, the bulls will see this company as well run, cheap relative to its peers, with aggressive returns over the last few years. It trades at a modest 9 times its expected earnings for October of 2023, its fiscal year, with just 0.7 times its sales. Also pays a pretty consistent dividend. But the bears then are concerned that after an unusual boom in PC demand over the last year, growth will start to wane. And now we have started already to see actually growth wane in that PC market with the more lower end consumers. But I was reading a lot of analysts' notes that say that actually HPQ stands to benefit from a return to office as printers and supplies and actually, more computers are purchased through companies actually. They stand to benefit from that surge. But I do think that we saw PC demand, Alex, really over the last 2 years was something unprecedented, honestly. So it is a very curious debate between the bulls and the bears. I'm not sure who is right, but that is what has sparked a lot of investors today following this Warren Buffett, Berkshire Hathaway move.
Yeah, interesting to see its strong performance and kind of the issues that we've seen and things within the supply chain for things like chips and all of that's gone on there. Of course, something in the computer hardware space doing okay relative to many of its peers. But I looked at this, I don't have a rooting interest one way or another. I can hear both sides, both make a compelling case. But when you're talking about the fear of missing out, given that the headline was Warren Buffett buying, increasing a stake over 10% now of the company, I felt that, given the response that we see in the stock today, that fear of missing out likely for most is probably an upside move continuing. And so I looked at a trade illustration, Jenny, here with that in mind. We've looked at this kind of strategy before. What we're looking to do here is look to replicate the upside potential of a long stock, so uncapped potential upside, while also simultaneously having defined risk, but also looking to limit time decay working against us. Because of course we know, okay, limited risk, max possible unlimited gain, buy a call comes to mind for many as a strategy for that. But typically when you're doing that, you're of course buying time premium, which can work against you if the stock doesn't make a move within your expiration time frame. And so what I've looked to do is create a ratio that seeks to reduce that time risk as much as possible in the sense of that intrinsic versus extrinsic value situation, but also still a risk-defined trade with unlimited possible upside. And how we do this is buying 2 in-the-money calls and selling 1 basically at the money call to create roughly 100 deltas worth of risk here. So at the time that I was looking at this particular name, it was trading for around 40.25. And so to buy it at 40.25 using this particular strategy of buying 2 of the May 37 calls, selling 1 of the 41 calls, this would need to be a debit of $650 for that to be our break even. And so doing that there, we'd have $650 in risk if the stock sold off and traded below 37 through our expiration, or of course we have unlimited possible profits to the upside as we have 1 of those calls does not have an out of the money call sold against it, and therefore it is uncapped in its upside potential. So Jenny, what would be referred to, I guess, as a stock replacement of sorts is you're going to get about 100 shares worth of upside exposure, but you will have defined risk to the downside. So for many, maybe the best of both worlds, but of course it does have a risk of $650, and that does take place below 37, where if you just bought 100 shares at 40.25 and it traded to 37, you'd only be out 3.25. So you have twice as much risk for those first $3 lower, and then it's defined.
And a strategy that you explained sort of stands to capitalize if you believe this stock has room to run up. I just think it's really interesting, Alex, that we oftentimes talk about a lot of these high growth tech names, which I wouldn't necessarily say that HP Inc. is high growth as it is a more established tech company, but definitely a tech company nonetheless, and it's actually up 8% this year. It's sort of bucking the trend we've seen with a lot of these tech-heavy NASDAQ stocks. It's very interesting how it has outperformed so many of its tech peers. Well, I would have never guessed that HP of all the companies, Alex, would be doing so.
Yeah, and I think it's a little bit skewed given that it's up 17% today alone.
Right.
So you really have reduced your losses that it did have coming into today. And then, of course, adding those gains as well as kind of the cherry on top of the cake here. But this was a stock that had been fairly resilient. It, of course, was weaker year to date prior to today's session, but certainly not to the same extent that we've seen of some of these other names. Something like Roblox comes to mind.
Exactly. I mean, to talk about a high growth, a name that ran up very quickly, but is also a newer company to the market as HP Inc. is a little bit more established. But now, coming up next, we will totally shift gears. We'll be talking all things taxes. And it is, I would say, officially tax season. Yeah, it's definitely tax season. I was joined by Carrie Schwab-Pomerantz to discuss more on all things tax returns and tax refunds.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim Mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Next Gen Investing. I'm Jenny Horn, and I'd like to welcome back Carrie Schwab Pomerantz, the Managing Director at Charles Schwab and the President of the Charles Schwab Foundation. Thank you so much for joining us today, Carrie.
Thanks for having me, Jenny. Always love being on your show.
So this is a very important time right now because we are in the midst of tax season. So today we are going to focus on what investors need to know. So let's start with, I think, the question everyone is wondering, and that's how people can get the biggest tax refund.
Oh boy, doesn't that sound exciting to get that big check in the mail? But unfortunately, you should not be focusing on getting a tax refund because all that means is that you gave Uncle Sam an interest-free loan. In other words, you paid too much in taxes. Now, conversely, though, you don't want to withhold too many taxes during the year because otherwise, in April, you'll owe a big tax bill. So it's a fine balance of how much exactly you pay during the year.
So you mentioned previously withholdings. Can you explain a little bit how they work?
Yeah. So withholding means that you're withholding paying taxes from the IRS. And the way they typically work is, say you get a salary and a paycheck, your employer takes out a certain amount every paycheck and sends it to the IRS. So your tax payments are spread out evenly over the year. And you have to find that exact right amount because if, let's just say you withhold too much from the IRS, you could owe penalties and interest on any taxes that were due. And so when you think about the withholdings, you want to think about your total income. That includes salary, bonus, investment income, real estate income, whatever it may be. And you're going to be paying taxes on all of that. So that's how you determine how much you can withhold from the IRS or how much you really need to pay during the year.
And every year I think that we should have been educated more on this back in school because it is such an important conversation that many people just don't know enough about. And that brings me to our next question of how do people know if they should take the standard or the itemized deduction? Again, I feel like we should have had many classes on this maybe in like middle and high school.
Okay, so deductions allow you to reduce your tax bill. And so the difference is the standard deduction is one lump sum that the IRS allows every individual or married couple to use against their taxes. So if you are an individual, you can deduct $12,999 $950. If you are jointly filing, then you can deduct $25,900 from your income or from your income. So that's a standard deduction. Now, if you have itemized deductions or opportunities to reduce your taxes even further, so for instance, if you have over, say, $26,000 in items such as charitable giving, mortgage interest, property taxes, then you're going to want to itemize your taxes because, again, that'll allow you to reduce them even more.
Yeah, that brings me to another question for you, and that's how people can help lower their total tax bill.
So tax advantage accounts are a great way to do that. Retirement accounts such as 401k or the IRA allow you to deduct taxes at the time of savings, or donor advised funds or a charity donation directly to the organization are another great way. And then there's also a strategy that's used by investors called tax loss harvesting, in which you take losses in order to offset gains that you have during your trading of the year. And also available to people are tax credits, and those are available to people with certain incomes and so forth. So be sure to take advantage of those. And if you want to know more about that, go to schwabmoneywise.com.
And a very timely discussion for this, as many people, I'm sure, are filling out all of the different tax forms, and they're very extensive to say the very least. But Carrie Schwab Pomeranz, Managing Director at Charles Schwab and the President of the Charles Schwab Foundation, thank you, as always, for joining the show.
Thanks for having me, Jenny.
As if I needed a distraction from the Masters this weekend, that's a good reminder to myself. I'm going to check on my tax situation as well, but always a great conversation with Jenny and Carrie. Thanks to both of them. We're going to take a short break. When we get back, it's time for Under 30. We're going to talk SoFi Technology. Stock making a massive move here in response to a guidance update. We'll find out more with Jeff Pierce right after this short break.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. tune in live, or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, equity markets calmed down from some early weakness. Actually ended up being kind of a quiet Thursday afternoon thus far. So maybe the curse of Jenny returning might finally be broken with the S&P's only down 4. But Jenny, we're talking SoFi Technologies. We were kind of just talking during the break that for many, their first encounter with this company might have been watching the Super Bowl and seeing that they're the sponsor of the stadium that the game was played in.
Talk about like ultimate marketing. I saw all these tweets that were like, what in the world is SoFi? And I think that is sort of the first time we saw really this name ripple through the public sphere, at least, as this is a name that has made lots of moves, at least so far this year, as we've seen it fall about 51% year to date. So pretty brutal, down 17.5% this week. And we got some news today. They cut their fiscal year 2022 guidance below estimates, and maintained their first quarter guidance still below the estimates. So we've seen some selling since that news came out. A lot of different analysts covering this name cut their price targets. Some of those include Oppenheimer, Mizuho, Goldman Sachs, B of A, and Wedbush. So leading to that sizable move lower. But to tell us more on SoFi is TD Ameritrade Network contributor Jeff Pierce. Jeff, this is a name that operates with a lot of different student funding. So they attributed their guidance adjustment to President Joe Biden actually extending the federal student loan payment until August 31st. Now, is this a near-term headwind or is this a longer-term concern? Because to me, I say, hey, we're almost in like May at this point. What's another 3-4 months?
Well, that's kind of the interesting takeaway here from the company. To your point, they dropped that guidance to $1.57 billion from $1.47, and that's versus the $1.53 billion estimates that were out there. They said it was in part due to the response of that extended federal student loan payment moratorium until August 31st. They also said that they see the extended pause on the payments. They now expect that there will be no payments required for the year. So they're looking out even further, suggesting that there may be no payments back in the entirety of the year. SoFi reported their fourth quarter earnings. They said that with that outlook, they assume that this moratorium on student loan payments would expire in May, and that they would start to see those refinance originations return to pre-pandemic levels midway through the second quarter. Now with this news and their estimates of no payments for the rest of the year, it doesn't look as much of a rosy outlook. And as we're seeing from analysts, as you pointed out, whether it's near term or not, we're definitely seeing some price reductions, maybe not a lot of changes in the ratings. But right now, that optimism around SoFi and this kind of banking system that they're building up, at least in the near term, is starting to fade.
Jeff, there's 3 words that investors in companies never want to hear, and those 3 words are lifetime low. That's what we got again here today in SoFi. After some initial optimism and excitement around this company when it first became public, it's been kind of a rocky road, and it's been largely in one direction for the last 6 or so months, and that's been straight down. What should investors consider when looking at this company? Of course, you talked about the fundamental picture and some of the analyst takeaways in response to one of their core businesses being disrupted by policy. But that's not all that this company does. Of course, it's a big bulk of it. But, I mean, any company that's sponsoring an NFL football stadium, it's got to have some capital, right?
Right, exactly. To your point, it's not all that they're doing. It's not all that they're building up to. And that's what a lot of investors that are excited about the company have been pointing at. That's why we've seen them move up from time to time over the last year. You've seen some spikes here and there around earnings time. You saw in January they received approval to become a bank holding company. They've had some acquisitions out there, although the acquisitions in some ways have left investors a little bit concerned about the money that they're spending. But this is all to kind of build that ecosystem around banking that they're really hoping for. And if you're an investor out there that believes in this ecosystem, the question is this near-term problem around the student loans, which is not necessarily new. We look back almost a month ago, there was a downgrade from Morgan Stanley. They moved them to $10 from $18. They talked about this student loan moratorium likely, really bleeding over into 2023 and beyond. They reduced their target multiples because of it. So this is not necessarily a new story, but hearing the downgrade, the reduced outlook from the actual company is something that I think has investors a little bit worried. Now, having said that, SoFi has said in the past they expect a negative impact on the federal student loan payment moratorium to be about 30 to 35 million of revenue per quarter. I think investors right now are trying to weigh this prospect of this banking system. Also, what is going on with the Fed, what's going on with interest rates and the economy, and how that's going to affect these fintech companies, because we have not seen some of these fintech companies deal with higher interest rates, but also concerns over the economy starting to pull back.
Jeff, I see that Galileo, which is a pretty huge part of this company's success, has over 100 million accounts as of last quarter. So it is growing, just maybe not at the pace that the street would like. But I actually did see a downgrade yesterday on Toast as well as Affirm, saying that these fintech stocks are in trouble. Now, I know SoFi operates in a different space, but is a fintech player nonetheless. So are a lot of these just newcomer, say trendier fintech names just in hot water right now, given the credit and the lending environment?
Well, that's part of it, right? We have to understand they're spending a lot of money. We've seen in the past a lot of M&A activity across these companies. Competitors like Lending Club, Upstart, those are all down this year as well. Not as far down as SoFi for sure. But also, again, this is a new territory for some of these fintech companies. You think about lending, higher interest rates, a good thing, right? But will they start to see some of this loan activity dry up? They have all of these new customers, but are we going to start to see that slow down if we see interest rates continue to rise? That's a big question that investors are wondering right now, and whether or not it's the right time to jump into a company that they think is building this ecosystem as we're kind of looking at a totally new territory for a lot of these fintech companies.
Jeff, kind of final thoughts here. I'm going to zoom it out a little bit and get kind of your macro thought here on things. You mentioned interest rates. I've largely, made the statements that I think that's where it's all stemmed from right now. I'm watching U.S. Treasuries, then stocks are going to follow whichever way that may be. What is your assessment of the overall macro picture right now? We got inflation. We got uncertainty geopolitically. We got interest rates on the rise. We got earnings possible slowdowns. What is Jeff Pierce keeping his eye on?
Well, I think what we're seeing from investors, right, is they want to know what is the right sector to be in right now, and they're really trying to make that plan. That's why we've seen, I think, tech bounce up and down, even with interest rates on the coming this way, is because people have believed in tech. They maybe think that there's still some money to be made there. However, the major concern is you see a lot of these growth companies, and you can throw fintech into that category in a lot of ways. The question is whether or not they can withstand these higher interest rates, even if there's a part of their business that would make money off the fact that there's higher interest rates out there. And certainly the inflation concerns are all over the market. We're seeing that across the board. It's something that these companies are having to comment on when we're going into earnings reports, because it's such a big part of the story right now.
Yeah, Jeff, you can't really escape that inflation narrative, and it's pretty much in every single analyst note or on every single earnings call as of right now. But Jeff Pierce, thank you so much for your thoughts as always. And Alex, we have started to see markets slightly recover, kind of a dead cat bounce, if I will say myself. And actually, I'm quoting the guys in the newsroom who told me that, as I cannot say dead cat without my conscience hurting, because I love cats.
Yeah, I think it's too early to say what kind of bounce it is, but it's impressive nonetheless. We're down to 44, 44.5 in the E-mini S&Ps. We're 44.71.5. So that's a big rally off those lows. We'll see if it holds. That does it for us. Thanks as always for tuning in to Next Gen Investing here on this Thursday. The watch list is coming up next. Jenny and myself will see you tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides, live from the New York Stock Exchange. Thanks for being with us. It's 2 p.m. Eastern Time. Well, we always talk about volatility. Here you go after the lows that we saw earlier in the day. In fact, you're seeing a couple of the major averages now in the green. In fact, here it is. The Dow's up 23 points, 34,525. The S&P 500's up 744.87. The Nasdaq's down just 0.1% now at 14,484, and the Russell is down 0.8%. In today's top story, St. Louis Fed President James Bullard warned that the Federal Reserve is behind the curve to get to rising inflation and get that under control. And Bullard was the only official to vote in favor of lifting federal funds rates by 0.5 percentage point at last month's meeting. This comes after the March FOMC minutes did show, and they were released yesterday, showing that many of the officials were in favor of a 50 basis point rate hike, but settled at 25 basis points due to all the uncertainty from the war in Ukraine. Let's take a closer look at the top stories here, and Ben Lichtenstein is with us, host of Futures here on the TD Ameritrade Network. So, you mentioned Bullard earlier in the day. Fed is behind the curve. I think it's so interesting how you saw this market turn around from the show we were on earlier today when we were on Trading 360. I mean, healthcare, consumer staples, we're seeing materials, energy. I mean, to see the markets now in the green after the selling we sort of endured in the last couple of days that felt tough. Now what, Ben?
Yeah, kind of an interesting session to say the least, Nicole. We kind of chopped right around unchanged levels for the better part of the morning, and then the selling into the midday rally back, late day trade that we're seeing here right now. But, I think in terms of the Bullard comments, you mentioned he was the only one who actually voted for the 50 basis point hike. The a hawk that he is, but you also pointed to there were other members that are actually considering it. So I think aside from the Ukraine uncertainties and the unease that created, there probably would have been more. So let's take a look at the charts, though, because this has been the underlying headwind for the indices for the most part since the beginning of the year. We've dealt with some Ukraine geopolitical tensions that sold the market off into those March lows that we saw. Here's the NASDAQ rallying off those lower levels from last month, mid-March lows down around, well, below 13,000. You can see all the way up to that 15,200 level where we kind of double topped, and this is the movement we've seen recently was come back off. Now, I do want to point out that the ES, recently back down below 4,500. We've seen the Russell give way to that 2,000 level. So a couple of these indices have been able to give back some key psychological levels while the Dow remains above 34,000, the NASDAQ above 14,000. That's going to be the next area if the selling continues to keep an eye on. But here you can see how the ES was able to take out the Feb highs in the month of March, but throughout April here, follow-through has been very limited to the upside. Again, recently back down below the 4,500 level, and while we are fractionally higher on the day, well off the lows from earlier, down around 4,450, I think this is what we can expect to see in terms of the intraday volatility and some of the swings that are normally associated with. Take a look at the ES. I just wanted to point out this was a bit of an outlier. We're looking at the dark shaded area here on this chart, and these are the day session trades from this week. So going back Monday, Tuesday. This is yesterday's volatile session. Not a lot of conviction one way or the other, but major swings. We're talking 44, what was it, 44, 44 up to that 4,500 level. But notice here, ES today, the only one of the four majors, Nicole, that was unable to take out yesterday's day session lows around 44, 44. We got down to within a couple points of, but without participation from the ES, the NASDAQ, the Dow, the Russell are rallying back. And again, as mentioned, while still below some key psychological levels, well off the lows from earlier. And I think this is what we can expect to see into next week, for example, CPI, PPI. There's a lot of data due out, earnings. I mean, traders, investors are really gearing up for a continuation of this pattern, I think.
You know, I do think it's interesting because we will be waiting on a lot of news next week on all the earnings and the banks. And of course, everybody's watching any sort of correlation between rate moves and equities overall in different sectors at that. When I look at the 10-year, for example, it's an interesting one as it continues to climb. And there are some who say, don't worry about the inversions for now. Your thoughts?
Well, I think depending on who you ask about the inversion, you're probably going to get a difference of opinion. I think there's a lot that could happen in between now and then that could steer us in that direction or away from that direction. So it's tough to tell. But yes, the recent yield curve inversion has suggested that at some point in the next couple of years, we will see a recession. And, you know, Deutsche Bank yesterday was talking about the end of 2023, potentially this first quarter of 2024, we could see negative growth. So that's ultimately what we'll be looking out for. But an interesting move today in the bonds, the treasuries, the longer dated today actually participated to the downside relative to the shorter end. Now, keep in mind, when you're talking about the yield curve inverting, Nicole, we've been talking about that short end really accelerating beyond the pace that we've seen in terms of the long end. But that kind of reversed a little bit today. Here's a look at the bonds. We've seen off the highs from, well, this goes all the way back to the beginning of March, 156 down to 143.28. We're back up above 148, but you can see we posted a new low today. I want to point out the only one of the four majors. So now we're looking at the bonds, again, collectively relative to the other three. You got the 10-year on the right. Again, the bonds longer dated in the top left corner and the shorter dated on the bottom half of the screen. Now, keep in mind, it had been the shorter dated which had been leading, but look at how the 5 on the left and the 2 on the right have rallied off those lower levels, even though the bonds accelerated that momentum to the downside today. And the 10-year seems kind of stuck in the middle, didn't really know which way to turn. But here you can see, again, just looking at this shorter end, you can see how the 2-year has been leading the well-defined trend environment to the downside. I mean, this has really accelerated throughout the month of March here with that hawkish tone from the Fed. And take a look here. I've got the 30-year all the way up to through 2.7 today. Nicole, this is what we're talking about, the yield curve inverting. And I can't show the 230 here right now, or 210, I guess a lot of people watch, but I like to look at the 530, and you can see that still has been, continues to be, remains entrenched, inverted, and yes, suggesting that we will see recession. So something to watch here. Again, I think the inflation data, I think the retail sales, for example, next week will provide a little bit of insight as well in terms of some of these consumer trends and have they shifted at this point.
Yeah, so much to look at here as I see the 10-year, 2.6 and change. It's so exciting to watch the markets one way or the other. Obviously, people who are long feel good when we have a little bit of a comeback like we have today. Ben Lichtenstein, nice to see you, host of Futures here on the TD Ameritrade Network. Thank you. I'd like to get a look at the bigger picture. Dave Sekera is with us, Chief U.S. Market Strategist at Morningstar. What do you make of this market action?
Well, as long-term investors, we don't try and get too wrapped up in the day-to-day, intraday movements. But I think what it really does is it shows that there's still a number of different headwinds that we had pointed out at the beginning of the year that the market has to contend with. So first, we are looking for slowing of the U.S. economy. Earlier in the year, I think we were looking at the U.S. economy growing around 3.9%. Our estimates are now for 3.5% this year. We are expecting interest rates to continue to rise. I wouldn't be surprised to see us get up towards 3% by the end of this year. And then we're also looking at inflation is still running hot. Now, granted, we do think it will moderate in the second half of the year. That's certainly going to have some impacts here on earnings this quarter and what guidance is going to be for the second quarter as well.
Right, and as we see some of the headwinds that obviously we have some slower growth and you have a lot of high costs and such for companies, you do still see opportunities, right? Tell me a little bit about where opportunities could lie.
Well, right now, the only sector that we actually think is really significantly undervalued is going to be the communications sector. And of course, you can't talk communications without talking about Meta and Alphabet. So two companies that we rate 4 stars and 5 stars respectively. We think Meta is probably trading at about a 40 to 50% discount from our long-term fair value estimate. And taking a look at Alphabet, that one's trading at about 25% of a discount to our fair value. Now, having said that, across the rest of the sector, we see a lot of value in more of the traditional names there as well. So one that I would highlight for investors would be AT&T. So again, we think there's a good catalyst there with the spinoff of Warner Media. We think that's going to help unlock shareholder value. And then we also like Discovery, which Warner Media is merging with. Again, another company that we rate 4 stars, and we think there's going to be lots of good synergies after that merger is completed.
As you look at the market overall, is there something you just talked about communications maybe being a little bit undervalued or a little underperformer with some opportunity is a good way to say it, right? The way you looked at Meta and also Alphabet. How about something like the small caps? I saw a stat going all the way back, and it just shows how huge the underperformance of the small caps at this point really is.
Yeah, when we do break our valuations down by capitalization, both large cap and mid cap are trading a little bit below, but not much below our fair value estimates. We'd put those in the fair value range. But we do think small caps generally as a category is undervalued. And we think it's undervalued across the board, whether you're looking at value, core, or growth. So that would be an area that I would say there's a lot of opportunities for investors. There's some stocks in that area that we think are just really trading at almost just ridiculous lows compared to our fair values. One that I would highlight would be Groupon. I think that's trading at like maybe a 70% discount from our fair value. We see lots of opportunities there for investors. But again, it's going to be for investors that are willing to dig in there and really look at the underlying fundamentals of those companies.
Right, and it's interesting because when you're trying to find value, it's so hard. So it's not just saying one company in particular, or just you have to go through the balance sheet of each one. How much does the Fed moves at this point affect your advice at this moment? I mean, you're basically giving this advice on what plan?
So the Fed moves aren't going to really move the needle all that much for us because, again, as long-term investors, we're doing the full discounted cash flow analysis in order to model a company, looking at how much free cash flow that we expect that company is going to be able to generate over its entire lifetime and coming up with our intrinsic value that way. Now, when I'm looking at the Fed moves, I know a lot of people earlier this year thought growth stocks had sold off in January and early February because we saw the interest rates starting to rise. In our view, we came into the year saying that we thought the growth stocks were actually overvalued. So to us, it was much more of a valuation story, seeing the growth category coming down. Well, now that we're at 265 on the 10-year, as we start getting closer to 3%, that's going to be the area where I think investors are really going to start looking at the discounted cash flow analysis, what their own interest rate assumptions are. And that's where I think that if we get much above 3%, we'll start seeing that growth category, those long duration stocks, really start to experience more headwinds as people are ratcheting up their discount rates.
Right, and you know, I mean, Bank of America says the Fed's going to be hiking all the way into 2023. They're going to continue to do so until things really are, you know, under wraps and not seeing the inflation that we've been seeing. That being said, are we leaving out anything like international investing or any other sort of category, whether it's crypto or anything else for that matter?
You know, we don't follow crypto here ourselves. We really stick to, you know, more of the traditional, you know, stocks and fixed income. So, you know, I wouldn't have a comment on the cryptocurrency specifically.
How about international? I mean, there are some people who like emerging markets or anything else for that matter, or, you know, just looking at what's been going on with technology. I mean, are you leaving out tech for now?
Well, tech is pretty fairly valued. Again, it got caught up with the growth sector, so we saw that, you know, come down from being, I think, about 13 to 14% overvalued at the beginning of the year to being pretty close to fair value, you know, for now. You know, for investors looking more for international exposure, you know, I'd note a lot of the Chinese ADRs that we cover are certainly trading, you know, deep into that value category, you know, anywhere from, you know, 20 to 40% below our fair value estimates. Again, some of the names that I would look at there are going to be ones where, you know, we expect to see, you know, just generally here in the U.S., but globally as well, a shift in consumer spending going back towards the services industry, getting away from the goods. So those companies that are going to be leveraged towards, you know, travel and entertainment, you know, some of those other areas that people have shied away from for the past 2 years, really benefit in the second half of this year. So a couple names there, you know, I would like, you know, would be, you know, maybe in the gaming sector, you know, Caesars would be one that we would highlight. People looking for maybe some Chinese exposure but don't want to buy, you know, Chinese stocks could maybe look at, you know, Wynn or Las Vegas Sands, you know, both that have leverage to, you know, the casinos in China.
Yeah. Dave, it's great to chat with you. Thank you so much for that. I appreciate it. Dave Sequeira, Chief U.S. Market Strategist at Morningstar. Appreciate it. Thanks. Well, later this hour, we're ready to talk with the founder and CIO of MQQ Global, all about the newest fund that they've launched. It's really interesting about India in particular. JP Morgan, a bit more cautious on names like Apple. Michael Keeley is with us to explain. And Constellation Brands beat on the top and bottom line. Our panel is ready to talk all about it and what we need to know about the stock. Now, up next, Charles Schwab's Chief Global Investment Strategist, Jeffrey Kleintop, will join us. I want to hear what he has to say about international markets next.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim Trading from TD Ameritrade.
Welcome back to the watch list. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Want to take a look at some of the biggest movers right now. Looking at Constellation Brands on pace for its largest percentage increase since November of 2020, reporting a beat on earnings per share and sales, and the company also announcing a $500 million accelerated buyback. We got plenty on this. Our panel will be talking about this later in the show. Watching HP spiking higher after Warren Buffett's Berkshire Hathaway initiated a major stake in that company. Berkshire purchased almost 121 million shares, worth $4.2 billion. That's an 11% stake. Now, the purchase follows other recent investments by Berkshire, including in Occidental Petroleum and insurance company Allegheny. Barclays downgrading Ford to equal weight from overweight, cutting its price target to $17 from $23. The analyst saying that investors underestimated the risks of inflation, production pressure, the impact of interest rate hikes in the auto sector. Ford reported a 25% decrease in U.S. sales in March. And here's a look at Rite Aid. Rite Aid tumbled this morning after Deutsche Bank downgrading the stock to sell, lowering the price target to $1. The analyst saying that there's a possibility the drugstore operator may not be able to generate enough earnings to continue as an operating company. I'd like to take a look here at Bitcoin. We've heard more about possible more regulation, though it's not really reacting in a big way. In fact, it's down 0.2. It's at 43,700. It's our pleasure to welcome in our next guest, and that's Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeffrey, thank you so much for being with us. More headwinds or more tailwinds? I mean, there's so much volatility even today. As I sat here in the morning, markets were selling off, and now we're in the positive. What's going on?
Yeah, right. It's an uncertain environment, and so the market's taking cues from anything it can to try and get a sense of what's going on. The fact that oil's down a little bit today, maybe helping to support the overall market. But I'm really focused on this idea of energy stocks and what we're seeing around the world right now. There's a lot of uncertainty, as we mentioned, leading to volatility, but there are some things we do know. And despite today's dip, oil prices are likely to remain elevated. And it's interesting. They're down 1% today, oil prices are, but energy stocks are actually up. They're actually one of the sectors leading the market. And I think that's telling. And it's telling us that demand is likely to remain strong. And this is going to remain an area of opportunity for the markets.
That's interesting because, obviously oil stocks and these energy plays are often dividend payers, and people like to at least get paid while they wait to see if they can make some money along the way. I mean, I just saw also, for example, mortgages are now above 5%. Right? We haven't seen that. It feels like a big deal for folks that don't remember when mortgages were 10%, 15%, 18%. But what does this move mean for home buyers who home prices continue to come down? How much of that is the big picture of our economic outlook?
Well, this is a global phenomenon. As rates begin to climb a little bit here, there's been a lot of housing accumulated at these very low interest rates. But historically, we haven't seen a breakdown in the housing market until lending conditions begin to tighten. So when we look back at periods of rising interest rates, we often see home prices and home sales do okay. It's when the banks stop making loans at any price that we see this retrench. That's why we want to watch the Senior Fed Loan Officer Survey. This is a quarterly survey that measures whether banks are tightening or easing lending standards, meaning, are they making down payments harder? Are they changing where the threshold is for credit scores and qualifying people for loans? If we see more banks starting to tighten lending standards and tightening overall financial conditions, that's when we start to see the home price environment begin to break down and all housing activity begin to fall. We haven't seen that yet, but we need to watch that data closely.
And I know you wanted to, as we were talking about energy, one area that you were looking at was alternatives, because demand is still there. And tell me a little bit about that.
Yeah, I'm excited about this. So we know the energy sector has been the best performing sector since the war in Ukraine began. But what's often overlooked is it's not just the traditional energy sector that's doing well, it's alternative energy stocks. In fact, the MSCI Alternative Energy Index has doubled the return of what we've seen on the World Energy Index. So actually alts doing better than traditional energy companies. And I think this is just tied to this idea that we're moving even more rapidly, perhaps, away from fossil fuels. And we're seeing that not just in Europe, but around the world. There's a huge new Green Deal that was approved last year in Europe that's being, that money's being spent. We're seeing that accelerate. We're seeing trends here in the US and in Asia as well. So I think there's a lot of momentum to this green movement and the technologies behind it that could really support these stocks. In an environment where we're uncertain about the overall economic picture, one thing we can be sure of is that more and more government-sponsored dollars going into these green tech companies.
Yeah, I love that chart, and the blue line being the alternative energy index, the MSCI Global Alternative Index. So you did show how well it's been doing there. And you know, when you look at everybody wanting to go more green, not to be confused with the Green Deal that's been tossed around here in New York, not that one. You're just looking at big picture. And you know, I wonder how this translates to solar, to EVs, to charging stations. I mean, do you think this moves outwards?
I think these things have been growing for a while, but they've been growing based on, you know, private participation and private investment. I think what's different now is that there's a tremendous government incentive to move in this direction. You've seen it from China, just simply mandating certain percentages of electric cars and building that out. That's a huge economy focused on that. We're seeing that in the rest of Asia. Europe literally is making a dramatic transition in terms of their energy policy over the course of the next 9 months. And they're talking about, you know, hundreds of billions or trillions of dollars being put in place in order to enable that. And of course, we're all aware of the trends here in the US moving in that direction. It's amazing the amount of solar adoption that we've seen, underestimated every year by the International Energy Agency. It just continues to soar. So the point is that I do think we're moving more dramatically in this direction than we've seen in a while, supporting these stocks.
Yeah, and there's some people who just want it. There are some people who make these moves because they receive incentives and subsidies and the like. You know what's interesting, too, in your notes is how you're talking about, based on channel checks in Europe, no one's slowing down, and that they continue to drive around even though gasoline is so incredibly costly. You know, what does this tell you overall going forward about, you know, the global economy picture?
You know, what we've heard from consumers is that they're greatly concerned right now. Consumer confidence surveys in the US and Europe and elsewhere are really at dismal, almost recession-like levels. But what consumers are actually doing seems to be something entirely different. While they may feel like it's a bad time to be shopping for a car, oh, they're shopping for cars. Maybe it's a bad time to be driving around, they're driving around. This is a chart I put together of weekly GDP tracker from the OECD. That's a big global economic think tank. They do a pretty good job with this data. And what you can see is since the war in Ukraine began, we're really not seeing a dramatic downturn in any real-time measures of economic activity. And that's true for driving, that's true for movie going, shopping, dining out. Any of the things we can measure that are kind of discretionary activities are showing no signs of retrenching, and some are actually accelerating, even in Europe, where the issues are most intense. So I think so far there are few signs of recession developing, despite this flirtation with inversion by parts of the yield curve.
Yeah, I'm glad you brought up all the things that people are doing. You remind us that we should get out there and get busy, get to the movies and dining and such. Jeffrey Kleintop, nice to see you. Thank you always so very, very much. Thank you. Chief Global Investment Strategist at Charles Schwab. Coming up next, we have the founder and CIO of EMQQ Global here with us to talk about the company's newest ETF fund. It has a focus on India and technology. Coming up.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave them Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Thanks for being with us. Let's take a quick look at the markets after days earlier sell-off. What a big difference, because most of the sectors had been in the red, and now we see healthcare, staples, energy, materials doing well, with the S&P now up 1/3 of 1%. The Dow is up 60 points at 34,557. The Nasdaq gaining 23 at 14,522. Maybe it won't snap that winning streak it had. You know, we were talking about the fact that it might lose this week. I'd like to get to our next guest, and we've been talking about what's been going on here, and this is EMQQ Global launching its new fund, and it is our pleasure to have with us Kevin T. Carter, who is founder and also the chief CIO, and so we're glad you're able to be with us. So. Thank you for being here. You know, we just had some great conversations about the different funds that are under the EMQQ umbrella. Tell me a little bit about what the big deal here is that you're into emerging markets and all things internet, right?
Sure. So EMQQ Global, which is our company name, we have 3 different offerings. The first is EMQQ, which is our flagship, which tracks an index of all emerging and frontier market companies. So there's about 130 publicly traded internet companies in China, India, Brazil, Africa. FMQQ is our second fund, which we launched about 6 months ago. That's ex-China, so it's EMQQ ex-China. Okay. And then the third fund, which we launched this morning, is INQQ, which is just India. And the story of all of them is the same. I mean, you have most of the world's people, 85% of the world's people live in emerging markets. They're becoming consumers. They're getting their first ever computer. It's not on their desk, it's a smartphone, and most of them don't have an Apple logo. And they're getting their first internet access. And what it's created is, I think, the fastest growing sector in the world. And China has been the biggest part of the EMQQ story for many reasons. It's the biggest.
Well, like we saw with EVs, I mean, with everything, right?
We can call it China an emerging market, but when it comes to the internet, it is the most developed market in the world. The e-commerce market in China is 4 times as big as the other 45 emerging and frontier markets combined. So the future of this growth story is going to be outside of China, in Brazil, in Africa, and in India, where you've got what's going to be the largest population in the world, the youngest population in the world, and the next 15 years will, I think, see an incredible explosion of Indian internet companies.
And as we see this rapid digitization that's happening abroad, right? They're playing some catch up, as you noted. Some of the countries got there faster, US and China, and now you have these emerging markets that are joining on board. India in particular, this is your expertise when you talk about this group overall. And India, as you see the number of people living there, the demographics of the younger folks, do you feel like, I mean, you wouldn't be creating these unless you really think they're all going to be winners, right?
Well, I'm quite confident that all of them will do very well over the long term. I mean, this is the fastest growing sector in the world by far.
Right.
Over the last decade, the revenue growth has averaged about 38%. Now, you know, the law of large numbers, it'll slow down, particularly in China, where e-commerce is now 30% of, retail. But in India, e-commerce is only 4% of retail. So in these next frontier countries, Southeast Asia, South America, Africa, this is where we're going to see a ton of growth in the next decade.
What do you think of our internet companies here at home and or internet-related companies, whether it's e-commerce or social media or cloud, I guess you really see the value abroad. But what are your thoughts on our ones here at home, since you're an expert in the field?
Well, look, I mean, they've dominated our economies, they've dominated our lives, and they've dominated our indexes in the stock market. I mean, the FANG stocks are, been a thing for a long time. And, when I started EMQQ, this was already quite clear. I mean, every time you turned on the news during earnings season, you'd see the FANG stocks were killing it, and there was a list of traditional consumer companies that were going to go bankrupt.
Sure.
And the same thing's happening in emerging markets, except they don't have the traditional consumption infrastructure.
These are some of the top holdings. Tell me about some of these names and why some are more heavily valued than the others, weighted within the fund.
Well, the index is market cap weighted, but with an 8% cap weight. So we limit the largest holding at 8%. And so the biggest ones right now are PayTM. This is the 197 is the name of the company, but PayTM is how it's known to people. This is the fintech leader of India, and it went public in the fourth quarter. The stock's had a big decline, as have most of the emerging market internet companies. But this is a company that's backed by Berkshire Hathaway. And being the fintech leader in India is a very good thing, because the government is pushing digitalization in a major way for all of their government services, and in particular for their financial services and their banking systems.
Well, governments love it, because then they could track everybody and they can get better data.
They get better data.
There's securitization. I mean, there's so many reasons why digitally countries should move forward.
And once you get the money on the phone, which is how this whole thing starts, then you can get into investment products, insurance products, banking products, and it also is the accelerator for other forms of e-commerce once you get the money on the phone. So this is a big part of the emerging market story.
So as you manage these funds here, how often do you rebalance them? What do you need to do to balance these three? You have one, that's sort of the worldwide emerging markets. You have one ex-China, and this one with a focus on India. Are you planning on doing more of these soon? Are you going to hold on to these three? I mean, you must be very busy trying to keep all these going.
Well, first of all of them are in EMQQ. So EMQQ is the master universe, and the other two versions are just subsets. So it's not like we have three totally different things. They're rebalanced twice a year, in June and December. And if we have IPOs that are large, so a company that's over $10 billion, we'll actually add it before the rebalance, and then do a full rebalance at the same time after 3 days.
All right. Well, I think it really is interesting. I mean, what do you think of, just a quick final thought, when you talk about those that led the way, the Facebook, the Google, Elon Musk getting on the Twitter board? Do these things blow your mind, or are you just fascinated how they crisscross or rule our markets?
If you think about how fast our worlds have changed because of the smartphone, and remember, we had a computer. I had a computer for 20 years before I got a smartphone, but making it mobile has really changed our lives and introduced all sorts of new business models. And it's even more powerful in emerging markets, because these people have never had a bank account. They've never had a cable television, and there's no Target store to go to. So they're leapfrogging traditional consumption and are even more digital than we are.
Yeah, it's unbelievable. Kevin Carter, founder, CIO of EMQQ Global. Congratulations to you, your team, ringing the bell again.
Thank you.
We're getting used to seeing you up there, but exciting stuff, and certainly seems like you're in the right place for growth and what's to come in the future.
Thank you.
Thank you so much for being here. We appreciate it. All right, keep it right here, because still ahead in the second half of our show, Michael Keeley will join us to talk about what he sees for Apple based on some JP Morgan notes, and more on the Fed, what's going on there, and winners and losers in the S&P 500 coming up.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from the New York Stock Exchange. Thanks for being with us. 90 minutes left in the trading session. So you can see that the Dow is virtually flat at this moment, though we've seen winners such as Merck and Walmart and Procter & Gamble helping to lead the way on the Dow Jones Industrial Average. You'll see some of the other major averages are mixed, right? The S&P's gaining while the Nasdaq's pulling back a little, and the Russell down 0.75%. Well, JP Morgan is taking a more cautious stance on the world's largest company. Let's hear all about it. Michael Keeley's been combing through this one. It's all about Apple. Tell us, Michael, what are you finding out here?
Well, there are a number of analysts at the research firms that have trimmed their estimates for Apple on a go-forward basis. And the thinking here is that the App Store is showing some weakness relative to the growth in App Store metrics at the end of last year. And so in taking a look at this, we can see that it's just a modest haircut is how it's referenced. I haven't seen the collective consensus estimates actually reduce, Nicole, when you take them, all the sell-side analysts out there. However, this thinking is that, we don't need to make a big reduction in the estimates because of the resilience of what Apple supplies against the slowdown in overall consumer spending. And so when you take a look at some of the data stemming from places like Sensor Tower, they can put a really fine point on the App Store downloads and the net revenues per download. And they saw that things slowed down, getting more granular about that, more of a slowdown in January and February than what we've seen more recently. So more recently, we've actually seen some strength, but it didn't make up for the App Store downloads, that was sluggish in January and February. And looking ahead, what they've mapped out is year-over-year growth of about 32% on a comps basis, which was average, now backing down to about 14% for the next 3 quarters, with gaming being the biggest area of app downloads, and that's where we saw some weakness as well. So tack on the supply chain concerns out of China, and I think that does spell out that there's a more clouded view on the services side of revenue for Apple, is what this is all really boiling down to, but not enough so that the analysts are really deviating from their original estimates altogether, but something to take a look at and to pay attention to as we move forward, Nicole.
Yeah, I mean, they did keep their overweight, as you said, so they're trimming some, but that 120 target seems odd considering that the stock's at 171, but they have an overweight. That feels a little confusing, but I understand, and we still know that it is the world's largest company, but, moderating maybe some demand for growth for smartphones going forward. Michael Keeley, thank you, contributor for the TD Ameritrade Network. Appreciate that. Now let's get right to Kevin Heel, Senior Analyst and Fixed Income Strategist at Argus Research. Thank you so much, Kevin, for being with us. So much this year to take in from the Fed. Yesterday were the minutes. Today, we see the 10-year here at 2.6. What are you thinking? And of course, inversion of yield curves is on everybody's radar. What are your thoughts?
Yeah, thanks for having me on today, Nicole. We saw yesterday the move by the Fed that they were looking at a 50 basis point hike, but due to the uncertainties in the war with Ukraine, decided on a 25 basis point hike. But I think they pretty much further cements a 50 basis point hike in May, as well as future 50 basis point hikes to get to that year-end neutral figure of around 2.5% and still waiting till mid 2023. So I think they've definitely stepped up their urgency on getting that rate to that neutral figure. The other part of that came out was the plan for balance sheet reductions. They're going to cap it out at $95 billion a month, $60 billion in treasuries, and $35 billion in mortgage-backed securities. The treasury portion will be relatively easy to manage as they have bonds maturing every month. They did note that they would keep treasury bills as a separate entity. They have about 300 billion or so in T-bills, which they're going to manage so that there's no disruptions in the shorter term end of the market, the so-called plumbing of the market. The MBS portion is where it gets a little murkier on how to get to that goal of 35 billion per month. As you know, mortgage securities pay down, monthly interest of principal and interest, and right now with the homeowners with a mortgage between 2.5% and 3.5%, and experiencing some inflation and higher costs in food and energy. So there's not much real incentive to, throw a little extra money into your mortgage and pay that down. So, if we look at it, 35 billion per month is the goal on the cap. It would get you to 420 million per year on a run rate. They've got 2.7 trillion in mortgages. So we're looking at a 15%, in principal paydowns, which we expect here to be the paydowns to be much, much lower, more in the 3 to 5% in principal paydowns. So they did mention that they're going to explore selling MBS once the passive portion is well underway.
Yeah. The 95 billion of monthly runoffs basically, I think took some folks by surprise because they didn't necessarily expect it to be quite so much. But the market has now digested it, hit this bottom earlier today, bounced back. In fact, you're seeing at least 2 of the 4 major averages in the green. Is there certain areas, I know you had regional banks as part of your notes today. Tell me a little bit about the financials, the different types of financials, and where it all fits in. This is mortgage rates I saw today above 5%.
Yeah, so I do cover a couple of the mortgage origination companies and a number of the mortgage REITs. They've gotten slammed on higher rates, but I do see, the one positive side has been the strategic increase in the servicing side of the portfolio, and that's the mundane task that the servicer, makes your principal and interest payments. They pay your taxes. So that the value of that servicing portfolio, has grown over, the last 6 months, and you're seeing the rates or the multiples that people are willing to pay on servicing had been 1 times the servicing book, and now you're looking at multiples of that. When I'm looking into the earnings that will be coming up, we'll be taking a look as whether they've retained the servicing on their books, but there could be the potential for some mortgage companies to sell that servicing in order to boost their earnings for the quarter. So looking at a couple of, Rocket, UWMC, and NRZ are 3 of the originators that I cover, and they've all been increasing their servicing books, as well as some of the regional banks that I covered, such as Citizens and Regional Financial.
Yeah, and I think Citizens, Regional Financial, some of these regional banks, as you noted, they don't really have the worldwide exposure, and they won't be as volatile, right? Next week, we're going to get a lot of these bank earnings. Do you think that we could see some really dramatic moves? Do you think we'll get much of what we're expecting from the banks? I mean, for example, Jamie Dimon was talking about potential losses and the geopolitical, just the risk that happens after what's going on in the slowdowns, Russia, Ukraine, putting everything together over the next decade.
Yeah, I think we'll see the regional banks should do fairly well. We've had they're lending a little more after their customers. They garnered new customers, especially during the PPP loans. Their net interest margins should increase despite the flattening in the 2s10 spread. A lot of theirs is shorter term lending. So we should see that, and they will be, won't be hurt by any of the overseas dealings, much like the money center banks will be hurt. And we've also seen them expand, especially in the middle market lending and the M&A businesses. A couple of these banks have bought some middle market M&A firms, and also expanding into wealth management platforms.
Right. Yeah, it's so good to talk with you, Kevin. Thank you so much. Kevin Heel, Senior Analyst and Fixed Income Strategist at Argus Research. Thank you.
Thank you, Nicole. Have a good day.
You too. Still ahead, our panel is ready to discuss Constellation Brands, the earnings, the alcohol, what's going on with this one, and the outlook coming up.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
I'm Jenny Horn. Here's a few more intraday movers to keep on your radar. Apple's first go at live sports will kick off on Friday when the company will broadcast 2 MLB games on Apple TV+. The show will be called Friday Night Baseball and will be produced by the MLB Network. The broadcast will have several tie-ins to Apple's products, including on-screen graphics highlighting batter walk-up music available on Apple Music, as well as baseball trivia with Siri. Beyond Meat is making its Beyond Burger and meatballs available at about 2,000 Rite Aid stores across the United States. The company's announced that these Beyond products are coming to the vast majority of Rite Aid stores. Beyond shares are lower today, while Rite Aid has shed over 20% following a Deutsche Bank downgrade. And Netflix is also lower after Piper Sandler trimmed its price target to $460 a share from $500, while reiterating a buy rating. Netflix has an average rating of outperform among analysts, with price targets ranging from $305 a share to $700. The streaming giant has shed roughly 4% week to date. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Thank you so much, Jenny Horn, for that report. Constellation Brands, we're watching the stock on the rise after the quarter. We have some details here. Brett Sifling's with us, Director of Get Invested, Gerber Kawasaki Wealth Investment Management, and Nadine Sarwat, Director Analyst, American European Alcoholic Beverages at Bernstein. Thank you so much for being with us. Nadine, I'll start with you. You have a buy rating on the stock. Tell us why. What stands out to you on this one?
Yeah, thanks for having me. Absolutely. We like Constellation. It's our top pick amongst the U.S. alcohol space. And what we really like about Constellation is its portfolio composition. It's exposed to all the pockets of growth in U.S. alcohol that we like, the biggest one being the Mexican beer import category, where Constellation is the key winner with Modelo and Corona. Penetration is still low among some of the key brands, especially Modelo. Consumers are wanting to premiumize even amongst this more challenging environment as different gas prices or other aspects affect consumer spending. They still want to premiumize alcohol. It is an aspirational product, but it is affordable luxury. And we think that trend will continue. It has best-in-class margins in the beer space. But we also think that putting this together with valuation, when we look at stub Constellation, so stripping out their share of Canopy, which we can discuss, it is meaningfully undervalued and trading at a discount to where we think it should trade today.
Right. And, you know, that Canopy growth part of it, is an important part. I do want to get to that. Brett, what do you think? I see you have an outperform rating. Tell us a little bit about your thoughts, especially since we heard from the company now.
Sure, it's wonderful to see Constellation Brands on this earnings report. I was, surprised that they did so well leading that beer segment. They had a little bit of slack within their wine and spirits, but I think the two most important points of this earnings report and call were really the Sands family willing to give up control of their shares. And I don't know if this is because they're looking at other growth stories. There's been rumors of them maybe merging with a brand like Monster Beverages. And it was also nice to see that they started or accelerating a $500 million share buyback. So I think that those were really the two key points of the earnings report that we saw.
Right. And, as we talk about beer versus spirits, Nadine, I mean, you noted a lot of the demand that we had seen and also mentioned the canopy growth and cannabis. I mean, where should they be focusing based on your checks?
So they should absolutely be focusing on the core beer business. This is not only what I want to see, this is what investors want to see. This is a strong beer business that has a lot of juice to still give and a lot of growth to contribute, at least to the medium term, to solid top line and earnings growth. Past capital allocation mistakes, though, like Canopy, which you have just pointed out, but I could also call out Ballast Point Craft Brewery, which they acquired for $1 billion and then divested for $40 million. There's also the Mexicali Brewery, which they impaired earlier this year. All of these are indications of not the best track record of capital allocation. And that is why that proposal from the Sands family to switch up that voting structure is so important to investors.
Yeah, thank you for that. I mean, I'm glad you both brought the Sands family in because I think that's an important part of it. Another thing that I think, Brett, I don't know, were you surprised to see acceleration in that buyback program, Brett?
I was happy to see it because, I agree that management hasn't had the best execution. I mean, when we do look at Canopy Growth, they put in a little bit of cash and then they, kind of went all in when the company was nearly 30 times sales and still isn't looking to be profitable, at least for the next couple of years. And so management's track record, they're probably trying to shake it up a bit, find another growth story. They didn't do too well when the seltzer boom happened either. They weren't able to gain market share in that. They had, a weak attempt with the Corona seltzers, which aren't even that good. So it'll be interesting to see with this shakeup with the voting rights, if they're able to, reinvest in the business better and return capital to shareholders.
Right. And what about expanding? Brett, you also talked about Monster. I mean, is there something else that Constellation should be doing?
I think that the cannabis industry is interesting for them. And we do think that the cannabis industry is a lot more attractive than alcohol long term. You have the bill that just passed in the House recently. It's kind of in the Senate's hand for federal legalization at this point. But if you look long term, yes, beer is great. It's always going to be here. People love drinking alcohol. But ultimately, the long term growth that needs a reset is going to be in different industries, whether it's in beverages like Monster or cannabis products like through Canopy.
Yeah, and Nadine, I mean, it's such a competitive landscape overall. But what's your final thought here on Constellation as you have it as a winner? And do you have other names as winners in the group too? Is it the whole group that's doing it right? Or because the demand for beer, for example? Or is Constellation really doing something special?
Look, I think Constellation is really our top pick for the space, both because you have the strong fundamental earnings, but you still have a valuation mismatch because of those capital allocation issues that we've discussed. So you just asked me what else is my takeaway from the earnings today. I would just add two quick things. So the first is rising input costs are still affecting Constellation, perhaps less so than some other consumer staples out there, but their newly issued fiscal 23 guidance implies beer margins of 38.2%, and that is below the 40% that they were able to achieve this year. That being said, this is still better positioned company than some of the other alcohol names in my space. The last thing I would just touch on here is really what potential could happen with capital allocation. So the Sands family putting forth that proposed shakeup in voting rights is essentially offering The other investor is a trade-off. Better corporate governance, but at a price because they're having to do so at a 35% premium. Now, we think the math still works out in favor for this proposal. Current investors will get a 4% dilution in their current holdings, but could get a re-rating of Constellation stock of up to 17% in the share price. So overall, we're still feeling pretty good because all of these pieces indicate that it implies more focus on the beer business, probably less likely to have that deal now with Constellation and Monster, which we thought had very little strategic rationale.
Yes.
So we're encouraged by today's results.
Thank you both, Nadine Sarwat and Brett Sifling. Wonderful to see you both. Appreciate it very much. Did you hear about the guy who's drinking just beer for Lent in Cincinnati? I think that's an interesting story for the 4th time. Thank you both very much. Thank you, friends, for being with us on the watch list. I'm Nicole Petalides, 2 p.m. Eastern Time every day. And 11 a.m. Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Afternoon. It's 3 p.m. here in New York City. I'm Caroline Woods filling in for Oliver Rennick, and this is Market on Close. We have plenty to get to in this final hour of trading, but first let's get a check of the markets. Actually seeing some green arrows now, a bit of a turnaround here. Russell still negative, down less than 0.5%, but the major averages, Dow, NASDAQ, and S&P 500 all modestly, maybe firmly for the S&P 500 in the green. S&P up 0.6%, Dow up 0.4%, and NASDAQ up 0.5%. Here's a look at what's ahead on today's show. We'll catch up with Cowen's analyst covering Constellation Brands, the maker of Corona beer, seeing a nice pop following earnings. Then Tom White has his eyes on Pfizer, Corning, and Southwest Airlines for today's Options Corner. And in the second hour, we'll go one-on-one with the CEO from Flywire. So be sure to add ticker symbol FLYW to your watch list ahead of that interview. All right, before we get to all of that, let's welcome in Kevin Hinks, the co-host of Fast Market. Hey there, Kev. Before we get to some of the movers today, just kind of want to get a sense of your take on this market. Obviously, the gains that we are seeing are modest, but that tug of war between the bulls and the bears, it looks like the bulls are prevailing today, at least.
Yeah, hi, Caroline. This market has shown its ability today to take a pretty good punch the first couple days of this week and remain standing. If you look, it's healthcare, it's consumer staples in the S&P 500, and now Microsoft and Apple are up fractionally on the day, Caroline. So slowly but surely, 3 of the 4 major indices, with exception of the Russell 2000, are now green on the day, and the S&P is now up about 0.7%. So a real impressive, slow rally here the second half of the day, as these markets have absorbed a bunch of information, not only from Lael Brainerd at the beginning of the week, but the Fed minutes yesterday. Some of the data that came out today, jobs claims, was really strong, historically strong. And so without a lot of economic data to change the narrative, this market is beginning to firm up here slightly, Caroline.
We also saw Walmart hit an all-time high today. It's up about 1% right now, just under $157 a share. What were investors excited about there?
Yeah, Walmart on February 24th was $132, and it has gone straight parabolic since then. Now the news is there's an Indian e-commerce company, Flipkart, that Walmart is the majority owner of, that now has just adjusted their IPO. It was supposed to come out earlier around $40 billion. Now it's talking between $60 and $70 billion. So this would be a nice windfall for a company like Walmart, giving it some more strength. But the overall consumer is still strong. Walmart having an incredible run here up to new all-time highs. Caroline?
I also saw that they're increasing their their freight drivers' salaries to start at $110,000. I mean, tough job, but if that's your industry, that's a pretty nice base salary to start. But let's move on. Piper Sandler had a price target move for ExxonMobil. It's up about 1.4% today. What was that price target move?
Yeah, Piper Sandler kept the same rating, but moved the price target on ExxonMobil from $87 to $102. Obviously, with everything going on in crude oil markets right now, this is going to be pretty profitable for the oil companies in general. Firms are moving their price targets to slightly higher levels, as even though we're significantly off the scary $130 level that crude oil was, crude oil prices are still supposed to remain elevated for quite some time, Caroline. So, as you know, some of the CEOs, ExxonMobil, Chevron, are in front of the House of Representatives today. They're getting grilled on pricing, and I have to be extremely careful here now, Caroline, because I don't want to disparage anyone. But I think what we learn from a day like this is that politicians don't really understand how commodities are priced in the futures market and how those prices lead to the prices of the commodity. And so I think they're in front of Congress stating their case and making them understand that there's been several disruptions, like the war in Ukraine and U.S. policy and supply chain disruptions, that are baked into a big pie, Caroline, and affecting the overall price of crude oil futures, which, by the way, have come down from their highs of $130, currently sitting at right around $96 for /CL. But a lot going on in crude oil. It's actually good news that it is now back below $100, but that won't keep politicians from getting their YouTube hit or their a couple minutes of fame grilling an oil executive.
Yeah, that's right. I wonder if they know more about oil or tech, because it's also sometimes funny to watch them talk about tech. Let's revisit those jobless claims numbers from this morning. Kev, didn't really have much of a market reaction this morning, but lowest weekly reading since 1968. Is this an economy that can withstand a more aggressive Fed? Because I think that's ultimately the big question, right?
Well, I'll tell you, there's a lot of things going on. This jobless claims number, remember, this is that high frequency data that comes out every Thursday. And what it shows is first-time filers for unemployment insurance. Now, if you've been watching the markets for the last months and year, we've been waiting patiently for this migration of these job openings and these people that have left the labor force to come back to the labor force. Well, Caroline, you may be seeing finally that great migration off the sidelines and back into the labor market, because these numbers, these first-time filers for unemployment insurance, this is historic. You have to go back 50 years to see numbers like we're seeing here. So really impressive. Now, for 2 weeks in a row, remember it was 202,000 a week ago. That number was revised to 171. This one comes in 166. That is nothing short of historic, Caroline. So eventually, that's going to start showing up as a bunch of people appear to be leaving the sidelines and re-entering the labor force. Caroline.
It's time to go from the comfort of their own homes back into the office. Kevin Hanks, thanks so much. Appreciate your insights.
Have a great day, Caroline.
Thanks, you too. Now it's time to bring in our next guest. Rick Bookstaber is co-founder and head of risk at Fabric. Hey there, Rick. Thanks for being here.
Hi, it's good to be on.
All right, so I want to talk to you because I know you are all about risk. So what's the biggest risk to the market at this point?
I think the biggest risk that's reasonably long-term is inflation and the impact specifically that inflation is having on rates. Second to that, of course, are the issues in the war in Ukraine, which contributes to inflation, and the commodity prices and the stresses there. And then the one that's always in the back of people's mind and isn't going to go away soon is simply the high level of equities, the high PE and price to sales ratios, the high concentration in that market. But that doesn't have the legs that inflation and the relation to interest rates can have in terms of risk.
Well, I was looking at your notes. So obviously, we had a Fed-induced rally for the past 2 days. Markets are looking higher today as we enter the last 50 minutes of trading or so. But there's the big question, obviously, is can the Fed achieve this soft landing, right? Raise rates without pushing this economy into a recession. But some turn to the bond market for safety. And I saw a note that you said safe bond investments are actually risky as well. So what should we consider when it comes to bond risk in a higher rate environment?
Yeah. So for some background there, people have the sense, they sort of have rate myopia. They look back maybe 10 years when rates have been extremely low. But if you look back further, you can see rates actually can be higher. Rates can be 5%, 7%. And in that sort of a world, 10-year bonds dropping 10 or 20% is not a fantasy. So when people think of bonds as being stable, being the conservative part of their portfolio, well, yeah, they're probably more conservative than stocks, but they're not as conservative as maybe people think they are based on recent history. And by the way, corporate bonds are even worse because corporate bonds will drop as rates go up, and when rates are higher, the cost of funding is higher, so risk of default is greater, which means the spread over treasuries increases. So that's where there's risk. It's not only risk because it's greater than it's been in recent history, it's also risky because people don't expect it to occur. So what can you do about that? Bonds actually, the risk is manageable if you hold bonds that match the liabilities that you're trying to fund with those bonds. So you don't have to be taking risk there, but if you buy bonds and you're absorbing the mark to market as rates go up, you can see a real impact on your portfolio.
Okay, so shifting from bonds to equities, which areas of the market at this point would you say are most risky other than some of the non-profitable companies without earnings?
So first of all, I'm not necessarily saying that you're not going to reduce your risk when you go from bonds to equities, but you're not going to have as low a risk as you think you do if you go from equities into bonds. But if you are to say, you know, it's just not worth holding bonds because they simply are not going to give me the risk protection, so I'm going to take risk, I may as well take it in equities. I don't really have a sense of what part of the equity market you go into. And part of that is my background and orientation, which is towards risk. So I'm not so much focused on prognosticating the market as pointing out vulnerabilities and potential scenarios that could be troublesome. So I can point to parts of the equity market that are particularly vulnerable. I don't know that I would be the person to tell you which parts of the market are attractive.
Okay. So let's turn back to the war in Ukraine then, because there's still a lot of uncertainty and risk around there. Obviously not playing out in the equity market as much right now, but we're still seeing it certainly in the commodities markets. But how big of a risk is the current geopolitical landscape in your mind?
If you had asked me this 3 or 4 weeks ago, I would have said not that great, because typically when you have geopolitical events, they dissipate fairly quickly without a big impact on the market. This has been surprising, partly not so surprising because you know, we do see an effect on commodities, but the action of Russia to try to lay waste to Ukraine and the implications that can have longer term is really baffling. It's surprising that they would be so aggressive and actually vicious, but it also is not in their own best interest to be doing it. So it's hard to understand. It would be hard to have anticipated that. But there's, even with the war in Ukraine, there's a short term, a medium term, and a long term. So short term, clearly there's pain, clearly there's contribution to inflation, which, as I said, is a dominant risk. Medium term, things will tend to dissipate. By medium, I mean, say 1 to 3 or 4 years out, because we'll find alternatives to Russian gas and oil. Europe, Germany will. And we'll make adjustments in terms of finding sources for commodities. Longer term, the issues are going to be, first of all, clearly a long-term impact on Russia, but also one more nail in the coffin for globalization. And as you reduce globalization, that has a kind of a secular effect on productivity and on the markets.
So Rick, what's the key takeaway from all of this when it comes to what should our viewers be considering as they navigate risk? What's the key takeaway?
The key takeaway is that from many directions, risk is extremely high compared to history. And you know, whether you're looking, I would not use the VIX as an illustration of this, because a lot of the risks are more structural and longer term. But between the problems you can have with inflation, the overhang of possible recession, the combination of the two that can lead to stagflation, which you don't want to make a direct comparison, but you can look to the 1970s and, you know, we may not repeat history, but as Mark Twain was reputed to say, we may rhyme with it. The markets being very high in terms of fundamentals and high leverage there, and the bond markets facing a possible drop because of rates. You know, this is just not a period of low risk. And we're not seeing it manifest right now. If it had occurred, it wouldn't be a risk anymore, it would be a reality. But if I'm an individual right now, I would take the world, take volatilities being much higher, risk being greater than what you might be observing in the day-to-day, and take that into account. Whether you de-risk on that basis, move more into cash is sort of a call to make. But I see a lot of different areas where there's uncertainty.
All right, we'll leave it there. Rick Bookstaber, co-founder and head of risk at Fabric, thank you. Coming up, we'll order up a full flight of Constellation Brands coverage and find out why Cowen has an outperform rating on the maker of Corona. Stay right here on the TD Ameritrade Network. Market on Close. We'll be right back.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. Following earnings, Constellation Brands is outperforming the rest of the market today, so it's time to discuss some booze. For that, we welcome in Vivian Azer, Senior Analyst covering beverages, tobacco, and cannabis at Cowen. So good to have you, Vivian. Let's start with that earnings report. What stood out to you, and what's making investors so upbeat today?
Two key factors, and thank you, I'm glad to be here. One is exceptional beer growth. Constellation continues to be the best operator in U.S. beer. They consolidate 100% of the market share that both Anheuser-Busch and Molson Coors continue to cede, and they're doing that with premium brands like Corona, Modelo, and Pacifico. The other key factor from today's earnings release was the announcement of a $500 million accelerated share repurchase program, which is slated for fiscal 1Q23. The reason that the ASR is helpful, obviously, buybacks are great in terms of reducing the share count and contributing to earnings growth, but we also think that it really signals to the market the commitment to capital allocation that CEO Bill Newlands laid out last quarter. That's against a backdrop of market speculation around a potential combination with Monster, and that's on the heels of the controlling family, the Sands family, having issued a letter to the board over the weekend indicating their willingness to reduce their voting control from roughly 60% to 20%. That's being very positively received.
All right, let's talk about that exceptional beer growth. Where is that growth coming from? Do we have a whole bunch of new 21-year-olds on the market who are drinking beer, or are they taking it away from other brands?
They're absolutely taking away from competitors. And that's been very, very consistent, where they're gaining over 200 basis points of market share year over year, every single month in Nielsen tracked channels. We think that that really does reflect, though, not a bunch of new 21-year-olds, but a new generation of drinker that has very different demographics from older drinkers. We're dealing with many more multicultural consumers. In fact, when Constellation offered their medium-term outlook for beer revenue growth of 7 to 9%, they have consistently said that about 3 points of that comes from multicultural mix shift in their consumer base.
Very interesting. In terms of the underlying business, inventory, supply chain issues, cost pressures, how is Constellation faring there?
Well, cost issues are tough, and they're tough for everybody in my coverage universe, beer and the broader consumer staples sector. And so you're contending with it in a couple of ways. One, you're taking pricing. Constellation Brands generally aims to generate 1 to 2 points of price mix as part of their revenue algorithm every single year. They're guiding to be at the high end, maybe slightly above that. That does stand in contrast to a number of their beer competitors that are looking to take above average pricing. We really applaud Constellation for taking a more measured approach to pricing, given the broader inflationary backdrop. Their beers are already very expensive, 30 to 40% premium to offerings like Bud Light. So their consumers already trading up to enjoy offerings like Corona and Modelo. So we think it makes sense to be more judicious on pricing and try to offset margin headwinds with productivity and frankly to absorb some of it. So the beer segment generated a 40% operating income margin in fiscal 22. They're guiding for about 200 basis points of compression. From a supply chain standpoint, they certainly experienced quite a lot of disruption during the first summer of COVID in 2020 because 100% of their beer is manufactured in Mexico. And there was a time where beer manufacturing was not deemed essential. They did build safety stock, of course, but getting inventory levels back to satisfactory quantities has taken time. We were happy to hear from management today that they do think inventory levels have normalized with their wholesalers.
In terms of guidance, it was a miss by some estimates, but in line with your estimates. So if we do see a potential slowdown like many are calling for, how is Constellation poised to handle that? I mean, is this considered a recession-resistant industry like it has been in the past?
We think beer is resilient, and we think Constellation's business is most definitely resilient. If you look over the last 20 years, beer, not Constellation, but the broader beer category has been subject to market share losses to distilled spirits. Our proprietary research at Cowen helps us understand that. There are generational shifts in alcohol preference where younger consumers do have a higher preference for spirits relative to older age cohorts. Nonetheless, where beer plays very favorably in a tougher economic backdrop is that the cash outlay is more palatable to the consumer. So, you know, a can of beer, like a 24-ounce tall boy, much more affordable for a consumer than a 750 milliliter bottle of distilled spirits. And so to the extent, and we're not seeing it yet, but to the extent that consumer tightness really does take hold and cash management comes into play, that should favor beer.
And then you mentioned Monster at the top of your segment, but just want to follow up on that. How likely is a combination deal with Monster?
We'd written about it over the course of the press reporting, which really started late last year, and we'd been skeptical on the logic behind that. You know, to the extent that conversations were happening, I wouldn't be surprised. We've seen a lot of blurring of the lines between alcohol and non-alcoholic beverages. You know, Coca-Cola has a partnership with Molson Coors, both on the Topo Chico brand, as well as on Simply for a flavored malt beverage. They've got a partnership with Constellation, in fact, with Fresca. Pepsi's working with Boston Beer Company on a Mountain Dew flavored malt beverage. And so the fact that conversations are happening, no surprise there. In fact, in January, Monster made an acquisition of a craft beer operator. That said, for Constellation to acquire Monster, that part did not make sense to us. It would be a very expensive transaction, and it would really change the mix of the business geographically. Constellation has very small exposure to international markets. In fact, in the decade plus that I've been covering the company, they've been exiting international geographies, not entering them. And international is an incredibly important growth driver for Monster, and so strategically, we thought that was a stretch.
In terms of growth drivers, how does cannabis play into it for Constellation?
Cannabis has been challenging. We cover Canopy Growth. That's the company that Constellation made a strategic investment in the summer of 2018. It was $4 billion for 39% of the entity. And then Constellation's CFO, David Klein, moved over, and he's now serving as Chief Executive Officer of Canopy, and he's been in place for a couple of years now. The Canadian marketplace has suffered some pretty meaningful price deflation. Prices have been coming down, and that's been an impediment in terms of profit generation. We think it's a nice option. We're long-term constructive on cannabis. We've been covering the cannabis sector for 6 years now, but there are some market dynamics and capital allocation choices that need to be worked through, because broadly speaking, the Canadian operators have had a very tough time generating positive adjusted EBITDA in their home market. But for the U.S. operators that we cover, they've proven that the cannabis can be very profitable.
All right, we have to leave it there. I should note that you have an outperform rating and a $275 price target on Constellation. It's up 5% in the last about 30 minutes of trading, and it's trading around 243. So Vivian Azer, senior analyst covering beverages, tobacco, and cannabis at Cowen, thank you so much for all of those great insights. Up next, it's time to head to the options corner. Tom Wade has some big trades he's found in today's action. We'll find out which stocks have drawn a lot of interest today. That's ahead next on the TD Ameritrade Network.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. It's time for Options Corner. Tom White is joining us from the Chicago newsroom. Hey there, Tom. I know you found a couple of bullish trades and one bearish trade, but let's start with Pfizer. It's big winner today, up 4.5%. What's got the healthcare name on the move today?
Yeah, I think it's based on the fact that they are taking over a privately held company for about $525 million, Reviral, that provides respiratory therapeutics. Now, I think that it's already going to equate to about $1.5 billion in annual revenue for this company. So if you're paying only $525 million for it, with that potential moving forward, it goes right to the bottom line for this company. That's why you're seeing Pfizer up over 4%. It's still down about 6% on the year. It's off of those all-time highs above $61 a share that we saw just in December. But also a catalyst potentially coming up is a potential order for Paxlovid, their COVID pill that's supposed to get a bunch of orders out of China and other parts of the globe. So maybe some bullish sentiment there. Got put on a positive catalyst watch out of Citi a couple days ago also. So you're seeing some movement in there. And as far as unusual option activity, we're seeing a lot of call buyers in there. Over 200,000 calls have traded on the session. It's about 5 times normal daily average volume that we've seen over the last 5 trading sessions. And one of the big strikes that they were piling into early on this morning, buying the 54 strike calls in the April 8th weekly option. So these expire tomorrow at the close. So really short-term call buyers in here. They paid an average debit of only 90 cents, Caroline, and that break even of 54.90. The stock's already above that break-even point, so they're doing well on this position already. You can see the risk profile there, 35,000 of those traded. And if you look at that break-even, like as I mentioned, the stock's already above there with the expectations that it's going to continue to move higher into the end of the week. And this stock was only up about 3% early on in the session, but has continued to move higher as markets reversed from losses.
All right, yeah, it's currently trading around 55.28. All right, let's move on to Corning, ticker symbol GLW. You found a bearish trade for Corning. It's down about 1% today.
Yeah, and this is a head scratcher, right? It's they do displays, whether it's their contract with the iPhone and TVs, but we've got consumer demand that might be waning a little bit. The stock hit basically 18-month lows today at 33.75, down about 1%, off 7% so far this year. Fourth quarter sales did rise 10% year over year, and if you look at the margins, they started to decline. I think that's why you've seen this rapid deceleration in the stock price over the last couple of months. Inflationary pressures coming into play, and consumer demand deterioration might be what's driving the stock down. Now it is about 75 cents above those session lows, which were an 18-month bottom in the shares. But I think somebody thinks it's going to continue to move lower over the next month and a half or so, because we saw a trader come in and buy 5,000 of the May 35 strike puts for an average debit of $1.95. So taking a bearish stance here. That break even of 33.05 to the downside over the next 43 days, that's about 4% below the current share price. Put volume overall on every option strike is only 10,000, and that's 7 times normal daily average volume that we've seen over the last week of trading. So somebody piling in thinking, hey, this isn't the bottom for Corning over the next month and a half here. You got 43 days in this position. So somebody taking a bearish stance on a day that it's hitting 18-month lows, Caroline.
Well, it's not the analysts. They still have buy ratings for the most part. 11 buys, 3 holds, no sells. I know they have a longer term outlook, but still like to check nonetheless. All right, finally, you've got one in the travel space. What did you find for Southwest Airlines, ticker symbol LUV? Of course, it's down 3% today.
Yeah, all the airlines are under pressure. Barclays had a bunch of notes, not only on Southwest, but also the sector in general, cutting price targets. Jet fuel inventories at record lows here as the price of flying continues to move higher, but they haven't increased capacity yet. So that's a concern for them. Will the consumer stop paying these, triple the prices that they were just 2 years ago over the near term? So I think the overall sector as a whole has been sliding. Southwest down 33% from year ago levels, even though they're only slightly negative in 2022 because we saw that big pop in January. But they have been under pressure. But if you look at the call volumes, about 4 times normal daily average volume that we've seen, they were in there buying calls. It seems like the speculators come out in the airlines every week or so expecting that we're seeing demand still there for flights, right? But at the same time, if their margins are getting squeezed by not only jet fuel prices, but wages and the lack of capacity that they have, you might see, these inflationary pressures starting to weigh on a lot of these airline stocks. But the one that stuck out to me today was in the May 47.5 strike calls. They bought 15,000 of those earlier in the day for an average debit of 55 cents. So that break even for this bullish trade to the upside, 48.05, that's about 13% above the current share price. And like I said, despite that sell-off in a lot of these airlines, you're starting to see the speculators come out in here thinking they're going to pick a bottom as these stocks have been under pressure over the last 52 weeks.
Picking a bottom, it's a tough thing to do, but they can try. Tom White, thanks so much. Appreciate it.
Thanks.
Coming up, we'll turn our attention to commodities and futures products. Path Trading Partners Bob Iacchino will provide his latest thoughts on crude, gold, and more. So stay right here on the TD Ameritrade Network because Market on Close will be right back.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company details provide summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back. When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
A muted outlook for fiscal 2022 on the back of macroeconomic uncertainty. The team said they disagree with the street's valuation of Bye Bye Baby and are skeptical that Bed Bath & Beyond will ultimately spin off the business. Biotech stock Blue Water Vaccines is pacing to close the day 80% lower after being paused for volatility multiple times in today's session. Blue Water Vaccine saw over 2,500% of its daily average volume over the last 100 days today, trading at a volume of 1.1 million. The company went public in mid-February for an IPO priced at $9 a share. And with the 2022 Masters Tournament now underway, online gaming companies are looking to capitalize on betting for the event. Tiger Woods, the five-time Masters champion, returned today to his first professional round of golf since November of 2020. Although Woods is far from the Masters favorite, on DraftKings Sportsbook, he is by far the most bet-on golfer to win the tournament. John Rahm is the betting favorite to win as of Thursday morning. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Caroline Woods.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. It's time to turn our attention now to some futures products. Bob Iacchino, founder, chief strategist, Path Trading Partners, is standing by. Bob, thanks for hopping on. I want to start with crude oil because it was lower just until a little bit ago, now up about 0.6%, trading near 97, was around 95. What do you make of the move higher, and any significance about the fact that it's still below 100?
Well, hi, Caroline. Thanks for having me. To me, it's 100